crore with an uptick of 16% on a YoY basis and a growth of 7% sequentially. So all in all, if we see, the revenue growth, degrowth is largely offsetted by EBITDA margin expansion.
Okay, all right. Thanks a lot for that, Upasana. Rima, coming back at you. Persistent Systems, numbers look pretty good.
Yes, good numbers. 4.4% revenue growth. When the large caps are growing at what? Less than 1%, 1.5%, 2% kind, you have Persistent Systems growing at 4.4%, and EBIT margins too expanded by 80 basis points quarter on quarter, again ahead of expectations. Now, just to quickly summarize, CLSA says it's a high conviction outperform for them. They've raised the target price. The company in the press conference also reiterated their 2 billion revenue aspiration by FY27 and margin expansion this year and next year. And CLSA says that the company is positioned to deliver one of the strongest EPS growth in the entire IT pack, 29%, FY25 to FY27. So we keep talking about how IT is not growing, but there are some mid-cap companies, IT companies, which are growing. So 29% EPS growth is what CLSA expects between FY25 to FY27. The only thing is, in the case of Persistent, Coforge, stocks have run up, stocks are expensive. Now, for instance, Persistent is trading at 37, 38 times forward multiple, which is why some brokerages like the story. They say it's growing fast, but valuations are on the higher side. So you've got some neutral, hold calls too.
The con calls happen, Rima? Or
con calls happen.
And nothing on toward there. So
no, nothing on to that. Yeah, we'll get chatting with the management again later today. So we'll try and grill them more. But from the conference call, it was all fine.
Okay, all right. Thyrocare is the next one we want to focus on. Ekta's got details here. Ekta, morning.
Morning. Well, revenue up around 22%. Margins also improved to 33% versus around 27% year on year. And the profit was strong at around 80% growth. Now, pathology has seen a 24% growth on a year on year basis. It's the bulk of their business at around 202 crores. Franchise revenue was up 20%. They are debt-free with a net cash of 190 crores on their books. The company's also issued a bonus share of 2:1 in terms of a ratio and declared an interim dividend of around 7 odd rupees. So I expect the stock to be in the green.
Okay, all right, Ekta, thanks a lot for that. Well, let's hop across to Vivek. Rustomji or Keystone Realtors, that deadline was approaching where they had to reduce the stake, and Vivek is picking up that they're going to be doing that. Vivek, tell us more.
Well, absolutely right. Like you mentioned, promoters have to go down and bring their holding to below the 75%. At the end of Q1, they held close to 78.34% stake in the company. And so what they've done is they've gone ahead and launched an OFS, or an offer for sale, where the promoter selling shareholders are Bowman Rustom Irani, Chandresh Dinesh Mehta and Percy Chaudhary. All of them will bring their stake lower together by over 3%. Now, the floor price for this particular OFS is at close to 550 rupees a share, implying a very significant discount, almost 10% discount to the last closing price. The offer size is 3.63% of the total equity. That brings the offer value at the floor price to a little over 250 crore. Minor dilution, but at a significant discount. So going with the red as far as Keystone is concerned.
Thank you very much for that. Wow, 3 years done from their IPO. IPO was November of 2022, and the issue price was 541, and the stock today is at 612. So it's given about what? 12-13% kind of a return in 3 years. Offer for sale today. But Vinny's now joining in for more stocks in the news now.
Hi, yes, good morning. So starting with Kotak, they gave their Q2 update. It seems like a weak update that's come in because the sales value is down by 13%. Volumes are down by 17% during Q2 FY26. Realizations a mild uptick of 5% and collections are up by around 8%. So we are expecting red today coming in for Kotak. Solar Vineyard, that's another one that came out with its Q2 FY26 updates. Net revenue is down by around 1% and revenues are at around 140 crores approximately. Own brands revenue, that's down by 2.5%. Wine tourism, that's the only one that's supporting in terms of growth, right? So we're seeing 7.7% growth in terms of wine tourism revenue. Keep an eye out on that, but red expected here as well. Mishra Dhatu, that's another one that we're keeping an eye out on. They've secured orders of around 306 crores and that takes the total order book to around 2,212 crores. So keeping an eye out on that.
Okay, all right. Thanks a lot, Vinny, for that. Hopping across to Parikshit, Hyundai has come out with details with regard to path ahead. I think they have the investor day meet as well. Parikshit joins us to fill us in with all of those details. Parikshit?
It's a big day for Hyundai since the time they've had their IPO. Yes, they have that investor day. Their global CEO, Jose Munoz, is here in India as well to speak to investors and various stakeholders. They are releasing a 5-year plan today with an aim to invest 45,000 crores in the India market. And in fact, sources close to the companies tell us that their plan is not to just double down in India, but triple down in India over the next few years. So they will be investing extensively in product development, in expanding their footprint in India, in digitization as well, also in electric vehicles. Now, speaking about future launches, they have 26 launches planned till 2030. And today, Hyundai will be giving a plan for that. So they have at least 7 new products that are coming up. They've got an all-electric SUV that will be launched in India in 2027. They have a plan for an MPV and an off-roader SUV as well. They want to grow their revenue to over 1 lakh crore by 2030. Have India as a very strong export hub. Maybe have 30% of Hyundai's exports coming from India alone. So a very strong plan for India that is going to be unleashed, something that investors had been asking since the IPO had happened. Let's see what happens and what more Hyundai has to say during their Investor Day, which will last for about 3 hours from 9 a.m. onwards.
Okay, thanks a lot for that, Parikshit. Well, I'm focusing on ICICI Lombard, and out there, the net earned premium. That came in high by close to 12.5%, so that's a pretty good reading, good amount of growth out there. The operating profit as well was up by close to 13.5%, so that as well is a positive sign. The underwriting loss, that's more or less stable. So, we'll have to find out further with regard to that. And the combined ratio as well, ballpark in that vicinity of around 105%. So, we'll be talking to the management, during the course of Bazaar in the next hour or so, and we'll try to get further clarity. But for the time being, these numbers go down with a mild green on this one. That said, let's do a quick recap of all the top stocks we just covered for you. Positive news flow stocks first up. Tech Mahindra, ICICI Lombard, Persistent, Cyan DLM, Thyrocare, Mishra Dhatu Nigam, and Hyundai. While stocks that will be reacted to negative news flow, Keystone Realtors, Kotak Patel, and Sula Binians. Well, we'll slip into a short break. On the other side, we'll connect with the management of Leela Palace's hotels as well as resorts to talk about their second quarter earnings. Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to our chat with Leela Palace's hotels. They've reported a softer second quarter numbers. Some would say it's on expected lines. But to help us out with how the last quarter went by and what's the way ahead, we're joined by Anurag Bhatnagar, the whole-time director and CEO at Leela Palace's hotels as well as resorts. Hi, Anurag. Good morning. Thanks a lot for joining in. Coming across to you in a minute. For the time being, just highlighting the three broad talking points. The outlook for the second half of the year, international expansion, and further debt reduction. What's the trajectory on that front? Well, Anurag, thanks for speaking to us here on CNBC TV18. You've mentioned in the past, right? The second half of the year is typically strong. So what's the targeted occupancy we could be bracing for the second half of the year? And also, are we on track to hit that 100 crore PAT number on a quarterly run rate?
Hi, good morning, and thank you for having me here. Firstly, I'd like to spend some time on what you said earlier that we had a softer quarter. Well, the RevPAR for the company grew by 13% in second quarter. The EBITDA margin has grown by 17%, and with a blended EBITDA of 48.2%. So, and the PAT, the company has had 4 quarters of positive PAT. So at a run rate, the company is growing 4 quarters of positive PAT. And this growth has come from both growth in occupancy as well as ADR. So at a blended growth of occupancy and ADR, RevPAR has grown by 13%. And just before I come to the balance of the year, let me tell you, as the first half of the year, and you're right, that the second half of the year, which is H2, typically 60-65% of the EBITDA comes from the second half of the year. But in the first half of the year itself, we are trending at an EBITDA margin of 45.5%, which is a 555 bips growth over the same time last year. And our ADR has grown by 10%. So there are a lot of positive tailwinds in this segment that we operate in, on the luxury, the focus pure play luxury segment. Another key point.
Yeah, sorry, just to get the numbers out of the way, margins grew 750 basis points on a quarter-on-quarter basis, right? Some 300 basis points on a year-on-year basis.
So on a quarter-to-quarter basis, the margin has grown to 246 basis points to 42%. But I mean, like you said, look, if you look at the trends, this segment that we are in ultra luxury amenities, experiences, and the offerings that we create, we see a lot of tailwind behind us. And the power of the brand and the experiences that we have created, we see a very robust, high double-digit growth in the balance of the year as well. And for the full year, we look at mid to high teens in terms of ending the FY26 on a high growth.
Could be 15 to 20, between 15 and 20%?
Without ascribing us, yeah, I would say mid to high teens growth in terms of EBITDA. This is our outlook for FY26, looking at where we are trending in H1 and how we are expecting the second half of the year to unfold.
Anurag, I get that point. You're sounding quite satisfied with the last quarter's performance. But from a market perspective, I think ye dil mange more because the stock yesterday was down close to around 5%. That aside, that 100 crores per quarterly profit, are we on track to get there?
I would like to say that seems to be right now is a very conservative number, I would say. But if I was to talk about the PAT that we are looking at for financial year 26, I definitely believe that the number that we had outlined earlier is going to be achieved and exceeded.
Okay, so FY26 PAT in excess of 100 crore. I think you've also given an EBITDA guidance of 2,000 crore by FY30. Is that correct?
That's right. That's a 5-year guidance.
5 year, 2,000 crore.
That's right.
And how will you get there?
So that is coming from 4 levers. One is the same store growth, where we see a lot of potential to grow both occupancy and ADR in the hotels that we operate. Second is the pipeline that we have. We are moving from 13 hotels to 22 hotels. We have 9 new hotels coming into our pipeline, out of which 7 are under our ownership. Our key count will move from 3,500 approximate keys to close to over 5,000 keys. All of that put together, plus the new verticals that we have launched in terms of the members-only club, extensions of our brand in luxury residences, our international expansion that you want to talk about, which I can also talk about in a while. We definitely believe we are on track to achieve 2,000 crore EBITDA by FY30.
Okay, and this includes the acquisition. You spoke about the international acquisition. You all, along with your parent Brookfield, have acquired a property in Palm Jumeirah in Dubai. And Leela will own 25%. What do you expect from this particular acquisition? And how will this progress?
This is a great marquee opportunity for Leela. With a 25% of the capital that we are deploying, we're getting 25% equity. This location in Jumeirah, as you would know, it's a beachfront location with 23 acres, over 500 keys, one of the most luxury districts in the world, with a very high, I would say, in terms of propensity for luxury experiences. So A, it's a beachfront location and a great opportunity and a rare opportunity. Secondly, the very attractive investment economics. I mean, at a purchase price, which is like a multiple of last year's for CY25, 12.8 multiple of last year's EBITDA earning, is very accretive, value accretive to Leela, especially because we are planning a very fast capital recycling in over 2 to 3 years, which will come to us from the sale of branded residences. Plus, it will create a cash flow and fee earning for long term for us. So from an investment thesis, it's a very creative opportunity for us.
Difficult, Anurag, after that sort of a description for us to come back to the studio, but we're going to try to do that. Very quickly, the interest cost has come down as you have guided in the past. Tell us about the debt number and where is that headed?
So our gross debt is close to 1,400 crores right now that we have on our balance sheet. Our net debt is around 400 odd crores. Our gross debt to, our net debt to EBITDA ratio is 0.5x. Our interest cost has come down from 9.1 to 8.4, and the tenure has increased to around 15 odd years. So it definitely increases size and capacity and strength in our balance sheet for our growth.
Thanks, Anurag, for stopping by, giving us all of those details. You're bracing for better times, going by what you're saying, profitability, EBITDA number as well. Wish you well, have a good day, and we look forward to chatting up with you as the quarter progresses as well.
Thank you so much. Have a great day.
For the time being, we slip into a short break. On the other side, Deven Choksi of DR Choksi Finserv is waiting for us. He'll discuss some fundamental stock talk.
Okay, welcome back. There's 14 minutes to go for the pre-open session. The big listing from yesterday, of course, was LG Electronics. I mean, it's been one of the best listings for a company that size in this year so far. So got to about 1700, ended just under it. Hormuz is here with some of the stats, delivery, valuations. Hormuz, take it away.
Oh, what a day for LG Electronics yesterday. Bumper listing, 50% premium in comparison to its issue price, among the best listings of the year. And as you mentioned, the best listing of a company that size. Coal India had debuted way back in 2010 with a 40% listing pop. This surpassed it, and with this, it has now even become more valuable than its South Korean parent. Now, that current market cap that LG Electronics India has is 1.14 lakh crore, or around $13 billion. It's almost at a 40% more valuable than its South Korean parent, which is valued at around $9 billion. We'll take a look at the trading activity yesterday. Almost 11,650 crore worth of shares that changed hands. Incidentally, that's almost the same as its IPO size. The volumes as well, close to 7 crore shares were traded yesterday. 61% of them, or 4.25 crore shares, were marked for delivery out of these almost 7 crore shares. It's almost as if the brokerages are getting a bit of a FOMO to initiate coverage on the stock. We had 8 initiations yesterday. We have 1 more today. Nomura joining the list, the buy recommendation, an 1800 rupee target on this. And they're saying that this significant growth runway is due to the favorable demographics that India has and under penetration of a lot of these large appliances in the country. And premiumization is emerging as a secular trend across multiple categories, which now can act as a tailwind for a strong revenue growth for LG. Now, what they say is that the value creation for investors will depend on companies that innovate, localize, and profitably capture a large pie of the premium landscape. So 9 analysts initiating coverage. All 9 of them have a buy recommendation on LG ahead of day 2 after its listing.
Thank you very much for that. Whatever valuation arbitrage was perhaps present vis-a-vis LG's valuations versus peers is now played out. From here on, many experts are pointing out it depends on the kind of growth. And so far, the top line growth hasn't been higher than peers, though it is more of a premium, offering a premiumization story. Deven Choksi is now joining in. Deven, thank you very much for joining in. Lots of stocks in focus. There is Hotel Leela Palaces, where the numbers are looking very good. The management commentary is optimistic. You've got Hyundai Motor outlining ambitious capex plans over the next few years in India. And Tarun Garg will now be the MD and CEO, the first Indian to hold that position. Some IT earnings. Tell us your pick for the day, your standout stock.
Hi, good morning. Well, I think the overall earnings season is appearing to be, very promising. The IT companies which have basically reported earnings, even except, those kind of misses, slight small misses, that they may have, in the revenue front. But importantly, including HCL Tech Mahindra, you have found that the margin improvements, even though it is marginal, but has happened, which means the adoption of AI in the work environment has actually started yielding the result in form of, saving the cost and putting across, better efficiency. It appears clearly. And maybe this could be a starting point. So frankly, the IT companies, they are written down. They could be the one choice, which one would like to possibly follow hereafter. Even some of the B2B segment service providers within their engineering R&D space companies within the IT space as well. I believe that those companies are probably relatively better off, in the coming situation. And we will probably see, a smarter growth in those earnings. So I guess, the overall environment looks convincing today. Second half of the financial year is definitely appearing very promising from the early commentaries that we have started receiving from corporates. So remain relatively more confident than before as far as the outlook is concerned for 26 financial year.
All right. Hi, Deven. Good morning and good to see you. Ben, let's talk about banking names then. Axis Bank will come out with its set of numbers. But what about RBL Bank? Has it run its course at around 290 rupees? Valuation-wise, there's still some support. The only problem is the stock is up 60-70% in this year itself. A view out there?
Good morning, Nigel. Not any specific view, on RBL per se, but overall, within the corporate banking space, we remain relatively more positive with the companies with a larger AUM. I think this is one quarter where probably you will see the retail lending, I think, would have approximately grown faster than I think what one would imagine. I think we're waiting for the numbers to come out for large corporate banks. But initial indication after talking to some of the companies, they have actually seen, I think, a smarter growth in the retail lending. So the corporate banks with a good size retail portfolio are the ones I think which would possibly do well in the second half of the year as well, because of the fact that the consumption story is picking up. And we believe that I think this is going to grow faster. So I think we are more focusing on the larger corporate banks with a larger AUM book that they have.
What about Hotel Leela? It's not done too much compared to its issue price. I think it's hardly up 1%. I mean, the numbers look fine. The company is talking, it sounds very optimistic. Its EBITDA margins are closer to 45-50%. They're talking about a 2,000 crore EBITDA by FY30. Closer home, at least for FY26, the profit should be in excess of 100 crore. They're expanding rapidly, aided by the parent Brookfield. Is it the valuations? Because the hospitality story is doing well in India. Premium hospitality sector is doing well in India. So what's happening with Hotel Leela?
Well, I guess I think in general, you rightly touched upon this point. I think each one of them, be it Indian Hotels, be it ITC, be it even Hotel Leela, I think each one of them are talking about increasing the number of room keys, I think in next 3 to 5 years, which is a significant growth. In fact, if you extrapolate the number, I think they are talking about around 20% CAGR growth over next 3 to 5 years' time, which is fundamentally very positive. Not completely sure about Hotel Leela, but both ITC and Indian Hotels, I think they have indicated and they're significantly working in that particular path as well, or working on the asset-light model. So the profit margin, I think, which you alluded saying in Hotel Leela's case also, I think is looking more promising. Yes, India's story, both for the leisure as well as for the business tourism, I believe is, I think, helping this particular sector as a whole. At this point of time, since we don't have the coverage on our Hotel Leela, I think we will refrain from putting across any further view on it. But we believe as a sector, I think the strength is quite some, likely to remain firm as well.
All right, Deven, final question. Thyrocare, any view out there? One of the top winners in the last 1 year, actually Thyrocare comes up because in the previous years, actually it was an underperformer, but it seems to be getting its act together and the numbers are looking pretty okay. Your view on it?
Earlier, Nigel, I think we had the concern about tracking the stock possibly quoting at a valuation. Honestly, I think in the recent times, we haven't, I think, examined again on the valuation side, particularly the company. But on the whole, I think the story remains promising. If the valuations have become attractive enough, probably I think this could be once again relooked at it. We are not yet looked into it, so we'll refrain from putting the view on that subject.
Okay. Stay on. We will slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Sandeep Agrawal of Sovilo Investment Managers to decode the IT earnings that we got overnight.
Co-powered by SBI. Best है सबको पता है. Co-presented by Bank of Maharashtra. Ek Parivar, Ek Bank. Co-powered by National Stock Exchange. Soch kar, samajh kar, invest kar.
Welcome back. Well, the pre-open rates are going to start trickling in. For the time being, let's welcome our experts. We've got Sudarshan Sukhani of Technical Trends, as well as Mitesh Thakkar of Bonanza Portfolio, who joins us on the show. Hi, gentlemen. Good morning. Good to see you all in. The market's paused for breath in the last few trading sessions. Do you think it's going to resume the uptrend, or do you think it doesn't have enough to move higher and you rather stay away? What's the trade on the Nifty? Mitesh, you go first.
Yeah. Good morning, guys. So, yesterday we talked about 25,100 as the support and 25,350, 400 as the range to clear on the upside. We, for a brief period, kind of declined below 25,100 but closed above it, and I think those counters still remain same. We need to get past 25,350, 380 zones on the upside to give a breakout. Otherwise, we'll keep moving between this 25,100 to about 25,350 range. And my sense is that the chances of an upside breakout are more given the direction of the short-term indicators. But for the time being, I think the range remains.
Okay, the range remains. That's the call that's coming in there. Sudarshan, what about you?
Yeah, good morning. Well, the Nifty has come to a point where it is drifting sideways. Till something else doesn't happen, we have to assume that the trend remains up, because that's how it reached a sideways stage. So in an uptrend, keep a stop. It's becoming, repetition. Yesterday, I said the same thing. Last week, also the same thing. Keep a stop at 25,100 on a closing basis and stay long or buy on dips.
Okay, stay long, buy on dips. Let's get that pre-open rate actually out of the way. It's showing a 400-500 point downtick. Let that rate settle itself, then we go back to it. Mitesh, you go first. Tell us your stock picks.
So I have an all-buy list today. The first one is a buy on area, good price and volume, I think backed by positive numbers. The stock can possibly head towards 162 to about 165. Buy here with a stop at 151. A buy on IDFC First Bank with a stop at just below 72 for a target of around 76. I also have a buy on KEI, which might have fresh highs. That's a buy with a stop below 43.20 for targets of 44.50. And the final buy call is Inox Wind. I recommend to buy here with a very tight stop at 154 for targets of, stop of 145 for targets of 154.
Gentlemen, morning, Sudarshan. What about you?
Well, I have one intraday short to start with. That is United Spirits. Sell with a stop above 1320. All the rest are buying opportunities. Adani Ports is a buy with a stop under 1400. GSL is a buying opportunity with a stop under 760. And finally, IREDA is a buy with a stop under 150. Again, since the broad trend is mildly up, focus on the buys.
Look at the rupee. It's unusually strong start. 88.26, 88.80 was the close. Let's see if this stays, but it's a very, very strong start to the currency this morning. I'm not sure. I mean, the dollar index, the broader dollar was down 0.25%. So, that shouldn't... the rupee, of course, has been one of the weakest currencies in Asia this year. But what's the reason for this morning's move is the question. We'll try and get some perspective on it as we go along. I just want to quickly take a look at the pre-open as well in terms of where we are starting for stocks. The rupee is, of course, open very, very strong. But what about the markets? So 22 points lower. So settling down slightly sideways, 25,125, 25,130. And I think you've got the Nifty Bank and other stocks, etc., which will be opening up, which should give you a sense. So not very much on the Nifty Bank right now. But Reema, let's talk about the IT earnings scorecard so far.
Well, we've got three large caps which have reported numbers so far: Tech Mahindra, HCL Tech and TCS. And all three have reported a beat on muted expectations. So the revenue growth first will come up for you on your screen in constant currency terms. HCL Tech right on top, 2.4% revenue growth. You have Tech Mahindra at 1.6% and TCS is 0.8%. All this is better than what the street was anticipating. Margin performance too has been higher than consensus expectations, and margins for the company have actually expanded across the board. HCL Tech Mahindra margins expanding by nearly 1 percentage point. Part of it is also aided on account of the rupee depreciation. The rupee depreciated by 2.5% against the dollar, and that aided. Now, in terms of commentary, there is no big change in the demand environment. All the companies are saying that it's not gotten worse, but it's not that it's gotten better. In pockets, things are fine. Like, BFSI, for instance, has been doing very well. TCS maintained that its international revenue growth this year, FY26, will be higher than FY25. HCL Tech maintained the full-year revenue forecast, but for the services business, that's ex-software, they've tightened it. So they've raised the lower end of the target band. So 3 to 5% guidance became 4 to 5%. And Tech Mahindra too, yesterday in the press conference and the investor call, they reaffirmed that FY27 goalposts of industry-leading revenue growth, margin performance of 15% remains intact. So all in all, versus subdued expectations, remember the IT index itself was down 20% on a year-to-date basis. The performance wasn't too bad. But again, it doesn't imply that growth is roaring, is coming back in a big way. Sandeep Agrawal, fund manager at Sovilo Investment Managers, is now joining in. Sandeep, I know the broad call is that, the Indian IT companies, particularly the large caps, are not going to see any growth, not just this year, for the next couple of years. It's going to be, we are in a low growth environment for IT. But just talking about the near term and what we've seen from these companies, Persistent, etc., what would be your top 3 or 4 takeaways?
No, so, the most important takeaway in my view is that, none of these companies have gone ahead and done something wrong. That is a good thing, because in difficult times and in very good times, both the cases, generally companies and promoters do mistakes. And I think that is one thing which has not happened. So it is a very good thing they have conserved cash despite all the noise to do acquisitions and get into AI and all. This is, I think these comments which people make, probably they have not understood the industry properly. So I think the good part they have been able to do is that, like Accenture, they are continuously doing their work, and they know that it is a low growth industry, it is a mature industry, and they are not rushing and doing some mistakes. So that is the biggest positive takeaway, I think, for the industry, because there is no sense in going ahead and burning money. Second, I think versus expectation, because expectation was much weaker. Versus that, most of the companies have been able to, do slightly better in this environment where your efforts are going down dramatically. And most importantly, they realize very quickly that, the efforts are going to go down. So there is no point in adding manpower, and they have allowed natural attrition to, go away, and they have not refilled that fully. So, their at least margins have been kept under control and protected. So I think these are 3 key positive takeaways from the industry.
Got that. Sandeep, the expectation was that because we are in a low growth environment, margins will come under pressure in FY26 and even in FY27. But now, considering we've got the rupee tailwind, depreciation tailwind, but even the efforts taken by the company, as you said, rightly said, right? They're letting the natural attrition play out. They are in a sort of cost conservation mode. Do you think that thesis might get challenged? Then maybe the IT companies will be able to protect their margins, maybe even grow it in FY26, FY27. Is that a possibility? Because that changes the EPS estimates.
So, Rima, I am very confident of 2 calls. One, that, next 5 years, the large cap will not grow in double digit at all. That is not going to happen. Maximum growth will be mid-single digit to, high single digit. That is also very tough. But second call, which I have very contrarian call for the sector, is that I believe that in fact the margins will be protected, and I believe some uptick in margins will happen in next 2 years, because remember that when efforts are going down by 30%, you will not get revenue growth, but your realizations will definitely move up. So I am very confident on margins. I believe that margins have a tailwind, in fact, without rupee also. But yes, growth will not be there. So this is an industry which is matured, where growth will be less, but margin and EPS growth will be slightly higher. Also, EPS growth will be higher because of buyback if that continues.
So now in the large cap IT companies, would you have a pecking order?
No, so, we run a PMS. I will not give a call on any specific company, but I will say you this, that you see the number of last 10 quarters for all the large IT companies and mid-sized IT companies, barring 3 companies, no one has reported a double-digit year-over-year revenue growth. So that gives you the answer, right? So this industry has entered a phase where it is too much matured, and AI has cut down the efforts, which was the growth engine. So I think, we will be seeing this industry as a 5-6% growth industry, and some of the mid caps can do 10-11%, which are in ER&D, and then small caps can do actually 20% because the small pilots will continue for 3 to 5 years in AI, which will give very high boost to very small size companies in near term.
This HCL Tech announced, reported $100 million revenue in advanced AI. What are your thoughts on that?
No, see, obviously, every quarter you will see this number will shoot up for everyone. So there are two key numbers to watch in the industry. One is how many resources you are able to train month on month, quarter on quarter in AI. So that is very important because that will defend your revenues and that will also give you some growth going forward. Second is that, what is your contribution of AI in the overall revenue? I think both the numbers are very critical and very important. And I think all the Indian large companies are reporting good numbers there. I hope not much of that is reclassification of the existing business into AI and all, because see, it is very tough to segregate also. But I believe that they should say that the new business which they have got in AI, that will be more relevant. And that is something which we should look forward. If that is growing faster, then probably, this high single digit growth is also possible for the large cap, but it will take time in my view.
How should this $100 million AI revenue trend according to you? I mean, if you have to make projections, what would that number look like? Because we have, say, a comparable from Accenture, right? They've been giving it out for the last 2 years, the AI revenue. I mean, say for Indian IT companies, and we only have HCL Tech for now, which is reporting this, what could the number look like, say 1 year, 2 years down the line?
So I think in next 2 years, it will be around 15% for all the players, large players.
15% of the overall revenue will come in from AI.
Yes, absolutely. At least that much, maybe more.
Maybe more. And the other IT companies, you believe, will also start disclosing this number. And what would that mean in terms of valuations? Now, because this advanced AI is seen as more of higher tech work compared to the legacy application development work that they used to do. Therefore, can the analyst community or the investors make a case that these companies need to trade at higher multiples, at least for that portion of the business?
So, Rima, I think that the right way to always look at is compare with the NASDAQ companies. And in my view, there is a substantial overvaluation in the NASDAQ components. And I think when they start coming down and they come to realistic valuations, then probably, Indian IT companies will not get re-rated during that period. But I think there'll be flavor which will come back after maybe 12 months or 18 months into Indian IT services, large companies also, once that meltdown in the NASDAQ components happen. And I am very confident that, they are massively overvalued. And a lot of those companies which are today selling high-end technology in the name of high-end technology, they are actually going to be commoditized. Because basically those products are commodity. Right now, there is no competition. There is no big scale innovation which is happening. So I believe when that happens, you will see massive price correction. You can't have 60-70% margin on commodity products, right? So it has to come down. It is a matter of time. And when that happens, then, NASDAQ multiple will come down. And when that comes down, it will be very tough for us to get re-rated. That is the way I look at the sector.
Sandeep, always a pleasure talking to you. Thanks a lot for stopping by, giving us your quick take. We look forward to hearing your commentary and tracking the space as well. Thanks a lot for joining in. Well, let's go back to Sudarshan for his 9:10 call. Sudarshan?
Adani Ports, buy Adani Ports with a stop under 1400.
Okay, got that. Mitesh, what about you?
I think I'll go with the IREDA good price and volume action yesterday on back of good news. So they should see more continuation. Look for targets of 162 here.
Thank you very much for that. Let's put the spotlight on RBL Bank. It continues to remain in focus. And with the kind of news flow swirling around, this stock has almost doubled in 2025. Sudarshan joins in with more.
So it's been one of the stocks of 2025. It's, as you say, it's almost doubled in 2025. And in last 4 months, it's up almost 35%. And the reason, there have been several reports regarding Emirates NBD looking to acquire majority stake up to 51% or say 60% stake in the company. And if it's done, there might be an infusion of almost rupees 15,000 to 16,000 crore in the company. Apart from this report, if you look at the June shareholding pattern we had earlier highlighted as well, FPIs and mutual funds both had increased the stake in the company. Mutual funds had taken their stake to almost 30% from the 15% that these mutual funds held in March quarter. As far as FPIs are concerned, they had increased stake to almost 18% from 14%. Brokerages have been highlighting about RBL Bank, and today also Citi and CLSA have come out with their notes, but mainly mentioning about the reports of Emirates NBD looking to acquire the stake. Citi maintains buy call and target is of ₹300 per share. It says ownership transition may mitigate near-term ROE dilution risk, and if 51% stake is acquired, there might be a cash infusion in the range of 18,000 to 19,000 crore. Also, it would lead to a 5 to 10% book value accretion near CMP. CLSA maintains hold call and target is of ₹260 per share. It says ROA could expand by 25 bips to 1.2% with this deal if the deal happens. But interestingly, despite a big move that we have seen in share price in the last 4 months, 90% of total trading session, the stock has been in the F&O band.
Thank you very much for that. Just awaiting the pre-open. Before that, a quick check on Asia, because Asia is rebounding. You've got more than a 1% gain on the Hang Seng, on the Nikkei, the Taiwanese markets too. All these indices are up close to about 1.3%. The only one which is trading flat is China, and that's because of the increased tension between US and China. US president criticizing China for not buying soya beans, calling it an economically hostile act. So that's weighing on China. But just awaiting the pre-open for the last 2 days. The Nifty has been closing in the red, the Nifty and the Sensex. Yesterday, we ended just shy of the 25,200 mark. GIFT Nifty suggesting an uptick. The bell has gone and the Nifty opens at 25,175. It's a modestly positive open. Just up close to about 0.1% now up. The Nifty climbing to levels of 25,200. The Sensex up nearly 100 points. So mildly higher now for the benchmark indices. Sectorally, if you just look at the early winners, I think it's consumer durables on the way down. On the way up, it continues to be capital markets. IT has a positive uptake. Mid-cap, small caps also moving in step. And the heat map for now is suggesting of more stocks in the green as we begin trade with. I think it's IT. Let's pull up, Tech Mahindra. Let's pull up an HCL Tech to see if there is any green on the screen. The Nifty IT index has definitely opened up, but HCL Tech continues, is up nearly 0.5%. Yesterday, it gave up all its gains. Well, Tech Mahindra is down close to about 1.5%. So HCL is up. The Tech Mahindra is down and it's selling off 2%.
The stock of the morning from the broader markets is Thyrocare. The stock is up close to around 10% as we speak. Volumes are massive as well. So big move is what we're seeing out there. Tata Communications, I recall post TCS's numbers, there was a read-through that there will be a positive sentiment for Tata Communications. The stock popped up. Then it pulled back in the last couple of trading sessions. Today, it's back to its winning ways.
By the way, just to interrupt, Tata Com's numbers are today. So keep that on the watch list for numbers too.
We keep it on the watch list. Tata Communications as well. The other one we're looking at is Persistent Systems. As Rima said, 4.4% growth, much better than any of their peer groups. So good going out there. Sattvic Green as well. That's come on the list. That's higher. There are some positive news flow coming in on that name. So that stock as well opens up in the green. And LG, no, it's not seeing profit taking. It's up and about even in today's trading session. So it's up close to around 2%. So after a blockbuster listing, there is some more to go on the upside. Genesis International, I don't know what's gone on there, but that stock is up close to around 13%. Close to 2 lakh shares getting traded just in the first minute itself. So I'm not sure whether or not there is some fundamental news out there. But big move is what we're seeing on that one. Quick Heal is another stock that's up 6.5%. So big move on that stock as well. And AGI Infra, I recall the stock has been seesawing. One day it was up, the other day it was down. Yesterday it was down more than 5%. Today it's up another 5% as we speak. So plenty of movers actually from the broader markets. Keystone Realtors, because of that OFS, the stock has opened up with a cut of around 4.5% or thereabouts. So not a bad start to trade, Rima. 90 points up on the Nifty. We're getting into that congestion zone at around the 25,250, 25,300 odd. Let's see whether or not the bulls have enough in it. And the Nifty Bank, important out there because last 3 trading sessions, it's moved to 56,750, 56,800 and seen a U-turn from there. For the time being, in fact, that one as well is, is moving to that level.
So just trying to make sense of Tech Mahindra's decline early in the morning. Q2 numbers were a beat. But what the company also said is that as a part of the 3-year turnaround plan, by FY27, revenue growth will be ahead of the industry. What they said as they complete midpoint of that turnaround plan is like FY27 will be better than FY26, but not as strong as was earlier anticipated or envisaged on account of the macro slowdown. So basically telling you that it's not that growth is coming back very sharply. And even an analyst are pointing out this 15% EBIT margin target is going to be a little optimistic. So Q2 is fine, but I think the fact that the company is sort of toning down their FY27 growth expectations because they hadn't given a number. All they said is we'll beat the industry. They're sort of toning it down in the conference yesterday. Maybe that's playing on the stock price today. So that's down close to about 0.5%.
Okay, all right. Well, let's get straight to our market chat then. We have a guest with us in the studio. Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional, joins us in the studio. Hi, Sanjeev. Good to have you in person in the studio. What brings you to Mumbai?
Just work. I'm employed half in India also.
All right.
Half in Singapore, half in India.
How are you feeling about the markets though, Sanjeev? You know, off late you've been putting out those cautionary notes. You've been telling us on a time-to-time basis there's a bubble in various sectors as well. I believe that you're working with modest returns, in the next 12 to 18 months. Define modest. What would it be? High single digit?
Yeah, 5 to 10%, I would think. In the last 1 month or so, I think become slightly more positive, I would say. Neutral to positive compared to fairly negative stance which we had a year back.
Yeah.
And the reasons for that is pretty simple. At least now we are starting to look like earnings seem to be stabilizing after a period of very heavy downgrades in the last 12-15 months. And second is 27 looks like a decent year for earnings growth.
Okay.
In fact, we're now looking at about 17% growth for Nifty 50 profits.
17?
17, yeah. Okay. Compared to about slightly below 10 for the current year. See, the whole problem last year has been you had high valuations and a series of earning downgrades. If I remember correctly, same time last year, we're looking at about 1250 rupees EPS for the Nifty 50. That has come down to about 1090 now. So that's been the big problem. This time around looks like earnings are stabilizing and 27 could be a good year for earnings.
So you think we're towards the end of that earnings downgrade cycle, and for this year we should work with 8-9% and mid-teens for 27?
Looks like, yeah. So I think we are definitely coming to the end of the earnings downgrade cycle. See, last year earning downgrades were led by, or I should say rather the current year, in the last FY 2026, in the last 12 months, you had earning downgrades coming from autos, banks and IT sector. This time around, auto should do a lot better simply because of the GST rate cut. And hopefully, we don't know when the 8-pay commission gets implemented, but if it gets implemented towards the end of FY 2027, you could see some bump towards the end of FY 2027 also. Banks should see a decent turnaround from a decline in profits in the current year to decent growth next year. Simply because all the negative factors of weak loan growth, decline in NIMs, and also higher credit costs should all, reduce going forward. And IT, it's been a very challenging year, the current year. Hopefully things look better next year.
Sanjeev, hi, morning, Reema here. You've always been concerned about the valuations in the Indian market. You've been calling it out. Since we've gone through about a 12-15 month period of time-wise correction, how are the valuations now, and which are the pockets where you still think valuations are excessive? Where are the valuations moderate? And where, if you do see value in any pocket of the market, where would that be?
The valuation challenge still remains. The problem has been that valuations have stayed high through this period simply because you're earning downgrades.
Correct.
It's not as if, we have seen multiples coming down. What has happened is prices have come down, but on the back of earnings coming down. So more or less valuations have stayed high. And that challenge remains. Having said that, at least, one part of the negative, if I may say so, of earning downgrade, that seems to be out of the equation for now. So now coming to valuations across sectors, see, most of the consumption names are still very expensive. Especially if you look at consumer staples, parts of discretionary, it's very hard to argue for, 45 to 60 P.
Right.
When most companies delivering, mid-single digit kind of earnings growth. Even that has been a struggle for many companies in the last 2 years. What resulted in a massive rating in the multiples of the stocks in the last decade was simply very strong secular growth for an extended period of time. If you look at, I'll give you a few numbers. Asian Paints last decade, earnings CAGR was 12%, Lever was 13%. None of this company delivering in numbers anywhere close to that. And because of that, multiples went from, let's say, about 25 P roughly, the beginning of last decade, to about 50 P by the end of last decade. The problem is multiple have stayed high, but earning numbers have simply collapsed. And my worry is that going forward for many of the consumer names, simply given the fragmentation in the market, the volume growth gets split across more number of players, and also profitability could come under pressure. So it just becomes very hard to argue for high multiples in the construct which we're looking at of lower growth and maybe some pressure on profitability.
So consumer staples, discretionary, still expensive.
Yes, still expensive. IT also, I still think on the higher side.
Okay.
It all depends on what growth they can deliver. And also keep in mind the fact that in the medium term, you have AI-related issues also coming up. Good, bad, ugly, only time will tell, but it is a big uncertain for the time being. Yeah.
You know, so we got to ask you a little about the sectors of the future right now, because you're talking about names like Asian Paints, etc., all the FMCG staples. The last decade or so, the growth had been led by penetration, more awareness, and probably more money in the hands of people. So that sort of, headroom has been more or less satisfied. Now, there are a lot of these sunrise sectors as well, where the visibility of growth, say 10 to 12% sort of earnings over the next 5 to 6 years, irrespective of the valuations, is still there. What sectors, according to you, would those be, and are there any opportunities here?
No, anything to do with manufacturing is in a very decent spot. In the next 10, 15 years, assuming India plays its cards well, you will see a big domestic import substitution story playing out. And government is rightly focused on that. There's a lot of incentives being available through PLI scheme, a lot of focus over there. So I think the manufacturing sector will grow dramatically in the next decade or so. Of course, you have to contend with the fact that Dixon is now at 70 PE plus. But the opportunity set is humongous for many of these companies. Anything to do with electronic manufacturing services, anything to do with electricity chain, there will be massive electrification of the economy. So all the capital companies, the companies who make transformers, rectifiers, again will see massive growth. Storage solutions, batteries, etc., again will see huge amount of growth. So not as if there is dearth of opportunities. New sectors will emerge. So you see, some of the challenge for India is that some of the new themes which are emerging globally, and I would put AI, biotech, and robotics, India does not have any great companies over there.
But we do have our own, unique solutions for the Indian market, the consumer market, which is via names like Urban Company, Eternal, Quick Commerce, which hasn't done well globally, but is very India-specific out here. So do you think there are opportunities here?
I mean, yeah, these companies are doing amazingly well. You have a very large unorganized sector, when it comes to retailing in India. So that's a huge opportunity. Healthcare services, another massive opportunity, I would say. Simply given the fact that as India becomes richer, the penetration of healthcare services will increase dramatically, and the quality of healthcare service in general is still very, very, I would say, poor for most of the Indian population.
I think healthcare, diagnostics, those are sectors you like as well as pharma,
very
right?
positive, yeah.
All right. Let me talk about the IPO market.
Yeah.
That got a little bit too hot, too bubbly for some, but not for the ones that got that LG Electronics. Those that got allocated, they would be happy. 50% pop-up always feels good ahead of Diwali, whatever, whichever way you want to slice or dice it. What is your view on an IPO like LG and also the IPO market? The problem is there is more supply coming. But the good news is that at least you're aware now that there is the supply coming out there, and maybe a couple of large ones like Tata Capital, LG, at least they got digested.
See, the interesting thing is, and I will give you some numbers over here, if you look at FPIs as an example, they have sold about $23 billion in the secondary market.
But they've got $5 billion in the
$5 billion in the
primary.
So it tells you a story that maybe the IPOs which are coming, A, the stories are good, and B, they're coming at the right price, at least some of them. You gave the example of LG Electronics. If I remember correctly, it's about 35 times one year forward. If you look at Havells as an example, many of these companies are trading at 50, 55 kind of P. So if you come at a decent price, attractive valuations, there should be interest logically, right? Because you have benchmarks in the market which are very well established. If you come at a 30%, 40% discount, why wouldn't people want to participate in that? And you have seen a very decent pop over there. The problem is most of the other IPOs, in many cases, are coming at very high valuations. Maybe the public market valuation is high, and then for whatever reasons, companies try and extract the maximum out there. And that's when the problem happens. If you look at many of the smaller IPOs, mid-sized, smaller IPOs, they have done rather badly in the last, I would say, 3-4 months.
You speak about that, the IPO that is opening today, Midwest, it is a mining quartz-related granite company. We're looking at some numbers out there. For a 450 crore issue size, they're charging 20 times EV to EBITDA 1 year forward for a mining granite company. So it'll be very interesting to see how demand and growth comes out there.
But even Tata Capital, right? I know it wasn't cheap to begin with, but they still priced it lower than the rights issue, which was done recently in terms of the large issues. Sitting in Singapore, we were talking about the FIs selling in India. What is your feedback? I mean, is this disenchantment towards India changing now that earnings growth is picking up? I mean, when you speak to all these fund managers, what is your feedback and what does it tell you?
So I would say last 12 months they have been neutral to negative. This is across Asia, Europe, UK, US. I mean, pretty universal, I would say. 1 in 10 you would have found person who was positive. And the reason is very simple. Markets were looking expensive, and people were concerned, rightly so, as it turned out, on earnings downward cycle. I think people have become slightly moving towards the neutral zone, but I don't think people are super gung-ho in India as yet, I would say. The valuation problem still remains. Valuation is still high. I see at this point in time, enough opportunities elsewhere, right? We have seen other markets performing amazingly well.
Right.
And despite that, multiples are still far lower, let's say, in China, South Korea, etc., compared to where India is. If you look at some of the numbers over here, if I remember correctly, last 1 year, India MSCI index is down 7% dollar terms. MSCI EM index is up about 17.
Yeah,
MSCI
25% underperformance.
Yeah, global developed market index is up about 14-15%.
Yeah.
So naturally, people are inclined to obviously look at market which have done well more favorably.
Yeah.
Valuations were cheap, and they still remain quite okay. So that's number one. Number two is the fact that you have a lot of companies, especially in Asia, which play on all the right themes or the emerging themes, which is AI, biotech, robotics, as I mentioned earlier. I mean, obviously, you have leading companies in China, South Korea, etc., Taiwan. A lot of excitement over there. And India, unfortunately, does not have any play as yet over there. So those are the two issues, I would think, which have been holding back.
The second one doesn't change, right?
Unfortunately, yes. So the first one has to change, in my view, which means multiples have to, come off. So hopefully we go through some more time correction, a little bit of price correction, and hopefully...
And growth picks up, so that should...
How will the multiples come off? Because, the kind of strong domestic liquidity that there is, every sort of FII selling that you've been pointing out, has been easily absorbed. So it's most likely to be time correction.
Looks like. See,
are there any immediate triggers for a big spurt in growth or EPS apart from the GST thing that happened, and how much could that, according to you, add to the EPS?
See, but that's already discounted, by the way. The fact that most analysts have already assumed increase in EPS. If you look at for the auto sector, for example, we are looking at almost 20% growth in earnings in the FY 2027 compared to, I think, 4 or 5% in the current year. I'm talking about Nifty 50 companies. Yeah, so that's already built in and discounting in the 1 year forward multiples. So you're right in the sense, the multiples will probably stay where they are, simply because you have a lot of domestic support out there. And you look at the numbers again, DIIs have bought about $68 billion calendar year to date. Foreigners have sold about 23, which means another $45 billion has been sold by somebody else. And who is that somebody else? Basically, it's the PE guys and the promoters. So between $23 billion of FPIs, 45 of PE promoters, against that you have 68 being bought by retail. So, I mean, I don't know the reasons for their optimism, but I would assume that they have made a decent amount of money in the last 3-5 years. Experience has been very good. And despite the non-performance in the last 1 year, people are still looking at the last 3 year performance and taking a call that, okay, fine, you can still make money in the market from here on.
Okay, all right, Sanjeev, we're just going to address some news flashes on the screen. They're going to come back to you. You said you like select private sector banks, so we'll just address that in a bit. Ritu's joining in. She's addressing that big story that's flashing for you on the screen with regard to RBL Bank. Ritu, what are you picking up? And important, you're stating that the pricing could not be a significant premium that some media houses were reporting. So tell us, how do you see this panning out?
Hi, morning, Nigel. We're readying for Diwali, but an even bigger firecracker could be set off in the banking sector. After Yes Bank SMBC, now we understand Dubai's Emirates NBD Bank is finalizing a landmark deal to acquire majority control of RBL Bank, which will mark one of the largest foreign forays into India's private banking space. And the deal could be announced very soon, in fact, in the next few days itself. Remember, the bank is going to report its earnings this Saturday. So we could hear about this as early as that itself. itself. Now, there has been this has been widely reported that the two have been in talks and that Emirates was eyeing a minority stake in RBL. But our sources indicate NBD, the second largest lender in the UAE, is going to announce a deal to acquire as much as 60% stake in RBL Bank, which will include the open offer component that, of course, gets triggered when the acquirer buys more than 25% stake in a company. Now, we further understand NBD plans to acquire this controlling stake through a fresh equity issuance by RBL Bank, which will be done through its wholly owned subsidiary. Now, this is important because the entire investment is going to be then directly infused into the bank, and also because RBL Bank's current foreign shareholding, if you look at it, it stands at more than 22%. So the fresh equity issuance to NBD is going to expand the overall capital base of RBL Bank to ensure that their stake remains within the regulatory FDI cap of 74%. Now, our sources also indicate the transaction is expected to be priced, like you were saying, in line with, of course, SEBI's prescribed formula without a major premium to RBL's current market price. Now, the transaction cannot, of course, happen without RBI's blessing, and we understand this change of control has received an informal nod from the regulator. Formal submissions, of course, will be made once the boards approve this deal. Now, while RBI is not going to relax that 26% voting rights cap, our sources do suggest the regulator will offer a glide path to Emirates NBD, allowing it to gradually bring down its shareholding in RBL Bank. Now, for Emirates, of course, which operates in India through its 3 branches, the acquisition will significantly deepen its footprint in one of the top banking markets. And for RBL, of course, a globally recognized institution, massive capital infusion, and long-term ownership clarity.
All right, Riju, thanks a lot for that. So we'll most definitely keep an eye out on this firecracker ahead of Diwali. Yesterday, we had a comment coming in from RBL Bank as well. They kept it fairly open, saying that they're constantly seeking various opportunities that enhance shareholder value, and this could perhaps be one of them. The stock continues to be in F&O ban for over the last, I think, 2.5 weeks or so. Sanjeev, on the banking space, do you think something like this is a special situations opportunity for people to consider, given the sort of price move that has already taken place, and now that we understand that it may not be at a significant premium to what the current price is?
I can't specifically comment on RBL Bank because we don't cover the stock, so I don't have much of a handle on the valuations.
The banking space, as per you?
The banking space has been one of our favorite sectors for a while now.
For everyone, yeah.
Exactly.
I think from the PSUs you like banks, but otherwise the defense and railway names?
Yeah. Defense maybe still okay. Railways is like, what kind of...
But defense is okay now, I'm enthused. Tell us, do you think that price correction, time correction?
At least defense, there is a theme.
Yeah.
India requires defense, and there will be a lot of spending being done by the government in terms of procurement of arms equipment for a long period of time.
Right.
But railways, if you look at the numbers over here, the government spending itself has plateaued now.
Yeah.
It was 2.4 trillion rupees in FY 2024, 2.5 in 2025, 2.5 in 2026. And the kind of multiples many of the railway companies are trading at for maybe not much increase in the government spending and revenues in turn, how do you justify the multiples? That's the whole issue over here.
So other than railways, which is the theme, the narrative, which makes absolutely no sense to you?
Oh my God, you're putting me into trouble now. Some of the electrification themes.
Okay. Why?
Companies, for example, something like a BHEL.
Okay.
80,000 crores market cap. Very, very hard to justify in the context of the potential opportunity out there. You can do a simple math over there, right? Let's see if we can get this math right. India is supposed to add about 80 gigawatts of coal-based thermal capacity next, 5-7 years. And after that, anyway, I think we will move to renewables. I don't think we're going to be adding, coal-based thermal capacity in perpetuity. You take roughly 60 billion rupees per gigawatt, yeah. So 80 into 60, you become about 4.8 trillion rupees for like 80,000 crores. You take a PAT margin of, let's say, even 10%, which is very, very high, by the way. Normally you get a EBITDA margin of 10%. Even then you will come to 48,000 crores of total PAT opportunity. For assuming 100% of the opportunity goes to BHEL, by the way. Now remember, this PAT will come over the next 10 years. It will take, all this 80 gigawatt will take 10 years to get built. So if we discount that 48,000 crores of potential PAT opportunity, that will shrink to maybe half of that, right?
Yes.
So how do you justify 80,000 crores market cap? There's no terminal value in that business.
Good
How do you remember these? Yeah, how do you... And BHEL, any others? Sorry, before we run out of time?
Some of these PSUs like ITI, etc. I don't even know what business they are doing currently, but look at the market cap of these companies. Impossible to justify. The Maintenance company, I don't remember the numbers now.
The more mainstream companies like ITI not.
Nah, then it is okay, you know.
Or you're not saying it because you don't want to get into trouble.
I'm already in enough trouble with that.
Just one final question before we let you go. And this is not to do with the equity markets. The other FOMO that is taking place right now is in gold, gold and silver. Where do you stand on that?
We have written a note on this actually. So we have this funny situation in the world. Let me just dive a little bit. You have all safe haven assets going up. Gold has been going up like crazy, right? At the same time, you have all risky assets also going up, including crypto. And I don't know whether they want to put AI stocks at these levels into that bucket, but that's what is going on in the world. So it just tells me there's complete FOMO in the world. So whatever is going up, irrespective of any logic, people are running after that. Now, gold, if you look at the explanations, and we have a lot of data in that report, lots of explanations have been given, including buying by central banks, etc. But that's not the case. If you look at the numbers for the current year, central banks have bought about, if I remember correctly, about 170, 180 tons, versus about 350 tons, which they normally buy in any year. And this is for the first 8 months, by the way. Yeah? So in fact, they're running at the run rate below the historical run rate in terms of buying. And if you look at the data, the jewelry numbers are about 2,000 tons. So that is not no change over there. If you look at the investment part, that has gone to about 1,000 tons for the first 6 months compared to about 1,000, 1,100 in all the previous years. So that gives you the answer. Entirely driven by investment flows as far as,
I think the gold ETF holding as well is lower today in comparison to what it was 3 years ago. If I remember correctly, it's around 3,800 tons, 3,850 tons, the gold ETF global. And it was around 4,000 tons when gold was around $2,100.
Last year was small negative. This year is about 350 tons. I'm just trying to remember all the numbers. It's there in the
overall holding.
Yeah. So it's a big change in the investment activity as far as gold is concerned.
Great chatting with you. Thank you very much for coming down. Look forward to more such conversations with you.
Yeah, we can put you in a lot more trouble when you're here as against when you're on.
But actually today, Sanjeev is sounding a little bit more optimistic. Yes. Modest returns is what we could brace for. At least high single-digit earnings growth for this year and mid-teens. Sanjeev, I think you're in fine form today.
Thank you so much. Much appreciated.
Thanks a lot for joining in.
Pleasure.
I'll tell you what, we'll slip into a short break. Come back. Amit Murarka of Axis Capital will be joining, and he'll tell us all the expectations from the metal pack. Don't go anywhere.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by National Stock Exchange, Soch Kar, Samajh Kar, Invest Kar. Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, best hai sabko pata hai.
Welcome back. The market's doing well. A couple of these life insurance stocks. We have HDFC Life, which has moved higher. Alongside that, Tata Steel too has moved higher. We also have some traction in Nestle ahead of their quarterly numbers tomorrow, so we'll watch out for that. And obviously, the gainers continue to add more weight right now. ICICI Lombard, for instance, up 6%. Persistent Systems opened higher, continues to hold higher. In fact, currently at the high point of trade with a gain of almost 7%. But we did speak about Tata Steel moving higher. So on to our special Quarter Se Quarter Tak segment. Let's put the spotlight on the metals sector itself. Nigel's walked across to the wall to tell us what to expect from this space in the second quarter. Nigel.
Well, as we head into another result season, here's a look at what to expect from base as well as ferrous metal players in India. The base metal companies are expected to report, a quarter-on-quarter rise in domestic EBITDA. That'll be driven by operating leverage and a modest uptick in aluminium prices. In contrast, however, The ferrous metal players like JSW Steel, Tata Steel, they're likely to see EBITDA contraction this quarter. Due to weaker domestic pricing, sales volumes are largely strong, though, across the board, be it for JSW Steel, Jindal Stainless, Tata Steel India. However, Hindalco as well as Novelis volumes, well, they are expected to remain more or less flattish. They have been impacted by that fire incident. Well, steel margins as well, they have come under pressure this quarter as India HRC prices declined by close to around 4% on a quarter-on-quarter basis in the second quarter. That is despite the 5% rise that we have seen in China's export HRC pricing. Well, this has widened India's discount to landed Chinese imports to nearly around 8 to around 10%. So now the street is optimistic that we can see some price hikes here in India. That we'll discuss a little bit later. But though while steel prices have dipped, well, the fall in margins is expected to be partially cushioned because coking coal costs, they have been well behaved. There'll be some element of operating leverage as well that will play out, particularly for the larger players. That said, the EBITDA per ton is likely to contract sequentially for key names like Tata Steel, the standalone business, JSW Steel. Novelis as well will face headwinds, and so its EBITDA per ton will decline to around $430 per ton, as it will be impacted by doubling of the US tariffs, the fire incident as their Oswego plant. That will hurt the supplies as well. And there have been various supply disruptions to the key client, case in point being JLR as well. On the other hand, Hindalco's India business should benefit because aluminium prices have moved up. The EBITDA per ton could scale around $1,650 per ton. Valuations for the sector, well, they appear more or less reasonable. Hindalco as well as Tata Steel offering a balanced mix of growth as well as margin stability. But as we look beyond quarter two, here are the three key aspects you should be keeping your eye out on. Steel realization and cost guidance going to be important out there, especially post the recent volatility we've seen in pricing. The volume growth for the remainder of this year with multiple companies ramping up capacity. And what's the status with regard to the expansion projects as well, particularly in the downstream as well as the value-added segment. As always, we'll be watching for the earnings, the announcements, and the management commentary as well. Well, let's welcome on the show Amit Murarka, the research analyst at Axis Capital, who joins us. Hi, Amit. Good morning. Thanks a lot for joining in. Always a pleasure talking to you, Amit. Tell us, what are the expectations first in terms of the ferrous pack? And do you think there's a good case, given that domestic pricing is at a discount in comparison to imported steel, that we see some kind of price increase?
Yeah, hi. Good morning, Nigel. Good to see you again. So, you're right. The domestic pricing has been quite weak in the last 4 to 5 months, particularly because of multiple factors. One was obviously monsoon. So what we are anticipating is that given there's a push and the pull hitting steel prices, with China kind of seeing a moderation in export pricing, we would think that Indian prices should overcome that and start improving in the coming months, largely because of support from the Indian safeguard duties of 11-12%. So currently, it's a 3 to 4% discount to import parity. Usually, it's a 5% kind of a premium. So that itself calls for a substantial 7-8% improvement, which is what we are building into our numbers in the second half of the fiscal year. So while 2Q will be weaker, particularly for rebar players like JSPL, we are expecting 3Q and 4Q to be much better from a pricing and margin perspective for the sector.
Okay, got it. All right. So expecting the next couple of quarters. And I missed that number. What is the price increase you're working with?
We are working with about a 7 to 8% increase for the second half.
Okay, got it. All right. What about the spreads? Do you think the spreads as well start improving from here on? Because coking coal costs more or less well behave, operating leverage will kick in, as well as prices will improve. So if you could give us a comparative number for the past quarter, how were the spreads and how do you see it improving?
Yeah, so pricing and spreads go together. So pricing has come off close to 4,000 on an average for rebar and HRC combined, and spreads to that extent have also gone down by a similar number. Raw material has generally been kind of flattish in the last few months. So essentially, we are not expecting much of a rise in raw material. Like you all know, there's a big supply of iron ore coming in from Simandou starting now, and will keep ramping up over the next 1 to 2 years. So iron ore is expected to kind of stay a bit subdued, and coking coal though kind of tends to move up during November, December due to the Australian tightening season. But beyond that, we would expect raw material prices to not kind of move up much, and the price improvement essentially translating into spreads improvement. So that would be close to 4,000 per ton kind of improvement by Q4.
Okay, all right. Amit, what about Tata Steel? You know, because on a sequential basis, because you have that seasonality factor, most of the ferrous names will report some kind of, a dip in terms of profitability. But for Tata Steel, they have the European operations out there, and that will turn around to a large extent. Do you think there will be better times ahead for Tata Steel Europe in particular, both Netherlands as well as UK? And in that case, would you start getting optimistic on Tata Steel, or do you prefer the other couple of stocks in the ferrous pack?
Yeah, so I think more importantly, the European Union and the European Commission has proposed a new steel and metal action plan, under which they're looking to essentially get into protectionist mode. They have proposed a quota cut of almost 40% for HRC and 47% overall, as well as a doubling of tariffs from 25 to 50% post the quota limits. So essentially aligning with the US quota, US tariffs. I think that, if approved, it has to still go to the European Parliament. But if approved, that could actually lead to material upsides for European steel prices, and that essentially should benefit Tata Steel. So we had worked around the sensitivity kind of that if there is a $50 improvement in the European steel price because of this, Tata Steel could see like a 10% improvement in PAT, and that could kind of mean like a 5 to 10% increase in the S&P valuation as well.
Okay, all right. But in steel, your preference is JSW Steel as well as JSPL. Is that correct?
Yeah. So while the prospects of Europe seem to be improving, we are a bit worried for Tata from the Indian business perspective, largely for two longer-term factors, not necessarily next 12 months, but one would be the iron ore lease expiries in 2030. Like majority of their, in fact, the entire standalone iron ore reserve is going for auctions. And as you know, the auction prices tend to be higher. So longer term, therefore, there could be impact on profitability. And additionally, like they don't yet have a expansion pipeline in place. So the growth will drop after FY26. Whereas JSPL as well as particularly JSW Steel offer a consistent growth profile for the next 3 years.
All right, Amit, thank you so much for stopping by and giving us a preview into what one can expect from the metal space in the next quarter and more importantly in the very near term as well. Let's talk about the quarter that went by, and that was a very good one for ICICI Lombard. A decent set of numbers coming in, the stock doing extremely well. We now have with us Gopal Balachandran, who is the Chief Financial Officer at ICICI Lombard General Insurance Company. Thanks a lot, Gopal, for joining in. The street likes what you've reported, but the street wants a little more. You know, on your gross written premium, which has grown about 1.6% in the second quarter, net earned premium, which has grown about 12.5% in the second quarter. What are your expectations for these over the second half? And even the combined ratio, if you could give us a sense on what the expectations here are or your target here is.
Yes, Mangalam, good morning to you. And let me start on a positive note. Let me extend a season's greetings to you, entire team.
You and your team too.
CNBC and all your viewers. But coming back, I think let me take the second part first in terms of the combined ratio point that you asked. And let me put this in context. I think if you look at the combined ratio that we reported for quarter two, again, I'm just looking at it on a like-to-like basis for ease of reference. The quarter two of this year, the combined ratio was about 103.9% on an N basis. This number in quarter two of last year was about 104.5. So directionally, I think what we have been able to exhibit is an improvement in combined at a company level. And therefore, the trajectory that one expects is also to continue to see improvement in combined playing out for ICICI Lombard. But obviously, we will see how the industry kind of responds in terms of combined, and our combined will kind of, in that sense, mirror relative to that. To your first point on how do we see growth getting exhibited, I think the momentum on ground looks very, very positive. The point that you made in terms of, let's say, a relatively kind of a muted growth that one had seen for the first half of this year. But if you were to kind of break it down in the context of the quarter two, and within that specifically, the momentum that ICICI Lombard is riding on in the month of September, across lines, whether it's commercial, motor, retail health, each of these are preferred segments for us. The momentum on ground looks to be very, very positively placed. And therefore, to that extent, quite excited with how does one see the road ahead, particularly for the second half of the next year.
Could you put a number to that?
Honestly, I think what we have called out is, I think, relative to the market, I think what we would be kind of looking for is to try and see if we can get an alpha or a growth higher in the range of 100 to 200 basis points. I think that's what we would kind of largely be kind of working towards. But more importantly, obviously kind of staying focused on delivering profitable growth and sustainable return on equity.
All right. Good morning, sir, and festive greetings to you as well as to the team. Nigel on this side. Could you tell us what is the industry growth that you're working with, since you're working with that 100 to around 200 basis points higher growth? And if you could particularly tell us in motor as well as health, what kind of growth estimates for the second half?
Yeah, so Nigel, again, good morning to you. I think, so again, when you look at the industry numbers for the first half of the year, I think it has been a single-digit number, roughly about 7% growth is what the market has exhibited. And even the momentum that I spoke about in terms of whether it's motor, whether it's retail health, I think in general, I think the momentum on ground is playing positive even from a market perspective. And therefore, there is clear expectations that the market also should start exhibiting a growth number much higher than, let's say, possibly the 7% number that it had exhibited in the first half of the year. And which is where I kind of talked about. In that context is where we would look at it from an ICICI Lombard standpoint. I think what we will try for and what we're kind of clearly working towards, you should try and get that alpha of about 100 to 200 basis points over the industry growth numbers.
You said the industry will grow faster than the 7% mark in the second half. How much faster can that grow? You think it could be about 8 to 9%? And
honestly, I think we will leave it for the market to kind of come out with the
all right. So irrespective, you will grow between 9 to 12%, because if the industry grows at 7%, 100, 200 basis points would be 9% for you. If it grows at 9%, you will grow at around 100, 200 basis points higher than that. So 9 to 12% would be a reasonable estimate, right?
So what we are optimistic about is what I kind of talked about. I think across lines, I think the momentum on ground is looking very, very positive. Final outcomes of what does the exact numbers, I think honestly, we will come back and speak in the channel.
Okay, all right. Let's talk about the other big aspect that the street is looking at. Are you still hopeful of receiving of the motor third-party premium revision for this year? Or according to you, maybe it comes only the next year? What's the expectation on that front? And where are discussions? Because that was the big hope, right?
Yeah, so again, in context, I think third party has been one segment where relatively for the last 3-4 years, there has not been in that sense a price revision. But however, when one has seen from an industry standpoint, the average claim awards that is getting affected in the form of claims, that has definitely seen an increase, which is why from an industry standpoint, I think what we have been collectively kind of seeking is a price revision in the context of third party. We will wait for how it gets played out, whether it gets announced in the second half of the year or whether it gets kind of announced for FY 26-27. I think we'll wait for. I think, but clearly from an industry standpoint, when we looked at in terms of how things have played out relative to the last 3-4 years of no meaningful price change, there is a very strong reason that as an industry that we want to exhibit in terms of a revision in third party. But when it happens, I think honestly we will wait for the exact time.
Got it. So you think that the time is right, but it could be either the second half of this year or sometime next year as well. Let's talk about the other big imponderable, the GST. There was a fair amount of uncertainty out there with regards to the additional cost that could be on account of the inverted duty benefits, no ITC coming in for you. And have you decided to transfer the cost to distributors or not? We wanted to know a little about that as well. And, just try to give us a sense on what the impact could be on an overall basis, because lower rates could mean higher number of people opting for, insurance as well. So how is that cost benefit analysis for you?
Exactly, Mangalam, exactly to what you kind of said. I think what these reforms have done is kind of spurred demand on ground. Whether you look at across health or whether you look at, for the matter of fact, auto vehicle sales that has got exhibited in terms of the recent numbers that got reflected. So which is what we are very, very excited with. I think there is a lot of positive momentum which could translate into increased volumes of sales across most of the key retail lines, which kind of clearly augurs well when you look at it in the context of the distributors' incentives or distributions commissions. And from an ICICI Lombard standpoint, I think clearly we would make sure that whatever reforms have kind of got exhibited, that gets completely passed on insofar as the customers are concerned. And insofar as the impact consequent to any of the input tax credit, etc., I think that's a part of the business. And therefore, to that extent, whatever numbers that we reflect in terms of our expenses of management, they will be all a part of that. And to that extent, if there is some element of distribution cost that has to be kind of also passed back to some of the distributors, I think that is something that we have already kind of exhibited. But just to kind of say that, I think what we are more excited with is the positive momentum that is kind of getting created and which will kind of spur a lot more volume increase. And therefore, to that extent, the eventual revenues that will be seen in the hands of the distributors will equally be very, very positive.
So basically, if you could just simplify this for everyone who's watching, how much would the increase in cost be? And so far in the new GST regime, how much has the increased volumes been on account of the GST reduction? You've said there has been momentum. So over and above steady state, how much more have you received, which you can attribute to a lower GST?
So let's take the auto vehicle sales, right? Okay. From a Navratri to Navratri standpoint, whether you take private car or whether you take two-wheelers, I think what we have seen in the market is an increased volume to the tune of almost about 35% plus. So this is a significant kind of a jump, which is what one was kind of talking about. And therefore, to that extent, this kind of augurs well in terms of a higher incentives when you look at it even from a distributor standpoint. On the point on the input tax credit, that is more relevant in the context of health, which is what one had said. I think in the overall scheme of things, I think this amount is something that one will be able to kind of manage within the overall cost structures that we have, including some impacts if we have to take. To that extent, we will be taking that impact, and to the extent which is required to be passed back also to the distributors. That is something that we have again already announced on a case-to-case basis with the respective distributors.
Okay, all right. Well, sir, we appreciate you joining in. Thanks a lot for giving us that outlook as well. For the time being, the street seems to have liked what you said. And, I've had a favorable experience as well with the company in the last 1 year or so. So thanks a lot. And shareholders as well like what they see, Mangala.
Right, shareholders like what they see. But what they're also seeing along with the stock price here is that number 66. That's the stock score which has come in, as you can see on your screen. That's the money control stock score, which is just above the line graph, which is a score assigned to each stock based on money control's multi-factor algorithm. It's calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts and technical indicators for each stock. Each of the individual parameters considered for calculation of the four factors are assigned a score, which is then aggregated to arrive at an overall Q factor, G factor, V factor and T factor score. Remember, however, this is not a buy or a sell recommendation. Any investor, viewer is advised to carry out necessary diligence on their own through a certified, registered financial advisor for any investment decisions. That's just the money control stock score up for you above the line graph. All right, with that, it's time. It's 10 o'clock, so important to get in a technical view as well. Siddharth Rai Mangla joins in once again. We have a big move that we're seeing in a couple of these real estate names. So Prestige Estates for one comes up for you. Godrej Properties is the other one that comes up for you. All the others, in fact, the Realty Index comes up for you right now, currently seeing a big move. Siddharth, over the last 45 minutes of market open, have there been any fresh trades that have emerged for you?
Yeah, sure, Manglam. There have been definitely some good momentum building up. But if we talk about index, Manglam specifically, there has some change that has happened to the structure since yesterday, because we faced a strong resistance around 25,300 yesterday. There was a strong rejection faced in Nifty, so it has affected the structure in index, Manglam. Before that, just Nifty sustaining about 25,200 was a good enough signal to play for a move for a quick move towards 25,400, 25,450, those big marks. But after yesterday's expiry volatility, Manglam, we have seen a big change taking place. There has been a new layer of strong resistance that has added to the structure. In the past 3 days, Manglam, 2 times we have faced a strong resistance around 25,300. So, and right now, I would say the baton has shifted from 25,200 to 25,300 now to make a decision to take a long position in Nifty. A full-blown momentum play or a full-blown long position can only be taken in Nifty as well as in the broader markets only when Nifty goes and sustains above 25,300 now. So now I would say the level that we have to watch out for is 25,300 because definitely there is some good move in Nifty today, but a full-blown move can only be seen above 25,300.
Okay, 25,300, and we have visited that level in the last few trading sessions. Got that. But Siddharth, what about individual stocks? You must be having some trading calls.
Yeah, definitely, Nigel. Hi. See, there are two stocks and both are showing some very good momentum. So we have to buy the both of these stocks. The first one being Aditya Birla Capital. See, over the past few months, consistently the stock has shown good momentum, and specifically it has ignored all the market volatility and dips even in the past few days. So right now the stock has managed to come back above 300. It was a very important mark for this stock. So a fresh momentum can be seen building up. Aditya Birla Capital can be bought here. Right now, the price is trading around 303 somewhere. So the stop loss, we will keep the stop loss at 295, and our targets being the first target 320, second target being 325. The second stock is Paytm. Nigel. See, over the past 15 days, the stock has shown some really good momentum, but for the past 3-4 days, there was a consolidation, bit of a consolidation. Right now, the stock has managed to come out of that consolidation and with a good move. So a fresh momentum can be seen here as well. Paytm can also be bought right now. The spot is trading around 1272-ish. We'll keep the stop loss at 1255 and our targets being first target 1300 and the second target being 1315.
All right. Thank you very much for joining in. Time for a break. On the other side, we'll get you a candid rapid fire with Ramdeo Agrawal and Vaibhav Agrawal of Motilal Oswal Financial Services. Stay tuned.
Welcome back. We were talking about real estate stocks. Look at Lodha Developers. That's moved higher as well. And now we have Phoenix Mills, which is doing well too. Phoenix Mills in particular would benefit from all the retail activity that takes place in the second half of this year, more particularly in the third quarter. So we'll monitor the update coming in from the company for the third quarter. As of now, we do have the updates for the second quarter. But speaking about Diwali and the festive season, here's a snippet from our conversation with Ramdeo Agrawal of Motilal Oswal Financial and his son Vaibhav Agrawal of Motilal Oswal Asset Management. Listen in.
So I think his patience and ability to sort of sit through for the long term, and I think he's very gentle with people. He has a way of interacting with people which makes them very receptive to him, which I don't find in many people.
I admire his that coolness, that calm thinking, very composed, and of course he knows compounding. So that's a big asset.
Sorry, which one?
He knows compounding well. I don't know if I can remind him ever.
Book currently on the bedside. What are you reading? Anything you're reading now?
I'm reading this book on commitment. Actually, it's written by ex-army generals.
Okay.
And it talks about the importance of having absolute commitment in whatever you're doing.
Okay. Ramdeo, book, current book?
So I'm reading a book called The Brave New Wealthy World.
Okay.
Very exciting book, written in 2003 by Edmund.
Okay.
It's out of print kind of thing, but amazing book.
One stock you wish you bought?
I had a lot of fun with a lot of stocks. What I felt like I bought. See, one of the regret for me is that between 2006 and 2013, sorry, 2004 and 2013, 9 years, including the GFC boom, it had gone into our head that the corporate should not buy stocks in their, treasury. So 9 years I didn't buy stocks.
Wow.
Out of the cash flow. That has made us so poor, is not funny. My balance sheet would have been at least double.
Babu, you have that stock?
Actually, if I had held, like for example, I had bought Group Finance, but basically I didn't hold it on for long enough. So I wish I had sort of held on to that.
So this is an interesting one. If there was a biopic on Ramdeo ji, which is possible going into the future, who do you think is best fit to play him?
Hold your breath.
Yeah, I think Paresh Rawal would sort of fit that role. I think because
nice one.
Maybe because of his optics and also his ability to be both serious and hilarious at the same time.
Yeah.
I think he would represent him quite well.
A resolution for the new Samvat, anything?
Because of this book I'm reading, so I would like to take some of the ideas from there and maybe become more aggressive, a little more aggressive, or maybe some new business ideas will germinate. Definitely will give birth to some strategic change in my thinking about capital market and about the company.
About Motilal Oswal, the business itself.
Yeah.
Vaibhav?
No, I think yeah, just become a better investor and focus on getting maximum returns for clients. I think that would be the resolution.
Well, that's a fun conversation, and you can catch the full one at 11 a.m. only on CNBC-TV18. Time for a break now. On the other side is another Diwali special, Indianomics. Lata will get chatting with Madhvi Arora of MK Global, Samiran Chakraborty of Citi India, and Kaushik Das of Deutsche Bank, and Upasana Bharadwaj of Kotak Mahindra Bank.
Welcome to our Samvat special Indianomics. Here's wishing all of you a prosperous and great Samvat 2082. Well, the Indian economy has notched up many records as we stand at the start of Samvat 2082. The last available GDP number is a stunner at 7.8%, and just hours ago, the IMF has upped India's full-year growth forecast for the current year from 6.4 to 6.6%. The September CPI inflation stands at an 8-year low of 1.54%. The wholesale price index at 0.13%. I mean, next to nothing. This inflation index, WPI, has been below 4% for the past 3 years. And finally, the government and the Reserve Bank have given an extraordinary boost to the economy via huge rate cuts, 100 basis points, income tax cuts and GST cuts. So, how will the economy pan out in Samvat 2082? I have a panel of top-notch economists to tell us just that. Samiran Chakrabarti, the chief economist from Citi India, Kaushik Das, the chief economist from Deutsche Bank, Upasana Bharadwaj, the chief economist from Kotak Mahindra Bank, and Madhavi Arora, the chief economist from MK Global. Ladies and gentlemen, an even house, thank you very much, and Diwali greetings to all of you. Well, Samiran, let me start with you. Like I said, this huge consumption boost, what have you made with the initial numbers? Are you getting a sense that perhaps growth will get a leg up? It will be better than the 6.7, 6.8 that is now being projected.
Thank you, Lata. Diwali wishes to you and all your viewers. Well, this is a somewhat complicated question to answer right now, because while we have a very decent September quarter behind us in terms of the high frequency indicators that we have tracked, it is likely to be again a 7% plus growth quarter in September. But going forward, there are two different tracks that we have to observe. One is the stimulus that has been given to the economy, how the consumers respond to the stimulus. And second is, if this tariff-related global shocks, they continue, then what kind of second round impact we start seeing in the second half of the fiscal. I think how these two things will balance out each other will determine how the second half is going to look like. We are relatively more optimistic that this size of the stimulus at more than 1% of GDP is clearly a very big one. So we understand that there could be a debate on how much will be saved versus consumed, particularly when the market mood might not be that great. But beyond that, it's likely to have impact. One debate is also that whether the impact will be more on goods demand versus services demand. Our sense is that it could go more towards services than towards goods. And how the global situation is going to pan out is much harder to predict. In our baseline, we have taken that it might take some time for the tariff deal to fully come in for India. So this headwind can continue for a while. But even with that, we think it is possible that we clock a 7% GDP growth for the full year. Let's not forget that how the inflation numbers are panning out. Even for the December quarter, the GDP deflator is likely to be extremely low, which means that the real GDP growth will be much better compared to where the nominal GDP growth can be.
Okay, yeah, I was going to get that in, but I'm glad you brought it in. The WPI, there was a reason why I said the WPI is at 0.13%. That means that the nominal GDP is going to be deflated by a very, very small number, less than 1%, and that will make our GDP look good. But that's one thing, that's the statistical advantage. Madhavi Arora, you'll track a large number of companies and markets. So just one more word on consumption before I get to the other parameters. Are you getting a sense that your own growth forecasts may be bettered from the consumption numbers that you are getting so far?
So, Lata, the economic outlook has become a bit of a tug of war between whatever is happening on the external tariff-related headwinds, and also what's happening in the domestic economy with regard to lower inflation, consistent monetary easing in terms of transmission, decent monsoon, the GST cuts and direct tax cuts. As of now, I think there's still a lot of noise in the data. One doesn't really know this consumption boost is basically a temporary pop-up, or actually it will have a more durable life to it. I still believe there's an income effect which is very dominating in the urban sector, which has been working its way through in terms of a lower urban consumption that will continue. Yes. My fear is that it could spill over to the, the semi-urban economy as well as we get into the next quarter or so, because all this while what we were seeing was largely the income story which was playing out in urban, and rural had started to pick its pieces well after almost 7 years of being MIA, and was doing pretty decent. But I think the large chunk of tariff-related hit would be actually felt in the semi-urban economy, the MSME-led segments, which could actually probably lead to a much more weaker underlying growth story than what the GDP numbers would look to be because of the deflator effect.
No,
so
I take your point. I take your point that we underestimate the global impact, and it came in full force, didn't it, in 2008, 2009?
Historically, India has never been able to outdo the Asian growth trend. Even though we are a more domestic-driven economy.
Absolutely, and the Asian growth trend, especially when you look at Indonesia, Malaysia, Thailand, is not a very positive trend, and we don't know how much of that. The inflation is rubbing off, then maybe the growth also will. But I'll give all of you a chance to speak on growth in a bit. Let me cover the other macroeconomic parameters which the markets are terribly interested. And to you, Kaushik, on that, we've got these extraordinary inflation numbers, and the Reserve Bank is again going to be red in the face and will have to bring it down. Where have they started from 3.7% inflation down to 2.6 and probably now to 2.2 or 2.3? What's your estimate as to what will the inflation number come down to, and rate cuts? What are you expecting?
Lata, so, I was just looking at the inflation number today, and it looks like October, we are going to get, very low inflation number, the lowest on record. I think whatever index we have, probably we have to go back to the previous index to see if we get this kind of a number. So it could be close to zero. I'm saying, like I've written in my report, there's an outside chance that you can get an even negative year-on-year number if food prices kind of continue to remain weak in October. So we are talking about something like 0.4, 0.5% YOY growth in October. And what it does is basically it reduces the inflation average for October, December quarter, January, March, and even the next few quarters. So this fiscal year, as you mentioned, we could be as low as 2% or 2.1% compared to the 2.6 that RBI has just recently revised it down to. And it also reduces the forecast for next year. Instead of the 4.5 that we were predicting earlier, we now have a number like 4.2, 4.3, but my guess is we could go down to 4% even. And we are still yet to see the impact of the GST rates rationalization in the CPI, core CPI numbers. So that has still not come yet. So you'll probably see that through October, December quarter, which could reduce core inflation by 20, 30 basis points. Then you have this other impact, more structural impact of, the overcapacity in other countries coming into India, and you could have a disinflation impact. So basically inflation, if you have to take a call, probably the risk is biased to the downside. We know that there is a risk of food inflation, which can go up anytime, but even factoring in all that, probably next year we could be at 4.25.
So rate cut?
Yeah, so rate cut, my view. I thought October was the best time for RBI to cut already. If they have not done it, then December, they should not delay it any further. They should do a 25 basis points rate cut. And then it's a question of how much real rates differential you want to maintain. So if your inflation next year is 4% average, then if you're at 5.25 on the policy rate, you are at 125 basis points, positive real rates. I think that's enough for the time being, given what Samiran said, the stimulus that has been given on the GST side. I'm also optimistic that in the next few weeks or months, you will hear more positive news on the tariff front for India. And that would, reduce some bit of stress that is going on. And, this GDP growth number obviously will surprise to the upside on the real GDP front. But I keep on stressing the fact that you have to look at the nominal GDP, which has been slowing for the last 3-4 years. That's where all the problem is. And that's why you're seeing it getting reflected in the stock markets, earnings estimate, nominal credit growth, tax collection. Everything is in terms of nominal GDP growth. And that's where focus should be, and not just on real GDP because of deflator pulling it up.
Absolutely. We will discuss growth a little more later on in the show. So Upasana, thank you very much for coming in your Diwali finally. I didn't miss the henna as well on your hands. What's your sense? Does the Reserve Bank now have space for 2 cuts and not just 1?
Lata, we do see scope for up to 50 basis of rate cut. I mean, actually, until before the June policy, we were of the opinion that there is adequate room for RBI to go up to 5%. But of course, things did turn around. And since the GST announcement, we have been expecting that, even rather, I would say before that, we were expecting this year's inflation reading to be sub 3%,
yes,
which has further gone down to 2.1% now, given the recent numbers. And even as Kaushik pointed out, inflation trajectory, not just for the next 1 or 2 quarters, but now for the full year, next year as well, we are looking at comfortable numbers, barring any shocks, of course. And going ahead into the 4th quarter of FY27 too, our estimates suggest that inflation could be 4 or at sub 4%. In that kind of an environment, 5.5% repo rate today, with of 3.7 estimates of ours for the 4th quarter of FY27 gives about 1.9% as real rates. Now that is something which I think is very high, and hence there is adequate room for RBI to address growth and go ahead with about up to 50 basis. Okay. The only tricky part here is that the 3rd quarter is going to be clouded, or rather, colored with all the euphoria because of festivals as well as GST related, excessive buying. So the corporate earnings data, the high frequency data, consumption linked, will be suggesting a decent reading.
Okay.
But I would agree that because the nominal GDP is something which is important to keep in sight, we should not lose sight of the nominal GDP growth, which could still be very muted.
And its weakness.
So, 50 basis rate cut, there is room for.
Okay. All right. Let me quickly, before the break, get the rupee in as well. As we speak, Samvat is being celebrated by the rupee as well. 88.20 was where we started the day. A sizable recovery from the, fall that we saw. Samiran, what's your sense? Do you think the worst is over for the currency?
As we know that this year rupee has been an underperformer for most part of the year. And that's where in the October MPC meeting, when the governor spoke after the meeting, there was one line in his prepared statement, which was really out of the ordinary, where he said that RBI is very closely watching the rupee movements and will take appropriate steps.
Yes.
Our understanding is that after that, the intensity of intervention might have gone up in the market. That is probably giving the market participants a sense that RBI is going to use up this huge FX reserves that it has got to ensure that the undervaluation does not worsen any further from here. So when this market expectation from continuous rupee depreciation shifts, then you could see sometimes these large swings in the first phase of that shift of market expectations. And it could also be related to some market view that US is going to go stronger against China now with the tariffs. So maybe that increases on the margin the probability of India getting a better deal, or in some of the flows rotating back again from China to India. So all those expectation changes might have caused this large move today.
Okay. Well, fair enough. Actually, if there is a tweet monitor, we can say that tough Indian tweets are, clearly declining. And perhaps, therefore, the sentiment about India also will improve. But I do want to get in even the ECB steps that the Reserve Bank has taken, all of which can help the rupee. All those questions after the break. For the moment, for Bazaar viewers, it will be Chartbusters, but you will get to hear this grand show in its entirety after market hours.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, best है सबको पता है. Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Shares of ICICI Lombard trade higher after a steady set of earnings. The net premium earned rises 12%. Profit also sees an uptick. Management says they will try to outperform the market by 100 to 200 basis points on the growth front going forward.
Shares of Persistent System gain over 7% after reporting a strong September quarter. The company's revenue and margin beat estimates, with brokerages CLSA and JP Morgan raising the target price.
Thyrocare rises after reporting a 79% uptick in profit, aided by higher test volumes and improved efficiency, which led to higher margins.
And Godrej Properties gains in trade after acquiring 26-acre land parcel in South Bengaluru, with estimates revenue potential of around 1,100 crore rupees. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see in a short while at the top of the screen, there's green on the screen. So pretty good, Mangalam. Some positive earnings reactions. We've had a bit of a, some consolidation for the last 2-3 trading session. But it appears the bulls are back. We're getting closer to around that 25,330, which will be the first level of resistance.
Bulls are back, and the broader market is doing a lot better as well. 2 stocks advancing for every stock which is declining, which is a good, relief from what we saw in the last couple of trading sessions as well. But more importantly, HDFC Bank, that's come back in style. Reports its numbers over the weekend. So let's pull up the intraday chart of HDFC Bank. That's powering the Nifty bank ahead. And alongside that, we have the Nifty as well, which has moved to the high point of trade. For the last couple of sessions, while the other banking stocks were doing well, HDFC Bank was a bit of an underperformer out there, which is why the Nifty bank did not do as well. But the last few minutes, if you look at the intraday chart of HDFC Bank, the Nifty bank and the Nifty, all of them would be fairly congruent in the shape of, the move that we've seen in the last 15 minutes or so. Good time to then welcome Shivangi Sada of Motilal Oswal Financial Services for a quick technical check on the market. Shivangi, the morning so far looks fairly good. We're closer to that 25,300 mark. Do you think today is the day where we break out and actually stay above those levels? Or maybe once again, around 25,330, 25,350, we'll see sell-off?
Very good morning, Mangalam and Nigel. Thank you for having me. So we've seen that festivity cheers are already, showing on the charts for Nifty. Of course, yesterday was, kind of a profit booking day. But the good part is that we saw excellent support-based buying at the 25,050 zone, where there was strengthening of the put writers as well. Even though the fall yesterday, we did not see the put writers shift their strikes. So that was a positive there. Of course, we are going with buy on decline, which is to continue ahead of the festivity and in the series as well. So we're looking at 25,050 as an important support level for the next upside move towards 25,450 marks. This is for the index. Of course, India VIX had given trouble in the last couple of sessions, but the kind of put call ratio that has maintained at its level is positive. Talking about Bank Nifty, of course, you've seen outperformance here. And this has been led by the PSU banks of lately. And we've seen that even, despite the profit booking yesterday, it has managed to surpass above 56,500 levels and hold quite comfortably. So we are looking at 56,500 as a base here, as a support, which was earlier a resistance. So, of course, role reversal has happened here. With that, we're looking at the upside potential for 57,250 marks for Bank Nifty.
Okay, got it, Shivangi. What about individual stocks? What's on your radar?
So having said about the strength in Bank Nifty, my first pick would be from the related space. But of course, this is a digital space platform that I'm talking about. This is Paytm. This stock has kind of come out of its consolidation on the daily basis, and we've seen on the weekly basis as well. It's been, respecting its upward sloping channel. Quite so that, we've seen that it has respected its 50 DEMA perfectly as a crucial support level from the last few months. So this one's on radar and getting ready for a potential target of 1320 levels and 1240 as a support for this one. And the second pick on my radar would be Persistent System, where we've seen bottoming out structure here. IT space has kind of shown some sort of strength and a comeback move in the last couple of weeks. And Persistent System has been one of the strongest out of the entire lot. And we've seen that call writers have unwinded their positions here, which is a positive for this one. Even on the weekly basis, it's kind of surpassed and is holding at the higher levels. So this one's quite positive and looking for a good upside. So recommending a buy here with a target of 5950 levels with a support of 5600 levels.
All right, take that point, Shivangi. Thank you so much for joining in, and festive greetings once again. Just before we move forward, keep an eye out on two stocks. We've been so far talking about stocks which have been doing well. Dreamfolks is one that comes up for you. For the last few trading sessions, it's a big up move. In fact, purchase backed by volumes, etc. as well. But today that's come undone. It's down about 7%. So that's the one which is trading on the downside. The other one that I'm looking at is Hotel Leela Palaces. Yesterday, post numbers, the stock was down about 5.5%. Today as well, the management sounded fairly optimistic about growth, mid-teen sort of revenue growth with 2,000 crore EBITDA target by FY30. That's what they've reiterated. But the stock's fallen. And the current level of the stock extremely crucial because, the IPO came in at 435 rupees. So with today's decline, it's fallen just marginally before the IPO issue price of 435. So we'll keep an eye out on Leela Palace Hotels. But with that, let's get you some ideas for profit. Our colleagues from Money Control joining in. Today we have Khushbu Rai Gupta of moneycontrol.com.
In today's idea for profit, we have Aditya Birla Capital. The stock has delivered strong returns and outperformed the market following the merger of Aditya Birla Finance Limited, the NBFC arm, with the parent company in March 2025. The robust growth in the asset base and earnings in the June quarter extended the positive market sentiment. The reverse merger has transformed ABCL from a holding company to a large unified operating NBFC with better access to capital and improved operational synergies. The merger will also act as a performance booster on account of more cross-selling opportunities. We feel that the merger synergies, better growth prospects and improved financial performance are expected to drive the stock performance. While the amalgamation has enhanced the stock valuation due to the elimination of the holding company discount, we feel that any future valuation re-rating will be dependent on the sustained risk-adjusted growth by the company.
All right, with that, we'll simply do a short break. Come back on the other side, a conversation with the management of Lemon Tree Hotels. Stay tuned. Look at the surge that we're seeing in urban company. It's up around 8% right now. Typically, again, a strong seasonal quarter for them. So that stock doing well right now. From its IPO, it's done extremely well too. But let's talk about the hospitality space once again. Patanjali Keswani, who's the chairman and managing director at Lemon Tree Hotels, joins in to discuss the impact of GST cuts. More importantly, the outlook for the second half of this fiscal year. Thanks a lot, Mr. Keswani, for joining in. The obvious question, how's the business been post GST cuts, and has the lack of input tax credit impacted performance for you?
Well, I think, look, there will be obviously an uplift in demand because the price comes down. But on the other hand, there will be a loss of input credit. So one can only hope that the uplift, the flow through from revenue uplift, more than cancels the loss of input credit. And I think input credit should have been retained in an industry like ours, but unfortunately it was not.
Got that, Mr. Keswani. But what kind of quantifiable impact would you have, due to the lack of input tax credit?
We own a lot of our hotels, number one. Okay, and input credit matters either way for us. The reference you are making is for management fee income, but the reference I am making is for ownership. So when I look at our business, about over 50% last year was above 7,500 rupees as an average rate, and about 50% or a little less was under 7,500. Obviously, there is a change in pricing this year, as it happens annually. So I would reckon about 40% of the business that we get is going to be impacted by loss of input credit. Okay. If I quantified it on a revenue basis, I would estimate it would be in the range of about 1.5% to 2% of revenue. Say 2% of revenue. So that's the impact on margins. But will your revenue go up by more than 2% because of this fairly significant drop in GST? Well, I would hope so. And if that happens, then this becomes, one cancels the other.
All right, so about 100 to 200 basis points impact on the margins, but if that's offset by higher revenue because of lower prices, that would be a positive for you. But the second half, it's a strong season for the hospitality industry. How's that looking for you?
Q2, you had a good last year, and therefore Q2 this year, in relative performance to Q2 last year, would not have been anywhere near as good as Q1 was to last year Q1. Now, when I look forward into Q3, the interesting thing is what affected Q2 will not affect Q3 this year. For example, there were a lot of festivals and so on last year in Q3, which occurred this year in Q2, which deflated demand this year in Q2. I hope I'm making sense to you. And so when I look at Q3 this year, Diwali, Dussehra, all of it put together has occurred and will occur in October. Okay, so that gives you what's called a clear November this year, whereas last year Diwali was towards the end of October and the impact was felt through in November. Keep in mind that in our industry, I would say the 3 most critical months, 3 to 4 most critical months are after Diwali till middle of December, and after January 26th till middle of March. These 3.5, 4 months account for 50% of your revenue. Because it goes gangbusters then, demand from every possible segment. So this year we are going to have a very, very good H2 compared to last year, primarily driven by the fact that you have this enormous upswing in November this year, which you did not have last year.
That's a little tricky answer there, Mr. Keswani. Let's keep things simple though. How much higher will growth be in the second half of the year compared to last year?
We had a very, very good Q1, for example, the industry. By the way, I'm talking industry. And I think 18 to 20% was the growth. So I would not be very surprised if we did not at least do mid-teens growth this H2, tending towards late teens versus last year.
All right. And what are the new properties that you're opening? All right. Just before we let you go, what's the update on the restructuring, sir?
You'll have to wait for 2 months. That's being discussed, but there is plenty of very interesting stuff happening in our company, and that should be out by the end of this calendar year.
Wait, you said you have to wait for 2 more months. Could you give us some more details of the interesting stuff?
We are looking at multiple things, one of which is, of course, the listing of Fleur and a pre-IPO kind of valuation. So we will look at raising some money in Fleur. We will also look at the route to listing Fleur, which is it a direct list or a demerger? Third is we will be looking at certain large acquisitions for our company. And I mean, parts of it you've already seen. We've acquired, the 550-room Aurika plot in Delhi, which is very, very important for us. And there are many, many more things happening. Can't tell you right now, but for me, it's going to be a super busy Q3 because of so much happening there.
Okay, all right, Mr. Keswani, appreciate you joining in. Always a pleasure talking to you. Look forward to catching up with you rather soon. Well, time to slip into a short break, but as we do that, a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameters considered for calculation of the 4 factors are score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor, viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions. Welcome back. You're tuned into Chartbusters here on CNBC-TV18. By the way, that's a big order coming in for a smaller company, Power Mech. Remember, the stock has been under pressure in the last few months because there was a lack of any order win. Now the company has gone ahead. They have secured a large-scale order of around 2,500 crore rupees from BHEL. This is for an EPC package for the balance of plants at Singareni Super Thermal Power Project. So this will be read positively because the management had guided for around 10,000 crores of order inflow. And that was lacking till the half-year mark. But now this 2,500 crores seems to be, the trigger that the street was looking forward to. A rank underperformer in the last 1 year or so. Last 4 months as well, the stock was under pressure because the street was expecting this order and it didn't come about. They've given further details that 38 months from the start of work is when they'll have to execute it. So we'll have to keep an eye out on what kind of margins, what kind of profitability they'll be making as well. But that large order that the street was anticipating for the last quarter or so has finally come in for this smaller name. Moving to Persistent Systems, though, that's the stock that's in focus today. It's up close to 6%. They reported solid set of numbers. Rima told us earlier today she's joining in to help us out with the revision of that and what brokerages are making of it. Rima?
So, JM Financial calls Persistent's quarter a near perfect quarter. Nomura says it's an all-round performance in Q2, while CLSA has a high conviction outperform rating on Persistent. Now, the company's done well. It's beaten expectations on revenues and margins. Revenue growth is 4.4%. And if you look at the dollar revenue growth, it's been above 3% for 22 straight quarters. That's phenomenal consistency. Margins, too, have expanded by 80 basis points to 16.3%. The company is guiding for 100 basis points margin expansion this year, FY26, despite the wage hike which kicks in 1st October, and another 100 basis points expansion in FY27. Brokerage view is positive to neutral. So the bullish calls are from JM, CLSA, Nomura, HSBC have a whole neutral call, and Ambit has a sell call on the stock. Now, the reason why Ambit has a sell call is because valuations are on the higher side for Persistent, and according to their calculations, close to about 42 times forward multiple. But CLSA likes the story because this is a company, according to the calculation, growing 29% EPS over FY25 to FY27, and JM Financial likes the consistency.
All right, Rima, thanks a lot for that. With that, we are wrapping up on this edition of Chartbusters, but you stay tuned because an exciting conversation with Motilal Oswal's Ramdeo Agrawal coming up next.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Today we bring you a very special conversation. One, hopefully, which is a blend of market wisdom, but also family banter. And that is why this, I think, for me as well, is a very special conversation. My guests, one has built an investing institution, which I don't think needs any introduction. I'm talking about Ramdeo Agrawal. Joining him today for this interview is his son, Vaibhav Agrawal, who is the CIO for the AIF and the PMS businesses at Motilal Oswal. Gentlemen, both of you, thank you very much for being part of this program.
Thank you. I mean, this is very, very new and I would say very good experience for me to bring Vaibhav along with me.
New and old.
Yes. No. I mean, we are fully out there. The best is ahead.
Best is ahead. Happy Diwali to the both of you and to the teams and, of course, this wonderful institution.
My pleasure to be here and grateful to be with you and my father on the interview.
And Vaibhav, have you seen any of these? How do these Diwali interviews go? Have you seen any of the earlier ones?
Yeah,
we've done so many over the years.
Yeah, when I was younger, I had seen it at that point. But I think every year there's some different color, different flavor, and so it's obviously a very interesting time to sort of be part of the market.
Did both of you gel match what you guys were going to wear?
No, till 10 o'clock in the morning, I didn't know what I'm going to wear. I knew what he's going to wear, but I didn't know about mine. So it came out with a...
But it's looking fabulous, fantastic, and Diwali-like. Vaibhav, what are your earliest memories? I mean, you're here managing, the AIF and the PMS portfolios. But what are your earliest memories of this business, basically?
Yeah, so I think earlier, we were just a broker. So I remember we used to go to Natwar Chambers, which was one of our first offices next to the Bombay Stock Exchange. And there I used to get fascinated seeing the stock tickers sort of going, up and down. So I remember that was one of my earliest memories. And then I think that time, Dad and Mr. Oswal used to sit in one cabin. And if I was ever sort of making too much of a noise, I would get a shouting from Mr. Oswal because he was always a very strict disciplinarian. Not
your father?
He was more polite. He has a gentle way of being firmer, but Mr. Oswal is obviously sort of more strict, and so that was my earliest memories. And then I also used to play computer games. I remember because when I was a 4-year-old kid, that's what interested me. So since then I've seen a lot more.
72 square foot office. When we started Motilal Oswal, I was so happy to walk into that office. 72 square foot. Was, in that we had Moti and me sitting next to each other, and then there was a working space where 4-5 guys were sitting and doing the clerical work, making the bills and contracts and all sorts of stuff. So in 72 square foot we started, and I was very happy when we inaugurated that office. And that was 1990. We got the membership and we started that office. And that's where Vaibhav was maybe 2-3 years old, and he used to come and...
So he said that he would sit in the office and play computer games.
What else can
now
you do?
Markets have become computer games.
Completely.
What a journey it has been, right?
My God.
आपने कुछ मुझे पहले आप बता रहे थे. From what to what is you've seen 3 phases.
Yes, I have seen. I read the book Value Migration, but I have seen the value migration right in front of me. When we started in '87, that time we were the first 2 or 3 chartered accountants to come in. It was a completely, all the old Parsis and Gujaratis and Marwadis, dhoti masters,
Dhoti masters.
So many of them were actually wearing dhotis. My father was also wearing dhoti, but they were elderly, respected, very respected community. But they were very old type, a lot of family kind of business, and small income, not much of it. It was not a big game, and markets were small, and from there. We took over. I don't remember any of those old guys in any significance now. Now, whosoever is there, they're all our generation or the new digital guys. So from us, the cake has expanded too much, very, very large, but now third part is happening. That is complete digital. Like your Zerodha, Grow, and whatnot. So those guys have taken almost like 70-80% market share in broking. And we are with, that advisory driven, 20-25% of the
You've also
pie.
expanded, not just broking. I mean, so many
We
other
expanded
businesses that
but
you...
our smartness is that we use all the cash flow to build other businesses, other associated businesses in the wealth management, private equity, AMC. So all those businesses we built, and that has what has made Motilal Oswal, kind of capital market powerhouse.
Right.
So that's what, and now the journey is different, and that's where now Vaibhav and Prateek's, their entries are there, and they have to play the role.
Did you always know that Vaibhav was going to be part of the business?
It is his call, but I told him right in the beginning, this business पागलों की बस्ती है. You have to be passionate about his stock market.
This is when he was how old?
No, like whenever he started understanding, I was very clear, he has to have a free hand in what he wants to become.
Right.
He wants to become Bollywood star, or he wants to become cricketer, or boss, it is your call what you want to become. You'll get the share certificate of the company for sure. So don't worry, you'll not be poor, but pursue what you love, yeah.
And when did you realize, Vaibhav, that you want to be in this business? That's investment management.
Yeah, so I had gone for my undergrad to the US, so I was studying computer science at that time. And then I started taking some courses in finance as well. And that's when I think, I was able to sort of understand that more deeply. I think maybe it came naturally or whatever it. And even over the summer when I used to come, I used to do...
Before going to, you went to UPenn.
Yeah.
And then you went to London Business School.
I went to London Business School for my MBA.
For your MBA later. But did you think you'd do something in computer science, IT, technology at one stage, or no?
So I had that feeling. So that's why I was studying engineering. But then when I came over the summers, I realized that sort of equity markets, investing, that's kind of something that I was gravitating towards. So the second half of my time in my undergrad, I sort of focused more on coming back to investing. And so I think mostly when I was about 20 years old, I figured that I want to be in part of the equity markets.
How's it been coming back here?
I think it's been great. I mean, I think the platforms like just exploded since the time I've been here. I think every day there's so much to learn. Because obviously there are phenomenal people over here, but you also get to meet amazing people outside who are like the companies, the analysts. So I think it's a very fulfilling experience.
When I said you cut your teeth as a fund manager. You have to be a good fund manager. Otherwise, you're my son, that is one thing. But what competence you bring for the capital market?
Is he a strict boss?
Yeah, he's definitely a stricter boss.
But polite, you said.
Yeah,
or
polite but strict.
Polite but... I want to ask you, how did you teach actively as he was growing up? And I mean, Vaibhav is almost as old as Motilal Oswal, right?
Yes.
I mean, the organization. Just a 2-year difference. Did you actively sort of teach him? I mean, concepts growing up. You're busy building the business, but
no interaction that much. In the sense that not discussing so much about the company or business. Or I taught him only. He was learning Vedic maths. I don't know. Somehow he and his mother both got into thinking that they must learn Vedic maths, which is much more mental maths actually. In that, I said you must learn compounding. So after the dinner, when we go for a walk, just a stroll. He used to come and I taught him compounding then, when it must have been about 11, 12 years. You must have been.
I think about 14, 15.
14, 15, yeah. So now he can do faster compounding than me. So that is the only thing I had taught. Rest all
otherwise, I mean, growing up in a house like this, I mean, you pick up through osmosis, right? I mean, you pick up a lot of stuff, absorb a lot of stuff, which you don't even realize, but it's there.
Yeah. I think it's just organically, I mean, if someone discusses the markets or the companies. So I think it more formally started maybe like when I was in 11th and 12th grade. I think that is when he started telling me about value investing. That time his focus was more about Benjamin Graham and value style and a little bit of Warren Buffett. But I think his own style evolved over a period of time. So that's when we moved from purely value investing to growth investing.
So Prashant, why don't we go and sit and have a cup of tea and we'll continue the discussion. Yeah.
Ramdeo, I wanted to ask you, do you spend a lot of time together in office? Have lunch together or have fixed time where you can sort of connect?
Zero. No interaction. I'm the boss. He's one of the fund managers.
ये तो बड़ी ज़्यादती है.
But ऐसे ही है. So I mean, like actually in AMC, I sit actually right next to the AMC. But now with the SEBI mandate, I'm not allowed to enter. Every time I enter, I have to give reason why I enter. So I've said I will not enter till 3:30.
Right.
Ever.
Right.
So I stay out and he's there inside as a fund manager.
But now that he's part of the business, part of the investment management business, which you oversee, do you actively, as you said, I mean, you know, you've not actively taught him how to invest or the frameworks or the models, etc. But now that he's part of the business, do you kind of spend time with him in that sense, or?
No, I take reporting from his boss.
I see.
His boss is Pratik Agrawal and his boss is Navin Agrawal. So I talk to all of them. I mean, of course, I talk to him and Niket, who is another CIO for the fund, MF. So I generally talk about the business, not about the stock picking.
Right.
What he's doing. If he wants to ask something, then of course.
Right.
But not much of active interaction with him about what he's doing in his fund, what his stock is buying, why he's buying. No,
Right.
I don't get into that.
Right. Do you find that as a missing piece or no? Not really.
I think like earlier between 2012 and 2014, when I was just learning the ropes of investing, I think at that time I had the advantage of we had a much smaller team. He was more actively involved with asset management. So at that point I had the advantage of seeing him up and close for 3-4 years. So I think I was able to pick up a lot of things at that point in time. And then I think informally I have picked up things over the years from him.
Right.
So I think it's obviously like it's a huge honor to have someone like him, to look up to. But at the same time, I think a lot of my colleagues at work, and the analysts and the other managements who we interact, I think there's a lot to learn from them as well.
A lot of them have, at least in Motilal, trained under you at some point or the other. So in a way, it's kind of that knowledge is seeping through, not directly maybe, but indirectly.
Yeah, through our well-placed studies and some casual interaction also at home.
Yeah.
Exchanging of the books.
Yeah.
Some idea I would throw, he would throw. But I mean, so it's a continuous process. It's a cumulative process, I would say.
I want to ask both of you a question. What do you find about Weber which is different from how you invest, how you think about things? Is there anything which stands out to you?
No, one thing which is than what I was at his age.
Okay.
So now I would be, even now I'm more talkative or more active than him.
Right.
But to have this kind of patience and what do you call?
Sthirta.
Sthirta, stability.
Which is?
So that's what he has. So he's a good listener. He will talk less. And he will do his homework. He's far more digital. Initially when Google came and, when I would ask any question, he will go to Google and figure out what's happening. I think
do you also find the area of coverage is a lot more in terms of the kind of companies or not really? I mean,
no, I mean, now if you're sitting in this kind of AMC, the whole world comes to you.
Correct.
So and I'm busy in much more corporate activity. He's busy in actually fund management.
Right.
So the number of companies, I mean, 100, 150 companies are getting listed new.
Correct.
First time, and I'm struggling when the company guys, they pitch the idea, what this company does. From there we start. These guys, they know much more about each and every company. So now the future or present of even what's happening in the corporate development is all in their head. They are building new directory in their head. We are the top 500, old 500 is in our head. So
new and old, not just old, new and old.
And no, more old and few new ones. The something like say quick commerce and all, which fits into my head, that I'll pursue.
Like he's able to think like 10, 15, 20 years for a stock or a company that he invests in. I think just given that like how volatile the external environment is and how quickly things are shaping up, sometimes it becomes a little difficult for me to maybe visualize how in the midst of all those factors, will maybe an early stage company, behave after 10, 15 years. So I think obviously maybe because of his wealth of experience, over time he's seen that journey more. So he's able to visualize that. So I think that's something which maybe I'll learn over a period of time.
Whether it is a HDFC, though I lost it in 6-8 months, then started with the Hero MotoCorp. I sat for 18 years. Then we did Infosys, Tree CMD. That was a very short blast, and then we did Bharti, again 50x and all. So like that, we kept on. So I became more and more buy and hold, longer term. But it's a journey. I mean, eventually he will also realize that as the money becomes bigger, when he has to manage thousands of crores prop, not AMC. In AMC, there is no taxation and all. So when he'll manage his own money, then he will realize that, boss, let's find a great idea. And
you can't flip in and out, not continuously.
I mean, that option is also there.
Yeah, yeah.
But where you should be sitting, you should be sitting.
Yeah, yeah. I want to ask you a sector idea which.
He's the best guy. You ask him.
No, not about what will do well, but anything you can disagreed on and one or the other.
So I think back in 2014, I remember I was pitching TVS Motors to him, and I think he was more of the hero camp, you know, back in the day. So
hero and
old faithful.
Yeah. So I think
old faithful.
Yeah, old and
actually, so there was a leadership change in TVS at that point. So I think from there on, TVS I think has obviously done very well, and kudos to them and the management there to sort of do what they did. So I remember, I think that was one thing where we used to have a lot of disagreement about.
Yeah. So did you finally buy it or no?
I think our funds.
Once you disagree, then you.
I think our funds have bought them over a period of time.
Okay.
But yeah, I mean, I think so there are obviously instances like that where we do.
The reverse has never happened, right? Obviously, it's not happened.
Yeah, but I bought a multi-bagger with his trip. That was Guru Finance.
Guru Finance. Guru, I think, was one of your first kind of.
Yeah.
Guru, and there was another stock, no? Which was.
So the first stock I ever bought was Nestle because I was doing my summer internship studying it.
Okay.
But then I think Guru Finance sort of came about.
Guru was the HDFC subsidiary.
The HDFC subsidiary that got taken over by Bandhan. So that it has HDFC management, and I think it was available at 1.5 book or something.
Right.
And it was growing very well and very well managed housing finance company. So yeah, it did very well. I think it went to at one point as high as 9 or 10 book. I think even today in the NBFC space, I think it is one of the highest ever recorded valuations.
Right.
So it's too cheap, very cheap for the growth and quality and parentage. So when he was in US, he came in summer and all. That this Nestle kind of thing, this one looks to be good. So I bought and then I bought and bought and bought. I made a lot of money in Guru.
In Guru.
Guru, yeah. So those kind of things happen.
You know, let's do a rapid fire if both of you are up for it.
Yeah, absolutely.
Yeah, please.
Quick ones. So let me start with the first one. One standout habit you admire in each other. In Vaibhav and Vaibhav, you and Ramdeo ji.
So I think his patience and ability to sort of sit through for the long term, and I think he's very gentle with people. He has a way of interacting with people which makes them very receptive to him, which I don't find in many people. So I think that's what I think.
If I had to name one, and I've said this before, is his curiosity.
Yeah.
Which is he's so excited.
Yeah.
About things and new things that and he'll sit down and he'll ask you questions and always at least I found that over the last 2 decades. Ramdeo ji, about Vaibhav?
No, I admire his that coolness, that calm thinking, very composed, calm, and of course he knows compounding. So that's a big asset.
Sorry, which one?
He knows compounding well. I don't know again remind him ever. So,
do you read as much as? I mean, that's one of the first things he said. Pado.
Yeah.
Read 30, 40, 50, but it doesn't matter what it is, but read. And so
I don't read maybe as much as him, but I have these phases when I'll maybe read 3-4 books at one time.
Right.
And then I'll not read for a period and then sort of do it. So it's like a step jump that happens with me.
Book currently on the bedside? What are you reading? Anything you're reading now?
I'm reading this book on commitment actually. It's written by ex-army generals.
Okay.
And it talks about the importance of having absolute commitment in whatever you're doing.
Okay.
So I think that was very interesting to sort of learn.
Ramdeo ji, book? Current book?
Always.
Books or book?
No, book. Always a book. So I'm reading a book called The Brave New Wealthy World.
Okay.
Very exciting book, written in 2003 by Edmund.
Okay.
It's out of print kind of thing, but amazing book.
Okay.
A
brave new wealthy book.
Yes.
A wealthy world.
Wealthy world.
Yeah. Okay.
So this book is about in 2003 this prof who is now dean of Babson College. So this guy is saying that because of securitization, Why America is rich? Because they did the securitization of the debt as well as equity, big time, and that is making the
that cycle.
Yes, all the savings are going into the assets, and assets are being securitized. So that whole cycle is on, and that is making them very rich. And I think, fortunately, India also has the same kind of machine here.
Correct.
So he has projected the world will become so rich. It's not funny. By 2030, 2020, he said it will be 600 trillion. 600 trillion will be the wealth of the world, because he thinks all global. And by 2050, it will be 6,000 trillion.
Wow.
Okay.
Wow.
So now we have the benefit of seeing what he said in 2003 and what has happened in 2025. Directionally, he's perfect. Okay. But the quantum is somewhat, I mean, he's say 5 years behind. What would happen in 2030, what would happen in 2020 as per him will happen in 2030 or maybe 2028.
Got it.
But directionally, bang on. Very exciting book.
Where one stock you wish you bought, you had bought?
There are quite a few.
What,
I wish
one you think you kind of sort of maybe you didn't buy it for X reason, Y reason, but you really liked it at that point. And said, well, Ramdeo, you want to answer till then? Till Weber thinks?
It is. I had a lot of fun with a lot of stocks. What I felt like I bought. One of the regret for me is that between 2006 and 2013, sorry, 2004 and 2013, 9 years, including the GFC boom, it had gone into our head that the corporate should not buy stocks in their, what do you call, treasury. So 9 years I didn't buy stocks.
Wow.
Out of the cash flow. That has made us so poor is not funny. My balance sheet would have been at least double at this point of time.
But that does not show up in your...
It doesn't show up.
Regular,
it's an error of
Buffett says
omission.
in regular
It's
accounting.
an error of omission.
If there was a biopic on Ramdeo ji, which is possible going into the future, who you think is best fit to play him?
Hold your breath.
Yeah, I think Paresh Rawal would sort of fit that role. I think because
That's a nice one.
Maybe because of his optics and also his ability to be both serious and hilarious at the same time.
Yeah.
I think he would represent him quite well.
A resolution for the new Samvat, anything?
Nothing in particular, but because of this book I'm reading, so I would like to take some of the ideas from there and maybe become more aggressive, a little more aggressive, or maybe some new business ideas will germinate. Definitely will give birth to some strategic change in my thinking about capital market and about the company.
About Motilal Oswal, the business itself.
Yeah.
Weber?
No, I think yeah, just become a better investor and focus on getting maximum returns for clients. I think that would be the resolution.
I thank both of you for joining me here on this Samvat special. Wishing you guys, your families, your teams very happy Diwali. Thank you very much.
Thank you and happy Diwali to you.
Happy Diwali to you and your entire CNBC viewers all over the country. They admire CNBC.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Hormis Fatakia. Hey, Hormis, good morning. Going well for the markets today after the fall that we saw yesterday. We are above the 25,300 mark. The bigger question is whether we stay on to those levels or not. It's a 167-point gain on the Nifty. We have the mid-caps, which are actually outperforming today. It's a 1% gain that we are looking at currently. And if we look at the advance decline ratio as well, that should come up for you on the screen. That one is in favor of the advances. The ratio is 1:0.5. So it has continued its lead from the word go, and that had been one of the concerns because this line used to see a lot of crisscross during the trading session. Nifty Realty, a big gainer there, 3.2% higher. PSU Banking Index also contributing well. We do have the Metal Index, which is doing well also. Only the Nifty Media Index, that is lower in trade today. Apart from that, it is looking good across the board. We spoke about mid-caps outperforming, so let's go back to Hormis. He is here with us and putting spotlight on the top movers in the markets as we speak. Hormis, over to you.
Oh, well, the mid-caps are outperforming and the markets are trying to gather some pace after being in pause mode for around about 3 days now. We'll start off with Genesis International, locked in a 20% upper circuit today. The biggest single-day gain since 2019 that the stock has seen. It's been up in 4 out of the last 5 sessions now. And today we have already seen close to 30 lakh shares that have traded. Look at the 20-day average here. It's only 60,000 shares. And as a result of which, the stock has moved above its 50-day moving average, which is at 560. The next level on the upside is the 100-day moving average, which comes up at 607. But the stock has been an underperformer this year, down almost 37% year to date, and has declined for 4 months in a row before seeing some gains in the month of October so far. Urban Company is a name that has sprung up today in the list of gainers. At one point was up almost 8%, so seeing some bit of profit booking from those higher levels. It snapped a 5-day losing streak today. And the 20 trading sessions that it has had so far, the stock has gained in only 9 of them. And today we have had more than 1.3 crore shares that have been traded. An important day lies ahead tomorrow because of the fact that its shareholder lock-in period ends on Thursday. The stock is trading below its issue price, which is 162, and it's down almost 25% from its post-listing high, which is well over 200 rupees. A lot of earnings reactions taking place today. ICICI Lombard, Persistent Systems, Cyient, DLM, all of them seeing moves. ICICI and Persistent gaining up to 8%, and look at the volumes here as well. Significantly higher compared to their 20-day average. Cyient DLM on the downside though, down around 4%. It's trading with around 9 lakh shares being traded. The 20-day average is only 1.5 lakh. And lastly, to put the spotlight on Tattvachintan Pharma, the 4th straight day of gains now for the stock. It's up 10% in the last 4 trading sessions on which it has been on this gaining streak. We have had close to 5 lakh shares that have been traded already on the stock. The 20-day average is only 35,000 shares. And after this move, or courtesy of this 4-day up move, the stock has moved back above its IPO price of 1,083. It has had a fairly decent year. It's up 32% so far on a year-to-date basis, Sonal.
All right, Tattvachintan Pharma. Let's see how the results are this time because it has usually been on the downside post numbers. So watching out for Tattvachintan Pharma. Thank you, Hormis, for joining us with that list. We'll slip into a break now. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by Coin DCX.
On our special segment, Crypto Corner, going across to Manisha Gupta with the latest trends in the crypto market.
On Crypto Corner today, we are talking about banks and crypto integration that we have seen. Well, the relationship between traditional banking and cryptocurrencies really seem to be evolving. To give you some examples, JP Morgan Chase International, for that matter, has introduced a JPM coin for institutional payments. It offers crypto-friendly banking services to its institutional clients, and the blockchain group Onyx is involved in pilot program for real-time transactions. Goldman Sachs, in the meanwhile, has launched a crypto trading desk for Bitcoin and Ethereum, exploring blockchain-based forms of money. Morgan Stanley, in the meanwhile, provides its wealth management clients access to Bitcoin funds. Citi is planning to launch a cryptocurrency custody service by 2026. Bank of America is launched crypto trading desks. We also have Wells Fargo providing access to crypto through its products and funds. And then you have US Bancorp, BlackRock, Fidelity Investments, State Street, and BIY Mellon. All of them are supporting digital asset custody. The IBS has launched its institutional-grade digital asset exchange. You have HSBC, which has launched a tokenized deposit service for corporate clients to move currencies across borders. And then PNC Bank is partnered with Coinbase for crypto trading as well. These are traditional banks which seem to be delving into blockchain and cryptos in some way or the other. And then you have dedicated crypto banks as well, which are focused on institutions, and this is banking beyond traditional banks, really. So then you have crypto native banks. Within this, you have Signum Bank, Frix, which offer custody trading, stocking, tokenization, and lending within a regulatory framework there. There also is fintech companies like Revolt and Bucked, which what they do is that they focus on blending traditional payments with integration within crypto books. And this is with offering multi-currency offerings. They also do fiat currencies, etc. So this is a proper integration that they're looking at.
Manisha, thank you for that update. We take a short break. On the other side, the management of Midwest joins us to discuss their IPO, which opens for subscription, and, of course, the road ahead for the company.
CNBC-TV18 presents Crypto Corner, powered by Coin DCX.
Welcome back. You're still tuned into Trading Hour. Let's talk about Midwest, which is a leading player in the natural stone industry. The company's 451 crore rupee IPO opens for subscription today, which comprises of a fresh issue of 250 crore rupees. Uma Kollareddy, who is the promoter and director, along with Ramchandra Kollareddy, who is the promoter and CEO at the company, join us now to discuss the company's fundamentals, what do they plan to do with the proceeds as well, and a lot more. Uma and Ramchandra, thank you so much for joining us today. On the show right now, we would like to understand more about the business. You had seen a big jump in margins that came by in FY23 and FY24. How much of it is sustainable, and what are the growth levers going forward for the company?
Sure. So the margin front is mostly on the cost factor. So our main cost is energy, and our pivot from diesel to electric, backed up with solar, so that is sustainable, and we are still adding more of that green energy into the system. So I think given that, I think it's sustainable, and maybe there is, I think it's a pivot that we have taken from diesel, fossil fuel to green.
Got it.
Firstly, congratulations on your IPO. First up, I was reading about your IPO itself. As one of your segments mentions that 50% of your revenue comes from China, if I get that right. Is that a risk factor going forward, considering the issues or the geopolitics that we are facing currently, or do you bring or intend to bring that share down going forward?
Our share has been coming down in the last 3 to 4 years. But what I would like to say about China for our business point of view is the EPC contractors who are taking these marquee projects globally, the companies who build the skyscrapers or the malls, large projects, are still predominantly Chinese out there. They have been aggressively going outside China after you see the downturn happening in China. And the supply chain has to come from global sources. And we, blessed with the natural stone in India, in Southern Peninsula, we become the supply chain for that. So China will be a substantial market, but the share is coming down due to a strong growth in domestic side in the last 3 years.
Okay, so you have around 10 customers contributing more than 50% of your revenues currently. How sticky are these relationships? Because we try to understand the long-term pricing that you have or long-term agreements which are in place for the company.
So on the, most of the customers are quite old for our existing business. As we go forward into the quartz business, they're even more sticky because these are solar glass producers. These are long-term contracts which need the powder to make the glass a continuous furnace. So even more further, when you go into the HMS or the rare earth side of the business, titanium, they're even more sticky. The customer profile is changing as we go forward. And even the existing customers, they have been with us for 15, 20 years as we speak, most of them.
60% of your revenue comes from foreign currency, right? Yes. With all the currency-related issues that have been taking place, the weakness in the rupee, the potential weakness of the dollar. What's your word on that?
I mean, we do forward sell and forward hedge our dollars to some extent to ensure that we're not taking too much exposure. Revenue is again very sticky because the quality of our earnings is very strong. We don't do any open credit for sales. Everything is LC backed, and dollar has been supporting us for a while now. We're on the right side of the dollar.
Right side of the dollar.
Yeah, exactly. You are on the right side of that phenomenon that's taking place. Could you detail project economics for the quartz expansion that is taking place, the kind of investment that you're seeing, the capacity, also importantly, the margin profile? Now that you are shifting to green energy, will it get better versus the peers for you?
Yes, so we've already spent 120 crores on the capex for an installed capacity of 300,000 metric tons per annum, which is servicing both the engineered stone manufacturers and also the solar glass manufacturers. So the margin profiles, because we are integrated with both the mines, backward integrated by the mines, and we have a processing capacity, and we are planning to double our processing capacity with the objects of the funds, and we are situated in the hub where our customer base is, entire customer base is. So the transportation cost, which is a bulk commodity, is very, very minimal.
Okay.
And plus, we are very close to the port. To the export market, where again, dollar plays a good important role, and we have very marquee customers abroad. So we're very bullish on the margin profile. There are listed players in Europe like Sibelco and others, and margins look better.
So how is it versus granite?
So we are expecting good margins because we are backward integrated and we are becoming we're a processor now, and plus we have two products. So the second one is a byproduct where the costs are already loaded on the engineered stone product. So which means that the entire thing being a byproduct and servicing the solar industry, where solar glass industry is growing at a 30% CAGR, and then the glass is becoming dual layer from a mono layer. So from a 3 mm thickness glass, you're suddenly using 2.5 mm glass, like a double layer, which is increasing by 60% again. And there is an import duty of 10% for the glass. So there's more and more glass manufacturers that are going to start manufacturing in India. So we see huge tailwinds in the solar industry for this raw material. And we'll be doing good volumes. It will support their capacities.
Interesting. One final question from my end, at least. There's one of the promoters that received a notice from the CBI as regards to pending claims of over 150 crores. There was also a JV liquidation with BEML. If you could share any status updates on both of these and the road ahead.
So I think, going public, a lot of people, a lot of companies do face sudden, legal notices that crop up. But we've discussed this disclosed it adequately in our offer documents. And this matter is sub judice, so...
Okay, all right. So it's sub judice right now, but there could be an update very soon, and we'll take that update from you and as and when it comes back. You also have 25.5 crore rupees which you're allocating for electric dump trucks. You said you are shifting to green energy. What kind of savings are now you are anticipating? So will that margin expansion continue through in FY25, FY26 as well? Not FY25, sorry, FY26.
To give a perspective, right now we are having about 9 trucks and we have a runway to go up to 80. Okay. And each truck is giving us a great ROI. And since we sweat the vehicle, so in any electric product, you need to sweat the vehicle. We operate 21 hours, 22 hours a day. The efficiency and the numbers are adding up. So I think that's the driving force.
And so do you plan on going up to 80?
We will do it but in the next 18 months, the number is close to around adding another 18 to 20.
18 to 20, all right. All right, Uma Ram, congratulations for that. Thank you so much for sparing time and joining us. And we wish to have you back on the day of your listing as well. So
thank you very much.
Thank you for sparing time and joining us today. That's the management there of Midwest, the IPO opening for subscription today. By the way, the Nifty currently 150 points higher, 25,300 is still continuing to face some hurdles at that 25,300 mark. Is at Monday's high of 25,310, and of course the recent high of 25,330 that comes into the picture now for the index. And a lot of these earnings reactions that have been taking place as well. ICICI Lombard continues to build on to those gains. Tattva Chintan Pharma, as we just highlighted at the start of the show, is now up 10% as we speak, as is Quick Heal. Quick Heal is now up 9%. It's going to report results today, so keep an eye out on Quick Heal as well. With that, we take your leave on this edition of Trading Hour. From Sonalmi and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Co-powered by SBI. Best है सबको पता है.
Stocks swing back up after 2 down sessions, with the market breadth turning distinctly positive. Realty, metals and FMCG lead the charge.
Tech Mahindra's growth picks up and profitability sees a marked improvement. But while the IT major reiterates its guidance for FY26, it tempers growth expectations for FY27.
Hyundai Motor India elevates COO Tarun Garg to MD and CEO from Jan 1st, 2026, making him the first Indian to lead the South Korean automaker. This even as Hyundai plans to invest 45,000 crores till 2030 on product R&D and capex, eyeing 1.5 times sales by 2030, with margins in the 11 to 14% range.
Persistent Systems delivers a near-perfect quarterly show after outperformance on both revenue growth and margins. It also guides for further margin expansion and reiterates its $2 billion revenue by 2027 ambition. The stock jumps in trade. Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Ekta Batra as well. Ekta, good afternoon, and it's surely a good afternoon coming in for the markets as well. 25,300. Nifty's come back to that mark. Sustaining this level is something that we're keeping an eye out on. 0.6% of gain there. Broader end of the market, that's also doing well today. So more than 1% of gain. So not much of a worry in terms of portfolios that come in as well, because broader end is doing well.
Hi, Vinny. Yes, absolutely. You know, the Nifty's reclaimed 25,300, and what we are seeing is all-round gains. We're seeing gains come through in terms of all of the sectors at this point in time, and the market seems to be rewarding good earnings. So, for example, we have Persistent, ICICI Lombard. Both of these stocks have surged anywhere between 5 to 6% at this point in time. So, a lot taking place in terms of the PSU banking space as well. So, just watch out for that, because yesterday we did see the sign. We said we saw the PSU Bank Index, in fact, end in the green in yesterday's trading session. So it's really building on gains in today's trade. So up around 1.5% on hopes with regards to possibly a government consolidation plan. But nonetheless, we do have our movers and shakers segment where we track a whole host of stocks which are buzzing in trade. And first up, we have Rima joining in on TechM. The company's FY27 goal is of revenue growth, which is higher than peers, with EBIT margins of around 15%. Rima's here with me.
Indeed. So while the company did reiterate the broad FY27 growth numbers, growth expectations, and it did well in Q2, the stock could be lower on account of, the fact that in FY27, growth is not going to be great. In fact, the company themselves lowered expectations for FY27. What they said in the press conference is that FY27 to be better than FY26 from a revenue growth perspective, but the revenue growth rate will be slower than the earlier expectations on the back of macro uncertainty. Also, the company analysts point out that, for the company to achieve industry-leading growth in FY27 appears to be a bit challenging. So CLSA says, and I quote them in the report, the bigger ambiguity is around the company's ambition to grow higher than the peer average in FY27. FY26 revenue growth seems to be in line or lower than peer average. BofA expects the company to do flattish growth this year and just about a 3% growth next year. On the margin front, though, the analysts like the progress. CLSA says the EBIT margins today are 12.1%, and getting to 15% does not seem very arduous. For the full year FY27, BofA expects EBIT margins at 12.7% and an expansion compared to the 12.2%. So the margin performance is fine. It's just that on the revenue growth, FY27, it just appears that the company has toned down certain expectations, and that could be weighing on the sentiment today.
Okay, Rima, thank you so much for that. Surely keeping an eye out on TechM. But Ekta, you're keeping an eye out on Thyrocare as well, and this is after its numbers, right?
Well, yes, I'm looking at Thyrocare because it reported what was a good set of numbers this time round. So I'll just take you through what they reported. The revenue was up around 22% on a year-on-year basis, and it was a 12% growth on a sequential basis. We had margins which expanded to around 33% versus around 27% year-on-year and 30% Q-on-Q, and the profit was up around 80% year-on-year and 25% sequentially. Now, the main bread and butter business, which is basically pathology business, saw 24% growth year-on-year to 202 crores. Franchise revenue, which is basically opening franchises on the Thyrocare name, was up 20% year-on-year. The company, remember, is also debt-free with a net cash of around 190 odd crores. What also enthused the market is that the company is going to be issuing bonus shares at around a 2:1 ratio and has declared an interim dividend of around 7 rupees as well. So all-round positivity which is coming in for Thyrocare. But let's go back to Rima, because she's looking at Persistent Systems, which has gained over 6% after its Q2 numbers. Rima, tell us more.
So, you know, JM Financial calls Persistent's quarter a near perfect quarter. Nomura says it's an all-round performance in Q2, while CLSA has a high conviction outperform rating on Persistent. Now, the company's done well. It's beaten expectations on revenues and margins. Revenue growth is 4.4%. And if you look at the dollar revenue growth, it's been above 3% for 22 straight quarters. That's phenomenal consistency. Margins too have expanded by 80 basis points to 16.3%. The company is guiding for 100 basis points margin expansion this year, FY26, despite the wage hike which kicks in 1st October, and another 100 basis points expansion in FY27. Brokerage view is positive to neutral. So the bullish calls are from JM, CLSA, Nomura, HSBC have a hold neutral call, and Ambit has a sell call on the stock. Now, the reason why Ambit has a sell call is because valuations are on the higher side for Persistent, and according to their calculations, close to about 42 times forward multiple. But CLSA likes the story because this is a company, according to their calculation, growing 29% EPS over FY25 to FY27, and JM Financial likes the consistency.
Okay, all right, Rima. Thanks very much for that. Well, we now have Upasna, who's joining in on Cyan DLM. The stock is under pressure. She's here to tell us more. Upasna.
Well, overall, it was a weak quarter for the company. Revenue and PAT missed the street estimates, but margins were largely in line with what was the street estimating. Now, coming to the revenue first, it stood at 311 crore with a degrowth of 20%. Now, this revenue growth was impacted by completion of a large order, is what the company has indicated, and the defense segment saw a Y-on-Y degrowth of 90% due to a large order completion, which is why it impacted the overall revenue of the company. EBITDA stood at 31 crore with a downtick of 1%, but EBITDA margins saw an uptick of nearly about 191 basis points at 10%, which was largely in line with the street estimates. Now, EBITDA margin mix was mainly skewed towards the company's aerospace division, which now stands at 37% of the overall sales. Now, coming to the PAT numbers, mind you, this time there was a one-off this quarter of nearly about 9.5 crores due to the other income gain, which is why the normalized PAT is perked up. But if we look at the PAT numbers correctly, it stands at 12.6% crore, which is down nearly about 18%. So in terms of order book, if we see, the order book has seen a growth of 16% on year-on-year basis and a sequential growth of 7%.
Okay, Upasna, thank you so much for that. But on that note, we're actually going to slip into a very short break. We'll get you more on the markets and focus on RBL Bank as Emirates NBD eyes 60%.
Welcome back. Well, for the markets, it's a good day, you'd have to say. So the broader markets are showing much more momentum. We have the Midcap index, which is up around 1% and maybe we should pull up the small cap index for you as well and see how that is doing as compared to the Midcap. So the BSE small cap index should come up for you. Just about showing gains of around 0.6%. So a little bit of an underperformance as compared to the Midcaps at this point. The advanced decline ratio is an absolute opposite performance as compared to yesterday, where it was a complete dismal performance in terms of advanced decline ratio. So today it's clawing back. It's at around 2:1, 1,860 odd stocks advancing to around 944 stocks declining on the National Stock Exchange. But let's talk about specific stocks then. RBL Bank is in focus. Sources say Emirates NBD is eyeing around a 60% stake after factoring in the mandatory open offer. Ritu brings in more details on this important story. Ritu.
After Yes Bank SMBC, now we understand Dubai's Emirates NBD bank is finalizing a landmark deal to acquire majority control of RBL Bank, which will mark one of the largest foreign forays into India's private banking space. And the deal could be announced very soon, in fact, in the next few days itself. Remember, the bank is going to report its earnings this Saturday. So we could hear about this as early as that itself. Now, there has been this has been widely reported that the two have been in talks and that Emirates was eyeing a minority stake in RBL, but our sources indicate NBD, the second largest lender in the UAE, is going to announce a deal to acquire as much as 60% stake in RBL Bank, which will include the open offer component that, of course, gets triggered when the acquirer buys more than 25% stake in a company. Now, we further understand NBD plans to acquire this controlling stake through a fresh equity issuance by RBL Bank, which will be done through its wholly owned subsidiary. Now, this is important because the entire investment is going to be then directly infused into the bank, and also because RBL Bank's current foreign shareholding, if you look at it, it stands at more than 22%. So the fresh equity issuance to NBD is going to expand the overall capital base of RBL Bank to ensure that their stake remains within the regulatory FDI cap of 74%. Now, our sources also indicate the transaction is expected to be priced, like you were saying, in line with, of course, SEBI's prescribed formula without a major premium to RBL's current market price. Now, the transaction cannot, of course, happen without RBI's blessing, and we understand this change of control has received an informal nod from the regulator. Formal submissions, of course, will be made once the boards approve this deal. Now, while RBI is not going to relax that 26% voting rights cap, our sources do suggest the regulator will offer a glide path to Emirates NBD, allowing it to gradually bring down its shareholding in RBL Bank. Now, for Emirates, of course, which operates in India through its 3 branches, the acquisition will significantly deepen its footprint in one of the top banking markets. And for RBL, of course, a globally recognized institution, massive capital infusion, and long-term ownership clarity.
Absolutely, Ritu. Thank you so much for that. But Sudarshan, RBL Bank stock also has doubled in 2025. What are the brokerages saying now?
So it's been one of the stocks of 2025. It's almost doubled this year, and in the last 3 months the stock is up almost 35%, and now seeing the today's move, currently it's up almost 4%. Now the stock has moved to the highest level since March of 2020. Now Ritu has given you the reason that why the stock has been moving higher for the last few months. Now, apart from this, if you take a look at the June shareholding pattern, there was a sharp increase in the stake of both mutual funds and FPIs. Mutual funds had increased their stake to almost 30% from around 15%, and FPIs had increased their stake to almost 17% from 14% that they held in March quarter. Now, brokerages also have come out with some notes, and these notes are mainly on the back of reports related to Emirates NBD's plan to buy stake in RBL Bank. So Citi has maintained buy call with a target of rupees 300 per share. It says ownership transition may mitigate near-term ROE dilution risk that RBL might have faced. Also, if Emirates decides to acquire 51% stake, there might be an infusion in the range of 18,000 to 19,000 crore. And if Emirates acquires 60% stake, infusion might be in the range of 21 to 22,000 crore. Also, infusion would lead to a 5 to 10% book value accretion near current market price. CLSA maintains hold call and target price is rupees 260 per share. It says ROA could expand by 25 basis points to 1.2% if this deal happens, and also ROE would likely remain unchanged at only 10%, and it would increase FY27 book value per share by 8% to rupees 318 per share. But after this recent move and all these things have happened, interestingly, in the last 4 months, out of all the trading sessions, in the 90% of trading sessions, the stock has been in the F&O band.
Okay, all right. Well, definitely a stock which is very closely watched at this point in time. RBL Bank is the one that we're talking about. But now let's go across to Vivek, who has a whole list of all of the stocks that are buzzing around and moving around at this hour. Vivek, over to you.
Well, it's midday, and clearly when you're looking at the advance decline ratio, clearly in favor of the advances and more number of gainers compared to laggards. Well, one particular sector clearly that's seen a bit of a comeback is the Nifty Realty Pack, almost 3.5% higher, and all of the constituents on the Nifty Realty Index doing very, very well. So have a look at Sobha, Godrej Properties, Lodha Prestige, good pre-sales numbers as far as Q2 is concerned, and strong outlook as far as the rest of the year is concerned. Most of the stocks doing quite well. RBL Bank, well, our colleagues Ritu as well as Solution spoke about it at the day's highest point. News and software, within the mid-cap IT pack, a whole host of stocks doing quite well after encouraging results, and Newgen on very strong volumes up quite significantly in the session today, almost 5% higher. And IREDA, day first day the company came out with its results, a good set of numbers, and today some follow-on buying seen after a brief intraday dip. On the other hand, quite a few stocks seeing some amount of selling pressure. BLS International, day first day down almost 11% today, some more follow-on selling seen. The MEA has barred the company from going ahead and for the next 2 years participating in any tenders. Also look at MapMy India, last couple of trading sessions up almost 20-25%, cooling off a little bit in the session today. And Scient DLM, a muted set of numbers, both top line as well as profitability, missed estimates, and order book too slightly muted on the back of that, almost 5% lower is Scient DLM today.
Okay, thank you so much for that, Vivek. We'll keep an eye on these names in the second half of the trading session as well. But let's move on to our Inside Edge segment then. And Yash will now focus on ICICI Lombard, which has been surging in trade. A good set of numbers that the company reported. More details with Yash.
Well, absolutely. As far as the stock is concerned today, seeing a very, very strong surge as far as today's trading session is concerned. And three important reasons for that move in the stock today. One is very strong performance coming in the second quarter when it comes to most of the parameters. Second, the weakness in some parameters, in a couple of parameters which has come, the weakness is a lot less than what the market had expected. And third, both these first and second factor coupled with the stock not doing anything in the last 3 months. I'll start with what has done very well for the company in the second quarter. The net earned premium, that has seen a strong growth of about 12%. Operating profit, that has grown by 13%. Finally, the profit after tax growing by 18%. In terms of segmental performance, both motor, retail health and group health have performed very well. There's a strong momentum in both these counters. Motor premium growing by 10%, retail health up 50%, group health growing by 15%. Now, the weakness is a lot less in some counters as per market expectation. Underwriting loss, that increased just by about 10%, and combined ratio went up by nearly just about 100 basis points, came in at 105.1 versus 104.5. As I said, strong growth in most parameters, lot less, the weakness is lot less in certain parameters. That coupled with the stock not doing anything in the last 3 months. In the last 3 months, the stock is in fact down 8%. Last 1 month, the stock is down 2%. So of course, the stock has been under pressure, and that, getting a strong push with the second quarter results coming in on a very strong footing today.
Okay, all right, Yash. In fact, let's listen into what Gopal Balchandra, who's the CFO of ICICI Lombard, had to say.
I think if you look at the combined ratio that we reported for quarter two, again, I'm just looking at it on a like-to-like basis for ease of reference. The quarter two of this year, the combined ratio was about 103.9% on an N basis. This number in quarter two of last year was about 104.5. So directionally, I think what we have been able to exhibit is an improvement in combined at a company level, and therefore the trajectory that one expects is also to continue to see improvement in combined playing out for ICICI Lombard. I think what we'll be kind of looking for is to try and see if we can get an alpha or a growth higher in the range of 100 to 200 basis points. I think that's what we would kind of largely be kind of working towards. But more importantly, obviously kind of staying focused on delivering profitable growth. and sustainable return on equity.
That's all about ICICI Lombard as of now, managing to hold on to gains of 8 to 9%. But on that note, we're going to slip into a very short break. But a quick programming note that we have coming in for you all. If you're looking for big bets and market themes for the festive season, CNBC TV18 Access gives you a direct access to Helios Capital's Samir Arora as he shares his winning market themes and actionable investment strategies. Ask your questions live on 16th of October at 2 p.m. Become a member today on the CNBC TV18 app or log on to cnbctv18.com access plans.
Welcome back. Well, let's get talking about the technicals of the market, considering that it's a good day of trade. Pritesh Mehta joins in to tell us what he's tracking this afternoon. Pritesh, hi, welcome to the show. 25,300 for the Nifty. What is the range that you suspect the Nifty would probably trade in for the rest of the week, and your call on it based on that?
Yeah, good afternoon. Thanks for having me. Now, see, I still hold on to my opinion, which I've been having since the month of June. These are the right time to look at index, look at the stocks, the stock pickers market. Since the month of May, Nifty is moving the range of 24,200, 25,500 and nothing beyond it. And after 6 months, we are still at the same range. Nothing much has changed. In last 2 days, we saw a bit of correction in market, bit of profit booking, but my customized index or even my my internals did not change much. In fact, the breadth of our market moved higher. So it tells us that there is strength in the market. Bank Nifty are outperforming continuously. Midcap this month has gone higher by 4.6%. So we have pockets of strength emerging. Apart from leadership index, some sectors are going well as well. So we had tires, we have real estate today. We have some PSU banks doing well. So it is setting up nicely for broader markets rather than index.
And Pritesh, afternoon, which are your picks that you're looking at in terms of trading strategies?
So yeah, the first one which we like is Adani Ports. Now the stock in the month of May 2025 gave a breakout about the downward sloping trend line on the pointed figure chart. Thereafter we have seen a series of bullish anchor columns. Now we can see ABC breakout in place. So we have buy for a target of 1600 and the stop loss would be around 1400. The second stock that we like is Poonawalla. It is a classic example of a stock which is in strong uptrend. The correction in this stock has been very shallow in nature since the month of Feb. And now what we have seen the bullish anchor column, and now we have witnessed it follow through also. So buy for a target of 620 and the stop loss would be around 500.
Okay, Pritesh, keeping an eye out on those stocks as well. Thank you so much for joining us this afternoon and giving us insight in terms of markets as well as the stocks. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. On the other side, Manisha Gupta will be joining in with the chairman of a Gem and Jewelry Export Promotion Council to talk about commodities. Stay tuned in.
Welcome back. Joining us now is Kirit Bhansali, he's Chairman, Gem and Jewelry Export Promotion Council. Mr. Bhansali, hi, thank you so much for joining in. Happy festivities to you. And this is the time that the golds and silver really are glittering. We've called you on a day when gold has hit yet another all-time high. First of all, your sense on the gold prices, and is that impacting India festival jewelry sales at all?
Manisha, happy Diwali, first of all. On your opening remark that all-time high gold, so all the pundits are failing now. I'm doing this story with you since last about a month. This is my third meeting with you. But all the experts are failed. So now anything comment on gold is not wise thing.
I absolutely get that, Mr. Bhansali, because all those targets that were put out for 2026 have been all achieved in 2025 itself, and gold prices still continue to rise higher. But is it impacting, and how much is it impacting Indian festival demand right now?
Very much, Manisha. See, it's now out of anybody's pocket. The prices today has touched 1,27,000, and nobody knows where it is going to stop. So definitely it is hitting domestic market. Every consumer is waiting. They are very cautious. But even then, something is happening in retail store. I was talking to Malabar and Kalyan people. They are showing a slowdown about 15 to 20%. But now only 4-5 days left for the season. This price will definitely help retailers.
Mr. Bhansali, when it comes to exports, we've seen better numbers come in. And when you look at the previous month, there has been a 3% increase. I mean, at these prices, even with US tariffs, you've managed to be able to export in the positive.
Manisha, it's nearly about 4%, 3.75 plus. Okay. It's nearly. So the rest of the market which we are exploring is supporting us. Although US is down by good numbers, but we're receiving support from various markets. And that is the result that we have increased 4% in this September month.
Oh, well, absolutely. Mr. Bhansali, when it comes to exports as well, what other countries are we looking at right now, and how much is the US down by?
The US is down by 40% plus this month. Yes.
And what other markets have done well for you?
UAE, Netherlands, UK, all the markets are showing little agreement.
Just coming back to the Indian markets yet again, when it comes to diamonds, how have you seen that industry do? Because there were concerns on whether or not this Diwali could be positive for this as a segment.
I tell you, the reason of diamond doing well is because of the high price of gold and silver. So people, consumers are shifting to buy diamond. Diamonds are stable. In fact, if you compare to last quarter, the diamond prices are little bit reasonable, 5 to 10% cheaper than last quarter. So the consumers are shifting their buying in this festival from gold to diamond. So we are seeing good increment in diamond selling.
Going forward, as a jewelry industry with where the gold prices are, diamond, as you said, is stabilized, even seen a bit of a decline. How do you see the industry approaching this kind of change, a dynamic one at that going forward?
You talking about domestic or exports?
Both ways.
See, domestic looks very dicey because of this continuous rise in gold and silver. Consumers are very confused, even the retailers are confused. But I see a good demand now in diamond with our continuous promotion activity going on and people's interest also. So I see the good market in diamond jewelry in retail.
That whole story that the GST cut would perhaps get in more money in people's hands and you could see a spend coming in, is that playing out? It is playing out.
Yes, that is also one of the factors. Yes, you can count.
Also, Mr. Bhansali, you recently have had an MOU or agreement of sorts with the Maharashtra government about the Gem and Jewelry Park. What is it about, and how are you moving forward on that?
That's a good news for the state of Maharashtra. That's a good news for the city of Mumbai. It will be a game changer. I met Maharashtra Chief Minister, and day before yesterday I met Uday Samant, also Industry Minister. They both are so confident and they're offering every day something new for this sector. Their ambition is to make this city and especially Maharashtra the hub of jewelry. And they've taken a number of steps. I must congratulate them.
How do you see that progressing? I mean, is it over the period of 3 to 5 years as we go ahead from here?
Yes, as we are starting this new jewelry park work within 15 days, immediately after Diwali. And we have seen good response also in this upcoming jewelry park. The offers given by Maharashtra government is a great attraction for the jewelry park. A lot of people are coming across India to invest in this jewelry park. They are setting up their factories. We are talking with the top players like Malabar, Kalyan. All have shown their interest. So it's a rosy picture.
All right. Well, absolutely. As you said, Maharashtra or Mumbai, for that matter, could be the hub of jewelry. And there's a jewelry park coming in, which perhaps would be the first in the country. Mr. Mansali, thank you so much for joining in. But before I give you over to you, Vinny, I want to get the gold prices on screen, because as we are talking, these are all-time high prices. I mean, these are the prices that the market has been talking about for the next year. But as we stand at $4,200 an ounce, this is a record. This is an all-time high price yet again. And a psychological level, clearly, because 4,100 people thought is a level we perhaps would not see before Diwali. But there you have it.
Before Diwali is... there's no time to go and buy, right? Diwali time shopping. I don't know. It's just becoming more and more expensive.
How much is demand down?
So as he said, demand is down anywhere between 15 to 20%. But that's really coming in from various areas. But the expectation really is, you know, as everybody continues to say, our salaries or our money or wealth creation hasn't gone up by that way. But then again, institutional buying, HNI buying, family houses are really buying gold, and that really seems to be supporting it. So we started this year with $2650 an ounce. We're trending at $4,200 an ounce. I mean, that's almost a 60% of a jump up that we've seen in gold.
Absolutely. Maybe next year would be a year of consolidation.
I really hope so.
So maybe it becomes a little more, affordable with the time correction. But thanks very much for joining in, Manisha, and taking us through that conversation. So yes, gold continues to be the big topic, possibly superseding equities in terms of a topic of discussion for the year. We'll take a short break, but we'll get you more on the markets and a lot of stocks in focus. So stay tuned for that. There's some news on Paytm as well. We'll try and get you an update on that. Stay tuned.
पड़े।
Welcome back. Well, for the markets holding steady, just want to point out a couple of stocks from the Nifty space which are standing out. So we have Nestle, which is coming out with its numbers. So that stock is up around 3.4%, doing well ahead of that this week. We have even a couple of others such as Asian Paints, which is holding up with a gain of around 2.3%. Just watch out for Infosys, which is also releasing its numbers this week. So that stock is down around 1% ahead of that. And we have IndusInd Bank, which will be releasing its numbers on this Saturday. In fact, we have a whole host of banks which will be releasing their numbers on Saturday. So it's definitely going to be a lot of focus on financials next week, or at least Monday, in terms of a results reaction. So overall, texture of the market looks good. We have the Midcap index, which is up around 1%, and the Bank Nifty up around 0.5%. But Diwali is just around the corner, and here's a glimpse of India's top market masters, Vijay Kedia, Sridhar Sivaraman, and N. Jaykumar, who joined Mangalam Malu for a Diwali music mehfil. Take a look.
The other asset class that I have been speaking about is gold.
Yes.
And there are a lot of skeptics in the market about gold. In fact, in the last 1 week, I've seen more skepticism on gold than anything else.
Are you really talking about skepticism in the gold? Because we hear, on the other hand, a lot of people actually saying, "Oh my God,
I buy it
gold,
here?
should I buy
silver
gold?"
So the people, I'm guessing that the people who missed out on the gold rally, they come out with, random data that, how gold has underperformed between 1980 and 2000. How gold is a very volatile asset class, and in most cases they sort of give out a dollar return number, whereas it is for the Indian investor, it is the rupee gold that matters. And as I've said many times, that gold actually is a store of value and also is a hedge against currency. People miss the hedge against currency. So if you go back to 1980, the rupee was 9 rupees. Today it is what, 85 rupees. So you've got a compounded return of what, 4 to 5% just on currency. So if I want to put it in a song, I would put it in this way. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल, महफिल ये नहीं तेरी, दीवाने कहीं चल, कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल.
Last 1 year, the Nifty has actually gained just about 4%. Gold is 60%.
Plus, yeah, 60%.
Silver
is,
I think, even
also, yes,
much higher than that. So you had a nice repartee to that. What was that?
श्रीधर भाई को ये बोलना चाहता हूँ भाई कि ठीक है, ये तो गोल्ड मैन है, अपने बोल्ड मैन है, तो मैं इनका बात का जवाब दूंगा कि ना चाहूँ सोना चांदी, ना चाहूँ हीरा मोती, ये मेरे किस काम के, ना मांगू बंगला बाड़ी, ना मांगू घोड़ा गाड़ी, ये तो है बस नाम के, लेता है शेयर ले बदले में सबके, लेता है शेयर ले बदले में सबके, ओरे साहिबा शेयर से सौदा नहीं.
क्या बात.
It's a nice contra to what
So the next 1 year, how do you foresee the next 1 year when it comes to earnings, when it comes to the macros, when it comes to micros? If I had to ask you to bet on a few themes and a few ideas, what would they be for, say, summer 2083 when we hopefully gather once again for a mehfil?
So I'd like to talk about 2 or 3 sectors. My number one sort of bullish case is for banking. I believe that when any economy reopens up or opens up for foreign capital, banking is the first space that will attract money. So I think NBFC consolidation, money coming into private sector banks, more and more deals like the Yes Bank kind of deals, I think we'll get to see and hear over the course of the next few quarters.
The ones that have fallen so far? Or?
I think it's not a question of fall. I think these are platforms that can't be replicated. Like NBFCs, there are infinite number of NBFCs in a manner of speaking. but there are a finite number of banking licenses, no new licenses to be given. So I think banking sector could attract disproportionate amounts of capital as people, especially foreign banks, come in to take stakes in the Indian context. I think that's going to be a big theme going forward.
Welcome back to Halftime Report on CNBC-TV18. Nifty as of now is at the day's highest point, 25,327. 0.7% of gain is what we're seeing coming in for the Nifty 50. Let's pull up the broader end of the market. The Nifty Midcap and Small Cap also is managing to hold on to gains. Nifty Midcap more than 1% of gains for the Nifty Midcap. Small Cap is also holding on to gains of almost 0.7 to 0.8%. PSU banks, that is something that has picked up pace, especially in the last 1 hour as well. Keep an eye out on that. But with that, we're going to wind down this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Co-powered by SBI. Best है सबको पता है. Co-powered by SBI. Best है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes and Hyundai Italian Collection designed for Sukoon.
Stocks swing back up after two down sessions with market breadth turning distinctly positive. Realty, metals and FMCG are leading the charge. Tech Mahindra's growth picks up and profitability sees a marked improvement. But while the IT major reiterates its guidance for FY26, it tempers expectations for FY27. Hyundai Motor India elevates COO Tarun Garg to MD and CEO from the 1st of January next year, making him the first Indian to lead the South Korean automaker. This even as Hyundai plans to invest 45,000 crore rupees till 2030 on product R&D and capex, eyeing 1.5 times sales by 2030 with margins in the 11 to 14% range. Persistent Systems delivers a near-perfect quarterly show with outperformance on both revenue growth and margins. It also guides for further margin expansion and reiterates its $2 billion revenue by 2027 ambition. The stock jumps. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia. The market's doing very well for themselves in midweek trading. The Nifty is now at last week's high of 25,330, and that is where the index finds itself in, almost 200 points higher now on the index. This comes on the back of 2 down days that it saw across Tuesday and on Monday. Managed to defend that 25,150 mark, which we were mentioning is the key. It closed closer to those levels yesterday as well, and it has now built on to those gains. The dip that came in earlier in the session has been very quickly bought into, and since then the index has continued to build on to those gains. Was doing well. The Nifty Bank was up around 200-250 points as well on a last check, but it is the Nifty Bank is also at the highest point of the day now, nearing 400 points worth of gains, nearing the mark of 57,000 as well. So that takes the index to around about 800 points away from its record high levels, which is at around 57,600. So good going for the Nifty Bank as well. And this move on the Nifty Bank is led by the PSU banks. The PSU banking index continues to move higher, as it has been the case over the last few weeks, and the PSU bank index now 1.75% higher there as well. So good going for the markets overall. Shifting back to earnings, it was 2 major IT names that were supposed to report results after market hours. Tech Mahindra and Persistent Systems both are reacting to their results. Reema is here to summarize both of those numbers. Reema.
Thanks so much for that. So Tech Mahindra, as you rightly pointed out, the numbers were fine. The quarter was good in terms of revenues and margins versus expectations. But the stock is struggling a bit. So one thing could be that the management seems to have toned down expectations for FY27. What they said is that FY27 will be better than FY26 from a revenue growth perspective, but growth rate could be slower than earlier expectations due to the ongoing macro uncertainty. Also remember, as a part of the company's turnaround effort for FY27, the company wanted to achieve industry-leading growth. The company maintains that, but analysts say that, it could be a bit challenging. So in CLSA's words, the bigger ambiguity is around the company's ambition to grow higher than the peer average. FY26 seems to be in line or lower than the peer average right now. And BofA too is saying that growth will be flattish for the company this year and just about 3% next year. But Persistent is the big mover today. JM Financial calls it a near-perfect quarter. Nomura says it's an all-round performance. CLSA says it's a high-conviction outperform rating on Persistent. So it's a top-line growth of 4.4% for Persistent. This marks the 22nd consecutive quarter where the revenue growth is in excess of 3%. That shows you the kind of consistency of profitable growth. EBIT margins have also expanded by 80 basis points. And not just that, the company is saying for the full year, margins will expand by 100 basis points and perhaps another 100 basis points expansion in FY27. And they also maintain their FY27 ambition or aspiration of achieving a $2 billion revenue run rate. CLSA expects Persistent to deliver a 29% EPS growth from FY25 to FY27, which is why it's that high conviction outperform rating. So shining. Persistent has been a very strong quarter. Back to you.
And it shows in the stock price performance as well. 7% higher on Persistent Systems. Reema, thank you for that update. Earlier today, we were joined by Gopal Balachandran, the CFO at ICICI Lombard. Listen to what he had to say.
I think if you look at the combined ratio that we reported for quarter 2, again, I'm just looking at it on a like-to-like basis for ease of reference. The quarter 2 of this year, the combined ratio was about 103.9% on an N basis. This number in quarter 2 of last year was about 104.5. So directionally, I think what we have been able to exhibit is an improvement in combined at a company level. And therefore, the trajectory that one expects is also to continue to see improvement in combined playing out for ICICI Lombard. I think what we'll be kind of looking for is to try and see if we can get an alpha or a growth higher in the range of 100 to 200 basis points. I think that's what we would kind of largely be kind of working towards. But more importantly, obviously kind of staying focused on delivering profitable growth and sustainable return on equity.
ICICI Lombard and Persistent Systems, the two positive earnings reactions of the day. The other stock that has been in focus all through the morning has been RBL Bank. Now, sources say that Emirates NBD is eyeing a 60% stake after factoring in the mandatory open offer. Ritu brings in more on this. Ritu.
After Yes Bank SMBC, now we understand Dubai's Emirates NBD bank is finalizing a landmark deal to acquire majority control of RBL Bank, which will mark one of the largest foreign forays into India's private banking space. And the deal could be announced very soon, in fact, in the next few days itself. Remember, the bank is going to report its earnings this Saturday. So we could hear about this as early as that itself. Now, there has been widely, this has been widely reported that the two have been in talks and that Emirates was eyeing a minority stake in RBL, but our sources indicate NBD, the second largest lender in the UAE, is going to announce a deal to acquire as much as 60% stake in RBL Bank, which will include the open offer component that, of course, gets triggered when the acquirer buys more than 25% stake in a company. Now, we further understand NBD plans to acquire this controlling stake through a fresh equity issuance by RBL Bank, which will be done through its wholly owned subsidiary. Now, this is important because the entire investment is going to be then directly infused into the bank, and also because RBL Bank's current foreign shareholding, if you look at it, it stands at more than 22%. So the fresh equity issuance to NBD is going to expand the overall capital base of RBL Bank to ensure that their stake remains within the regulatory FDI cap of 74%. Now, our sources also indicate the transaction is expected to be priced, like you were saying, in line with, of course, SEBI's prescribed formula without a major premium to RBL's current market price. Now, the transaction cannot, of course, happen without RBI's blessing, and we understand this change of control has received an informal nod from the regulator. Formal submissions, of course, will be made once the boards approve this deal. Now, while RBI is not going to relax that 26% voting rights cap, our sources do suggest the regulator will offer a glide path to Emirates NBD, allowing it to gradually bring down its shareholding in RBL Bank. Now, for Emirates, of course, which operates in India through its 3 branches, the acquisition will significantly deepen its footprint in one of the top banking markets. And for RBL, of course, a globally recognized institution, massive capital infusion, and long-term ownership clarity.
Ritu, thank you for that update. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now the festive season is here and all eyes are on jewelers this time as gold prices are making new highs every single day. Shilpa Ranipeta spoke to Titan's jewelry business chief Ajoy Chawla about the company's business outlook. Listen to what he had to say.
While Tanishq is the mainstream brand in the mainstream business, Mia has had the opportunity to take a different approach. And the innovation quotient out there, the non-fussy, let's say, jewelry that we are promoting. So Mia is doing very well. In fact, it's grown tenfold between in the last 5 years, and this year also it's continuing to grow.
Right.
So I think we are witnessing a good 60-70% growth in Mia. Of course, it's also come on the back of expansion. We've added a lot of stores last year, this year, and we continue to add. We're already, I think Mia already has 257 exclusive stores.
Right.
And Mia is also present in about 400 Tanishq stores because it's a sub-brand of Tanishq.
Correct. And coming back to the high gold prices, right ahead of the festive, in fact, in the festive season, we're there almost. How do you see this then impacting consumer sentiment and buyer? Do you expect the buyer count to decline, or how are you looking at offsetting that?
So I think in Q2, we were seeing buyers were spooked by the gold prices. Correct. And a lot of fence-sitters were there, and what happened was I think they held back their buying thinking gold prices will correct. Once festival has started, they are not seeing gold prices come down, it's gone up even more. There is a certain kind of FOMO. I think a lot of people who are fence-sitters have now jumped in.
Okay.
And the buyer stress which was there, which was extreme perhaps in maybe July, August up to mid-September, has started reversing, and in fact many more buyers are in the market now. So I expect festive to festive we should see buyer growth. We don't know. We still have a very critical week to go forward.
Right.
My sense is at an overall level, I would be surprised if buyer growth didn't come through in this festive period.
Now on to our special Diwali show. Here's a snippet from our conversation with Ramdeo Agrawal of Motilal Oswal Financial Services and his son Vaibhav Agrawal of Motilal Oswal Asset Management. Listen in.
So I think his patience and ability to sort of sit through for the long term, and I think he's very gentle with people. He has a way of interacting with people which makes them very receptive to him, which I don't find in many people.
I admire his that coolness, that calm thinking, very composed, and of course he knows compounding. So that's a big asset.
Sorry, which one?
He knows compounding well. I don't know if I can remind him ever.
Book currently on the bedside. What are you reading? Anything you're reading now?
I'm reading this book on commitment. Actually, it's written by ex-army generals.
Okay.
And it talks about the importance of having absolute commitment in whatever you're doing.
Okay. Ramdeji, book, current book?
So I'm reading a book called The Brave New Wealthy World.
Okay.
Very exciting book, written in 2003 by Edmund.
Okay.
It's out of print kind of thing, but amazing book.
One stock you wish you bought?
I had a lot of fun with a lot of stocks. What I felt like I bought. See, one of the regret for me is that between 2006 and 2013, sorry, 2004 and 2013, 9 years, including the GFC boom, it had gone into our head that the corporate should not buy stocks in their, what do you call, treasury. So 9 years I didn't buy stocks.
Wow.
Out of the cash flow. That has made us so poor is not funny. My balance sheet would have been at least double.
Babu, you have that stock?
Actually, if I had held, like for example, I had bought Group Finance, but basically I didn't hold it on for long enough. So I wish I had sort of held on to that.
So this is an interesting one. If there was a biopic on Ramdeo ji, which is possible going into the future, who do you think is best fit to play him?
Hold your breath.
Yeah, I think Paresh Rawal would sort of fit that role. I think because
that's a nice one.
Maybe because of his optics and also his ability to be both serious and hilarious at the same time.
Yeah.
I think he would represent him quite well.
A resolution for the new Samvat, anything?
Because of this book I'm reading, so I would like to take some of the ideas from there and maybe become more aggressive, a little more aggressive, or maybe some new business ideas will germinate. Definitely will give birth to some strategic change in my thinking about capital market and about the company.
about Motilal Oswal, the business itself.
Yeah.
Vaibhav?
No, I think yeah, just become a better investor and focus on getting maximum returns for clients. I think that would be the resolution.
And you can catch that full conversation today at 4:30 this evening. Take a short break. More news and updates on the other side. Welcome back. Now, in some noteworthy news, the Supreme Court has allowed the use of green crackers in Delhi and the NCR during the Diwali period. The court has said that the firecrackers smuggled into Delhi NCR may cause more damage than the green firecrackers and has emphasized the need for a balanced approach permitting celebrations without compromising the environment. The scale of firecrackers through e-commerce platforms has been strictly prohibited. Now, the court has directed police authorities to set up patrolling teams across the region to ensure that only permitted green crackers with QR codes are sold. And it's a double 100 now for the Nifty, above the mark of 25,350 where the index lies, and credit for that goes to the Nifty Bank yet again, and the Nifty Bank is now closing in on its record highs now, 400 points higher on the index, 56,900 for the Nifty Bank, 57,626 is the record high level for the Nifty Bank, 628 is the record high, so around about 700 points to go for the Nifty Bank towards its record high levels. We are awaiting major results. Axis Bank reports after market hours, HDFC Life will report anytime now, HDFC AMC, HDB Financial, a lot of important results lined up during the course of the day. Of course, IRFC as well, that too is set to report results later today. But with that, we call time on this edition of Business Lunch from me and the team. Thank you so much for watching. Midcap Radar on the other side.
Co-powered by SBI. Best है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes and Hyundai Italian Collection designed for Sukoon. Co-powered by SBI. Best है सबको पता है. In association with Aditya Birla Capital.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 News Online studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Hey, Vivek, good afternoon. What a rally and what a surge we have seen in the last couple of hours. Nifty is comfortably above the 25,350 mark. We are at the day's high. And the push continues, actually. The Midcap index is outperforming the benchmark with a gain of 1.2%. All the sectoral indices, they are in the green currently. But look at the move on Nifty Realty. That index is the top gainer today. We have a gain of around 3.5% on that one. The PSU banking index also is doing really well in trade today. But earnings, they continue to be in focus. Persistent Systems posted a stellar set of Q2 earnings, with the company beating street estimates on revenue and margin front. Vineet Desai, who is the CFO at the company, joins us now to discuss more in terms of the outlook as well. Thank you so much for joining in. Well, you've guided for 100 basis points EBIT margin expansion in FY26 and FY27. How will you get there? What's the glide path here?
2 years back, when we basically started this, we had stated that as we get to the $2 billion journey by FY27, we want to improve our operating margins by 200 to 300 basis points. At that point of time, we were roughly in the 14 to 14.5% range. Today, if you look at FY25, we delivered a 14.5% operating margin. This first quarter, we delivered 15.5. This quarter, we delivered 16.3. So we are roughly at 15.9 for the first half. What we have said is that this 200 to 300 basis point, if we just sustain what we are doing at this point of time, there will be 100 basis point of improvement over FY25. And as we enter FY27, we would like to see if we can improve it by another 100 basis points. So that's the 200, 300 basis point trajectory that we have been talking about. And at this point of time, if you look at it, the levers are pretty much what we have mentioned are out. We have seen our utilization continue to remain we are running a very tight shop. At this point of time, looking at the labor market, both demand and supply situation, we don't believe that we need to go and do any aggressive hirings in the market. We are hiring to the requirements. We are hiring just in time. We are able to deploy these guys immediately on business. And that's how the things are working.
Well, that's very important. But, when you're looking at the revenue growth in Q2, very strong revenue growth of 4.4%, led by BFSI, which was up almost 7%. Healthcare and high-tech verticals too have done well. What led to that? Along with that, has the demand environment improved, or it's better execution by the company, or any other factor? And how sustainable is the 4% plus run rate? How is H2 looking like?
Last 2 years, our growth was driven very heavily through healthcare life sciences. And that now is going through a consolidation phase. While it has grown up sequentially in this particular quarter, we anticipate that it is not going to grow at the same pace as it has grown in the last 2 years. But the more important part, banking financial services vertical, which has been a very, very important vertical for us, whereby we have made a lot of investment into leadership, on sales, all of those new relationships and logos that we have signed, we are now able to see the fruits of it. We are seeing a good amount of traction that is happening. We have been able to open up new logos and scale up our existing logos in North American region. We are now able to take that into European region where there is a focus. So all these factors and some of these investments that have been made over a period of time are yielding results. Needless to say, there is at least sentimentally, there is an expectation that the interest rates will continue to go down in US for next couple of quarters. That is a positive trigger for us. That will give a little bit of a credit uptake that will benefit the overall spending. But at the same time, let's be realistic. It's not that there's a sudden spend and sudden change in demand that is happening. That the environment continues to remain challenging. You have to do your hard work, and we believe our focus at this point of time is to keep our heads down, focus on our relationship, stay close to the customers, sign up what you can commit and deliver, and ensure that the delivery is flawless.
All right. So do you think BFSI will anchor growth for you? It's around 35% of your revenues today. Can BFSI contribution inch up to around 40%?
Yeah, it can go even better than that. See, if you look at it, our BFSI practice is roughly a $500 million practice. You know, if you look at the competition, many of the guys have actually BFSI practice equivalent to our overall revenue. So the total addressable market is quite large. And we believe that our focus on banking, financial services, wealth management, capital market companies within that, the sub-segment part of it is something very, very important for us, which we are now, whereby we have hired leaders, we have started doing our planning exercise in that fashion. Our targets are rolled out and looked out in that fashion. We are trying to look at this as a sub-segment that fuels the overall growth in the particular segment. So all of these things are positive for us, and that's what, you know, should lead down the growth.
Okay. Well, that's right. So you're saying that it could be slightly better, especially the BFSI part of the business. Now, getting back to the earlier questions on growth, is H2 looking materially better than H1, or will it be tough given the fact that seasonally Q3 sees furloughs?
See, at this point of time, what I can say is we don't give forward-looking guidance. But what we have said is our 2 billion journey by FY27 continues. In the last 22 quarters, we have delivered a consecutive sequential growth. Our order pipeline is very, very strong. The couple of deals that are in pipeline at this point of time look very, very promising. If we are able to strike them and happen it, we believe that this should help us in terms of continuing to maintain the momentum. At this point, unless until obviously any unknown event happens, which is not in any of our control, but we'll tackle that uncertainty as it comes.
Okay, all right. So that's what the word is coming in from Persistent. We'll continue this conversation, but we have to take a look at the markets. 25,360. So the surge continues actually, and I had to look at some of the names because there are major moves that we are seeing in the mid-cap part of names. Tatva Chindan Pharma, for instance, that stock has surged to levels of 13.5%. It started with this uptick of 6%, and that has continued to see higher levels. We have Prestige Estates. Some of these real estate companies are surging in how to 6% higher on Prestige Estates. It is heading to that 1700 mark on the stock price as well. Newgen Software is the other one which is on our radar as well. But let's get back to the conversation we are having with Persistent Systems. Thank you for waiting by patiently. Let's understand on the H1B visa issue. How many employees have you sent on H1B? Will you bring this down with the increase that we've seen in visa fee?
See, if you look at this is again before even the proclamation or even the current administration come into play. We have been reducing our dependence on H1B visas significantly over the last 60% of our hiring happens locally, mainly green card citizens, etc. That we look at it. Number two, we don't differentiate between an H1B and a local player. We pay the same amount of wages that are being given to it. Last, we have a good amount of inventory of people who are visa ready at this point of time and can travel. Our applications on H1B visa for this year from India are absolutely in the minuscule format. We are not actually making much applications because there is not much amount demand also coming up from the customers. So we don't believe at this point of time this H1B application fee proclamation that has come in that is going to have an impact on us for in the short to medium term. If tomorrow things change, we'll look at it. But at this point of time, we are well covered. We have a good amount of inventory of people available who can travel if the need arises. And also remember that the new fee is only applicable on new applications and new applications filed from India.
Right. So new applications filed from India is what will be impacted, especially as far as the new H1B visa application hike is concerned. So what is the total number of new H1B visa applications from India for you this year?
It's virtually in the low single digits. That's what the applications we have made this year.
Okay, would you also have a ballpark estimate of how much advanced AI contributes to revenue right now, the way HCL Tech did? Also possible to quantify the productivity benefit you're able to pass on to clients because of this? Okay, looks like we've lost that line, but thank you so much for joining in today. We'll try reconnecting, but for now, this is what the conversation looks like with Persistent Systems. The stock is higher by 6.5% as we speak, one of the big movers in trade today. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets, and we'll also get some technical trades coming in with our technical analyst.
Welcome back to Midcap Radar. Well, some selling pressure witnessed, from high levels on the Nifty auto index, so names like Maruti and a few other, stocks actually cooling off a little bit from the day's highest point. But our colleague Ria is standing by. She has a list of all of the stocks from the broader end of the markets that are making all the moves.
Well, yes, let's start off with the gainers first. Persistent Systems has popped up by 6% on the back of strong Q2 results. The constant currency revenue growth has been seen at 4.4%, well above estimates of 3.9%. The company has also guided for margin expansion of 100 basis points in FY26 and 27 as well. Ola Electric is also up by around 5% after reports have come out that suggest that the company is likely to foray into the energy storage market going ahead. Some other gainers today include Intellect Design, Newgen Software as well as Godfrey Phillips. Looking at the stocks on the losing side now, Tata Investment is down around 5% after rallying over 40% in the last 1 month. My India is also seeing cuts of 4% today after surging over 16% in the previous 2 sessions. BLS International is also down 3% today. It is continuing its fall, down over 15% this week after the MEA has imposed a 2-year ban on future tenders for the company. Bikaji Foods also down around 2.5% today after a 5% surge that was seen yesterday. And Tips Music is also down 2%, and this stock is down nearly 38% in the last 1 year itself.
All right, some interesting names there. Thank you so much for joining in, Ria, with those names. IRFC's numbers at the bottom of your screen. The net profit is up 10.2%. Net interest margins have come in at 1.55%. And the stock is on our radar. Let's do one thing. Let's welcome Shrikant Chauhan from Kotak Securities for a technical check on the market. Shrikant, good afternoon. It has been a one-way move on the markets, but we did see some selling pressure, a small one actually. Do you think we'll continue to see that? There could be some profit booking from the highs today itself. Okay, all right. Looks like there is some audio issue that we're facing today, but we'll of course get back to Shrikant in just a bit. For now, let's look at IRFC because the stock is doing well, up 1.3% as we speak. The net interest margin, okay, the stock has come off from the highs as well. It's acting absolutely in line with what the numbers look like. The profits are up 10% as we speak, and that is the reason why the stock is reacting. So revenue is down 7.6% as of now. Shrikant Chauhan from Kotak Securities is joining us now. Shrikant, what's your take on the next important levels to watch out for on the Nifty?
Good afternoon, Sonal. Good afternoon, everyone. So for Nifty, it is very clear that it has crossed its immediate hurdle of 25,330. And based on that, now the next level to watch out for would be 25,550, 25,600. In case if there is any correction, then I think now 25,150, 25,200 going to act as major support for the market. But the base part is that Bank Nifty as well as Nifty IT and Metal Index, all these major indices, they are participating in this current up move. And that's why we are of the view that we should be buyer if there is any correction in the market.
Okay, Shrikant, and what are your individual picks for the day?
Yeah, I would like to go with HAL from the defense space. Most of these stocks are forming some consolidation formation. We saw rally in the previous month, but in this current month, in last 10-15 days, we are seeing sideways sort of activity in multiple stocks. But specifically HAL, Hindustan Aeronautics, that looks very strong candidate to buy at current levels. The stock is forming pennant formation. Based on that, I'm expecting stock to move towards the levels of at least 5,000, 5,050. And we can keep a stop loss around 4750 for the same. The other stock on which we are bullish is from the metal space. Yeah.
No, go ahead, Shrikant.
Yeah. The other stock on which we are bullish is GMDC. And there also we are seeing rectangle sort of formation. Support is around 570, 575. So that should be the final stop loss for creating any medium-term position on it. But overall, we are expecting stock to move towards the levels of 660, 670. So Hindustan Aeronautics as well as GMDC should be on the watch list.
Take that point, Shrikant. Thank you so much for joining in and giving us those trades. We'll slip into a break now. When we come back, we'll get you more on the markets, focus on RBL Bank and Paytm. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Paytm is a stock on our radar, gaining in trade after it gets a double upgrade from Axis Capital. Gaurav is joining us now with the details of that report. Gaurav.
Well, yes, Axis Capital, they have upgraded the stock to buy rating versus what it was at reduce, and they have also increased the target price to 1500 versus what it was at 950, and they have a strong reason to do so. They believe that the large merchant payment players are actually entering into a strong earning season, and this is led by three reasons. First is that they are seeing healthy pricing movements across online and offline merchants. They are also seeing improving margins because UPI as a percentage of GMV is stabilizing, and share of the credit linked products it actually improving. And third is that the regulatory framework now it is being more clear. Amongst this sectoral tailwind, Paytm they believe is well positioned to capitalize from all these gains. At the same time, they also believe that the management is now focusing on the stabilization, and they are also looking for growth with new investments in new products. So that is the reason why they have upgraded the stock. In fact, they have also upped their EBITDA margin target almost by 33 to 46%, and this will be led by better payment margins, financial services which is scaling up, and tight OPEX. So that is the reason why they have upgraded the stock. When we look at the stock performance, the stock is also performing well. It has reacted. It's up more than 2.5%. So definitely watching out on this counter, and let's see how they perform specifically in second quarter.
Thank you so much, Gaurav, for joining us and giving us the reasons why Paytm is up today. As you can see on the bottom of your screen, cement company Nuvoco Vistas has delivered its results. It's a profit on the bottom line this time around versus a loss last time around. The stock has spared its losses. But moving on, RBL Bank, well, that particular stock, you've seen a news flow. You've also saw our colleague Ritu telling us that there could be a likely deal, including an open offer that could come in from Emirates NBD. Sudarshan joins in and he tells us what brokerages are making of this likely deal.
So RBL Bank has been one of the stocks of the last few months. If you talk about in 2025, the stock has almost doubled, and in last 3 to 4 months, there has been a gain of almost 35%. And after today's move of 3 to 4%, stock has hit the highest level that we have seen since early 2020. Now, several reports when we have reported today early in the morning and before also that Emirates NBD are looking to acquire majority stake in the company. It might be up to 51% or say even 60% stake in the company. Apart from this deal, if you take a look at the June shareholding, two mutual funds and FPIs both have raised stake considerably in RBL Bank. Mutual funds have raised stake to almost 30% from almost 15%, and even FPIs have raised stake to almost 18% from 14.4% that they held in March quarter. Now, brokerages have come out with notes on the reports related to Emirates NBD's plans to buy stake in the company. Citi has maintained buy call with a target of rupees 300 per share. It says ownership transition may mitigate near-term ROE dilution. That was a risk for the company, and 51% stake if Emirates acquires, there might be an infusion in the range of 18,000 to 19,000 crore. And if there is an acquisition of 60% stake, there might be an infusion in the range of almost 21,000 to 22,000 crore. CLSA maintains hold call and target is 260 per share. It says ROA could expand by 25 basis points to 1.2%, and ROE would likely remain unchanged at only 10%, but deal might increase FY27 book value per share by 8% to rupees 318 per share. Now, despite a big move that we have seen in the stock price, the interesting part is in the last 4 months, out of all the trading sessions, in the 90% of trading sessions, stock has been in F&O band.
That's right, Sudarshan. Thank you so much for joining us and giving us all of the insight as far as RBL Bank is concerned. Well, a couple of minutes ago, we did highlight and allude to the Nuvoco Vistas earnings. Just some time before that, we also saw the numbers of Tata Communication flash on the bottom of your screens. While the profitability has moderated both on a year-on-year as well as on a sequential basis, the company says that the data revenue growth this time around has been almost 7.3% on a year-on-year basis. And they say that the EBITDA margin for the data business has come in at 18.6%, which the company says has improved 140 basis points sequentially. Along with that, what they're saying is that as we enter the second half of the fiscal, we expect strategic bets to further enhance profitability as well as margin strength. So going forward, H2, they expect to be better as far as H1 is concerned. With that and with the markets doing very well, the Midcap index up over 1%. We call time on this edition of Midcap Radar. Your stocks when we return.
Co-powered by SBI. Best hai sabko pata hai. In association with Aditya Birla Capital. Co-powered by SBI. Best hai sabko pata hai.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Markets managing to hold on to that green 25,300. Comfortably above that mark, not much of a decline from the day's highest point is what we're seeing right now. So let's keep an eye out on that one. As of now, 0.7% of gain is what the Nifty is managing to hold on to. The broader end of the market, that's doing well. Nifty Midcap, more than 1% of gain for the Nifty Midcap. Keep an eye out of that. Small cap is also managing to hold on to gains of almost 0.8% in today's trading session. Now 0.7% of gain is what we're seeing. And obviously, because of this good performance coming in from the broader end of the market, advance decline ratio is clearly in the favor of advances today versus declines that we're seeing coming in. So keep an eye out on that. Advances, 1,000 stocks 1,800 stocks in the advanced side versus declines of around 1,000 stock. All the sectors today mainly are trading in the green except for Nifty Media. That's down 0.2%. Keep an eye on that one. Realty is the top sectoral gainer. Nifty Realty is the one also that we should watch out for in the trading session. A lot of movers that are coming in trade today is on the back of their numbers as well. Whether you look at an ICICI Lombard, Bank of Maharashtra, Persistent System, Tata Communications, that's the one also that has come in just a short while ago in terms of numbers. They're expecting profits and margins to improve furthermore in the second half of the year. So Tata Communication is also something that we're keeping an eye out on. But this is a show where we solve all those stock-related queries, and we're going to be doing just that with Asta Jain, research analyst at Hem Securities, as well as Saumil Mehta, head of alternate research, capital market strategy, Midday Asset Sharekhan. Asta as well as Saumil, good afternoon. Thank you so much for joining us on the show as always. Let's start with those queries, right? The first query for today we have is coming in from Raghvendra Rao, who's writing to us from Hyderabad. He's holding 450 shares of BSC. This is at a price of 2,617 rupees per share, making some bit of a loss here. Wants to know if you can add more shares for the long term or just continue to hold on to this. What should they be doing? Asta, afternoon, BSC, what are you keeping an eye out on? We had some updates that came in again also in terms of the expiry side as well. So what are we watching out for now?
Hi, good afternoon to everyone out there. Talking about BSC, we are keeping a hold on this counter and recommending even our clients to remain vigilant about the results. But right now, one can remain invested in this counter for the price target of 2,550 to 2,600 in the short term. Now, talking about the fundamentals of this counter, what we believe that there is a strong volume momentum, so which we have seen, and now the company is also gaining market share, and that too amid regulatory changes which is happening right now. So we believe that on the basis of the strong volume momentum with an increase in the market share and the company's focus is on the derivative segments also, I think that is also, we should keep an eye on how they will be going to perform in that segment. But overall, fundamentals are looking good to us, and hence we are recommending hold on this counter with a price target of 2,550 to 2,600.
Okay, so no adding, right now?
No, we are not recommending a add and on this point of time. Let it cool down and then make a fresh entry. Yeah.
Okay, Saumil, what's your view coming in on BSC, and good afternoon?
Good afternoon to everyone. BSC positive, long-term uptrend. In the short term as well, I think that it has taken support at 200 daily moving average. It has been trading above 20 and 40 daily moving average. Now, I think the next target for BSE is around 2,800 levels, which is the previous swing high. So looking good in the short term, even in the medium term. So I would say that long term, you can hold on for long term and medium term both.
Okay, can hold on for long term and medium term both. That's the word coming in there. So yes, continue to hold. That's the view on the fundamentals and technicals. Let's move on to the next query. We have Mohammed, who's writing to us from Chennai. He's holding 28,000 shares of IOC. Price is 75 rupees per share, making a profit on this one. Long-term investor wants to know the targets for the next 1-2 years, and does it make sense holding IOC now for 2 years? Asta.
Is looking good to us for the 2-year perspective, definitely. And we are recommending a hold on this counter, as well as buy on dip strategy can also be applied. Main reason what we are seeing right now that the crude prices are at a lower level. So that is really one of the factors for this counter to move in the northward direction, first of all. Secondly, what we believe that the cost optimization measures being taken by the company. So that will be helping the company. And now the company is focusing on strengthening its core business as well as, and aggressive capacity plans are also there for the company. And hence, I think that will really help the company increasing their share in the petrochemical space and the specialty chemical as well. So looking after and combining all these factors, I think it is a good counter to stay invested in at the current point of a time. Maybe buying on dip strategy can also be applied to this counter. My initial price targets are somewhere at around 185 to 200.
185 to 200 are your initial targets, and buy on dips is the strategy that Asta is saying. Saumil, what is the strategy that you would tell the viewer to keep now? 2 years, also the target that if you could give us.
Absolutely, I agree to Asta. My target should be almost the same. It has formed a basing out pattern and it has broken on the upside, high tops, high bottom on the monthly charts, weekly charts. great setup for a long-term, medium-term investment as well. In the very short term, higher tops, higher bottom, and a small flag pattern has been forming on the hourly charts. I'm expecting this to break on the upside. Stop loss would be around 147 in the medium-term outlook, and my targets would be about 180, 185 levels.
Okay, 180, 185 levels are the targets coming in there for IOC. Next query for today is coming from Venkat, who's writing to us from Sweden. He's holding 25 shares of Thermax. This is at a price of 4,700 rupees per share, making a loss on this one. Now, he is a long-term investor, wants to know if he can hold the shares or for the next 10 to 15 years. So there's no worry on that front. A very long-term view, Asta, for Thermax. Right now a loss, but what should they do? Should they add more?
There are reasons behind it that we have seen a fall in the stock prices, and the reason is, first of all, the muted revenue growth which this company has posted, and there is execution challenges is also there for the company, and hence we have seen that has now started impacting the growth of company. So I find these are some of the reasons that why we have not seen this counter performing so strongly. So now my idea here is to stay invested at least till the results arrive, because we are now into the result season. So let's wait for the result. Let's give this stock a chance. But overall, I believe that this stock is not looking very, very strong. So try to exit at the higher level, or wait till the results. So any one of these strategies can be implemented for this counter. Right now, fundamentals are not very much supportive for this counter.
Okay, fundamentals not too supportive right now for the counter. Wait for the results maybe and then take a decision as well. That's an option, or at a higher level is also something that you all can look to exit at. But Saumil, on the technicals, what are we keeping an eye out on now for Thermax?
Negative in the short term, in the medium term, both. The next level to watch out would be around 2980, 2980, and then if it does not sustain above that, then I think the next level would be 2500. So negative, low top, low bottom formation on the weekly charts, trading below 200 daily moving average for a very long time. So yes, exit would be my strategy.
Okay, exit would be your strategy on Thermax as well. Not looking too exciting on the charts. Let's move on then to the next query. We have Rohit Jain, who's writing to us from New Delhi. He's holding 50 shares of Zomato, or Returnal as we know it now, at a price of 260 rupees per share. Wants to know whether to hold or exit at the current levels. Asta, we have the earnings that are coming in as well tomorrow, I believe. So for Eternal, what should they do?
Remain invested, and we can see the price target of more than 400. So initially, I am keeping my price target of 410 for this counter. Now, talking about this counter, we all know that now the competition has started, showing its way in this space. But still, Zomato has a, edge. Why? Because their customer stickiness is something which I think will be there for this company, and that will help the company retaining the customer. So here, that is the major point which I'm liking about this company. And in fact, we are also expecting numbers to be on the higher side. So overall, idea here is to stay invested for the price target of 400 to 410.
Okay, and Saumil, your view for Eternal as well. 6 months, obviously, we've seen a very good run up, right, in the stock, especially 6 months up move. Now, should they continue to hold or exit at current levels?
Should absolutely continue to hold. Hold would be my strategy, but not fresh buying, of course. Very crucial supports around 320 for a medium-term outlook, and the 200 daily moving average, which is around 278. If you're a long-term investor, keep an eye on 278 levels, which is very crucial. But overall trend is up in the medium term, in the long term, both. So keep holding to it. 320 would be my trailing stop loss in the medium-term outlook.
Okay. Keep an eye out on those levels over there for Eternal. But on that note, we're actually going to slip into a short break. But a quick note for our viewers. You must have noticed there is the money control stock score just above the line graph that you can see coming in, right? Look at for Newton. It's given at 56. Now, this is a score that is assigned to each stock based on money control's multi-factor algorithm. And it is calculated by analyzing over 40 parameters, including both current and historical historical financial statements, price charts and technical indicators for each stock. Each of the individual parameters considered for a calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score and T factor score. Remember, this is not a buy or sell recommendation. Any investor, viewer is advised to carry out their necessary due diligence on their own or through a certified registered financial advisor for investment decisions. Welcome back to your stocks on CNBC-TV18. Markets and Nifty managing to hold on to about 25,300. So let's hope that continues in the last 1 hour of trade as well. But keeping it going with the queries, we have the next query for today that's coming from Naresh Reddy, who's writing to us from Bangalore. He's holding 1,075 shares of REC. Price is 397 rupees per share, making a little bit of a loss on this one. Asking whether you should hold or sell at the current levels. Astha, your view.
You are positive. Why? Because I think they have a hold their margins, and we believe that going forward also these margins will remain steady, and the healthy asset quality is what we find is there in the company. So that is also looking good to us, and the growth outlook for the company is strong, because what we have seen, in fact, their results of Q1 FY26 were also on the higher side, and that Q1 FY26 is always counted as a seasonally weak quarter. So even in the seasonally weak quarter, when they have posted strong side of a number, that makes a case to stay invested in this counter. Price target can be set at around 410, 420 odd levels. Remain invested in this counter.
Remain invested in REC. That's a word from Asta. But Saumil, what's the word coming from you? Given that the stock has seen a bit of a correction also in the last 1 year, what are the trends indicating more downside before it actually picks up?
I think in the last couple of months, it has been basing out around these levels, and this base out pattern, I'm expecting it to break on the upside. If we talk about in the very short term, I think it is positive. You can keep a stop loss around 364, and I'll be expecting the stock to go till 410. That is the 200 daily exponential moving average, which will be a very crucial hurdle. If it closes above this average, I think then the medium term trend will reverse to positive, and then the next targets would be around 450 and above. So I'll be positive in short term and medium term both. But conditionally that it closes above 200 daily moving average in the medium term outlook.
Okay, that's the word coming in there for the stock. Keep an eye out on REC and the levels. Let's move on and talk about the next query. We have Guru, who's writing to us from Bangalore. He's holding 8 shares of Tata Elxsi at an average cost of 6,016 rupees per share. That is Tata Elxsi. And the other one is Dixon Technologies. This is at a price of 6,415 rupees. So Dixon Technologies, they're making a good amount of profit here as well. Asta, he wants to know the future prospects of both these stocks. Tata Elxsi, obviously they reported their Q2 numbers as well, largely in line set of numbers. Revenue was good, margin slight bit of a miss. But Dixon Tech coming out with its numbers in a couple of days as well.
Yes, but there is one thing which need to be seen in the Tata Elxsi, and that what we have seen that the revenue growth was there, but from which vertical it was coming? It was coming from the media and communication vertical, because auto and healthcare verticals were remain muted on the growth front. Now, what happened in the media vertical also, we believe that there will be a challenges to sustain this kind of a growth which they have shown in the quarter gone by. And in the auto vertical, we all know that one of their top client was impacted due to the cyber attack. So I think H2 will remain a challenge for this company. This is what we believe. Although when we listen to the management, it says that definitely the growth will be higher than H1. But how much higher, we really need to see. So here, if the time perspective is more than 6 months, then the idea is to continue with this counter. And hence, our recommendation is for the long term. If someone has a long-term view on this company, then definitely they can remain invested in this counter. Now, talking about the Dixon Tech is looking good to us. But we believe that their quarterly results will also be coming on the higher side. So I think definitely one should remain invested in this counter, because results are now coming. So one can take the view after seeing the results also. Right now, remain invested in this counter.
Okay, remain invested in the counter. That's the word coming in for Dixon Tech. Saumil, your view for both these on the charts, Tata Elxsi as well as Dixon Technologies. What should they be doing?
Let's start with Tata Elxsi. Tata Elxsi negative, trading below 200, below 20 and 40 daily moving average. I'll be expecting this stock to retest the previous swing lows of around 4,700 levels. Negative in the medium term as well. So exit would be my strategy from Tata Elxsi. Same with Dixon Tech as well. My strategy would be to exit at these levels and entry at lower levels. So I'll be expecting this stock to go down till at least 16,200 levels, which is a gap area where it left off long time back, probably 2 or 3 years back. There was a gap, and I'll be expecting that target to hit. So 16,000 levels would be the right time to entry again.
Okay. Keep an eye out on those levels over there for Dixon Technologies. Let's move on to the next query. We have Bala Subramanian, who's writing to us from Bangalore. He's holding 60 shares of Uno Minda. Average cost is 1,295. They're still making a loss on this one. Wants to know whether he and can add more at the current levels. Asta, your view?
Yes, one can add more, but not at the current level. Let it cool more and then start making or accumulating this counter. Now, talking about the fundamentals of this counter, fundamental seems to be on higher side. Why? Because we have seen that GST rationalization was there, and that this will give a boost to the industry as a whole. So definitely, the company will be a beneficiary for that. In fact, they have focus on the EV, and I think that focus on the EV and the growth, which is mainly related to the technology, will really going to take place in their quarterly results as well. So what I believe that this counter is well poised, being in the industry which is really gaining the traction right now. So one should remain invested in this counter, and one should start accumulating this counter, not at the current level, maybe at the lower level. However, price target can be set at around 1350 to 1400 odd levels for this counter.
Okay. And Somil, your view for Uno Minda, what should they be doing? They're making some bit of a loss here right now.
Absolutely. Uno Minda in the very short term trend is down. I'll be expecting this stock to go down till at least 1100 levels, which is 200 daily moving average, which is even at 1100 levels, there are a lot of multiple support zone there. So that will be the right time to buy this stock. My view in the medium term outlook still remains positive, and I'll be expecting the previous swing highs of 1375 to break on the upside, and probably the next targets would be above those levels. So medium term up, so buy on decline should be the strategy at 1100 levels.
Okay, that's a view coming in there on the technical front for Uno Minda. But that was the last query for today. So Asta as well as Samir, thank you so much for joining in with us on the show as always and helping our viewers solve all the stock related queries. And hope you'll have great festivities as well if we do not speak again before the festivities. But with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can always email us your queries on the email ID that's at the top of the screens for you all. So do send us your queries and we'll get them solved with our experts. Last hour of trade is still left. Don't go anywhere. You have closing bell up next.
Co-powered by SBI. Best है सबको पता है. Co-powered by LIC, हर पल आपके साथ. Co-powered by SBI, best है सबको पता है.
Beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng, 1% uptick. Taiwan Index, 0.6% of uptick.
The outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago.
25,330 is the upper level. 25,000 roughly is the downside level.
The Nifty opens at 25,175.
Bank should see a decent turnaround from a decline in profits in the current year to decent growth next year.
Dubai's Emirates NBD Bank is finalizing a landmark deal to acquire majority control of RBL Bank.
Staying focused on delivering profitable growth and sustainable return on equity.
JM Financial calls persistence quarter a near perfect quarter.
Obviously, very interesting time to sort of be part of the market.
We are above the 25,300 mark. The bigger question is whether we stay on to those levels or not. Nifty is comfortably above the 25,350 mark. We are at the day's high and the push continues actually.
Well, that was the day so far, and it's quite a turn in the sentiment. After opening flat, the Nifty and the markets actually are moving up and up. The Nifty's crossed 25,300. Midcap's up over 1%. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me, Ekta and Mangla. Hi, guys.
Hi, it's looking good for the markets right now. You know, we're above the levels that we saw on October 10th, after which we saw a bit of a decline right now.
25,330.
25,331, yes. And now we're above that. That's a good part. And it's been led by a lot of these consumption-led names. Yes, of course, Nestle reports its numbers tomorrow. Stock is higher ahead of that. Asian Paints on account of lower crude prices. The season is changing, festive season and all of that and stuff. Look at names like Bajaj Finance, up nearly 4% on that one as well. So consumer-related, consumer finance companies, discretionary names, all of them doing good. So it's feeling a lot better. And even on the market breadth front, you have nearly 2,000 stocks advancing for about 1,000 stocks which are declining. So that's a reversal that we saw from the last few trading sessions.
Hi, guys. Yes, definitely. And, you know, if you just move a little away from the equity market, you'll see gold shining and continuing to shine. So that's where the festive season is also probably, coming through. But interestingly, Manisha did mention that demand for gold is down around 15 to 20% in the festive season. But nonetheless, back to equities, the other big pocket which seems to be shining in today's trading session is the entire banking space. And it's not only the Bank Nifty, which is up around 0.5%. If you look at the Nifty PSU Bank Index, that is up around 1.5%. And you see a lot of these PSU banks which are higher in today's trading session. So case in point would be, say, a PNB or a Canara Bank or a Bank of Baroda, all of these stocks which are managing to see some amount of traction on the upside. So interesting day. We have earnings which are being rewarded, such as ICICI Lombard as well as Persistent. And then we have the banks which are also managing to gain on the upside.
You know, what's interesting is that in Europe, the French index is up 2.5%, and it's driven all by the luxury companies. So they have this Stocks Europe Luxury 10 Index, and that's up 6.2%. And the big mover is LVMH. They came out with the numbers. It's a good, better than what the street was anticipating. So LVMH, if you get that, I don't think we have the share price, but that's showing a jump of close to about 13%. Christian Dior, Burberry, Moncler, all these are surging in trade. So it's consumption, even in Europe.
And how aspirational,
it's all luxury.
The last couple of quarters for all these luxury companies weren't very good, and that's largely because of a couple of factors. It was the post-COVID luxury boom was trying to get settled in. So we saw a decline in LVMH share prices for about 2.5 quarters before that as well. So now on a low base and perhaps luxury demand catching up once again, China coming back as well should be factors that everyone's looking at. So it'll be very interesting to see how it goes. Though, LVMH, Christian Dior, Burberry, all these brands wanting to make a big foothold into India, but it's still China that drives most amount of revenue.
Absolutely, and you have to also consider the rupee depreciation as well. Everything gets expensive with the rupee depreciation.
For you, nothing is expensive. I don't buy any of that.
But in any case, that's a topic which...
But everyone's talking about that, how there is wealth effect in India because Indians have the maximum store of gold. So now that gold prices are up, if you read a lot of articles, they're talking about, Indians should feel a lot richer. The only difference is it's not used to spend.
Yeah.
It's just as a store of value. So in your head, perhaps you're going to feel it, but there is the wealth effect that people are talking about India as well.
Absolutely. Well, nonetheless, let's see who actually manages to monetize that gold that they have stored at home. But nonetheless, let's tell you, we have an action-packed closing bell coming up in the final hour of trade. Good day of trade unfolding on Dalal Street. The Nifty is comfortably perched above 25,300 levels. Mid and small caps mirroring the strength. Real estate and PSU banks are the clear outliers in trade today. Follow-up rally on RBL Bank following news around Emirates NBD eyeing a 60% stake in the lender. Both parties likely to have bagged a tentative Reserve Bank nod as well. Details of this CNBC-TV18 exclusive coming up in just a bit. Strong Q2 earnings sent shares of ICICI Lombard and Persistent Systems roaring in trade today. And what's aided those numbers? Detailed earnings fine print coming up on closing bell. And finally, we'll bring you the earnings expectations and what the street is penciling in for the likes of Eternal and Nestle in the quarter gone by.
Right, with that, how should you position yourself in the last hour of trade? Mitesh Thakkar from Bonanza Portfolio joins us now for closing strategies. Mitesh, it's been looking good for the frontline index, hovering around the highs that we made earlier in the month on October 10th, and the broader market's doing a lot better as well. So do you feel a lot more confident, or do you believe that a convincing breakout still hasn't happened?
Good afternoon. So, actually, I've been advocating that we will inch up higher, and the first target has been met. 25, 350, 400 is a zone, which is what I have been highlighting for the last few days. See, if you join the recent swing high, which was on the 27th of June, we got a closing high of 25,638 on the Nifty, and then on the 17th of September, the 25,423 was the high. If you join both the points, the trend line comes around 25,350, 380. So broadly, this 25,350, 400 zone is what I'm looking at as the first target. We've done that. But the structure of the indicators and averages is positive, which means that if not today, in a day or two, I think in the next 2 days, we should see a breakout beyond these levels. And once that happens, the Nifty should at least try and retest that 25,630 zone again, and then maybe even test higher levels. So the structure is very positive, maintain long positions. On the index, tactically, around this level, you might want to take some profits off if you get a pullback to about 25, 250, 280, re-enter. Otherwise, buy on a breakout beyond 25, 400. And on the stock side, I have two long calls. Lodha Developers and real estate stocks are doing well. So Lodha Developers is a buy with the stop at 11.59 for targets of 12.10. And LKI Mindtree, that's a buy with the stop below 55.49 for targets of 56.85.
Thank you. For that, we'll come back to you. Let's talk about RBL Bank. That's in focus. Sources say Emirates NBD is eyeing a 60% stake after factoring in the mandatory open offer. Ritu brings us more.
After Yes Bank SMBC, now we understand Dubai's Emirates NBD bank is finalizing a landmark deal to acquire majority control of RBL Bank, which will mark one of the largest foreign forays into India's private banking space. And the deal could be announced very soon, in fact, in the next few days itself. Remember, the bank is going to report its earnings this Saturday. So we could hear about this as early as that itself. Now, there has been widely, this has been widely reported that the two have been in talks and that Emirates was eyeing a minority stake in RBL, but our sources indicate NBD, the second largest lender in the UAE, is going to announce a deal to acquire as much as 60% stake in RBL Bank, which will include the open offer component that, of course, gets triggered when the acquirer buys more than 25% stake in a company. Now, we further understand NBD plans to acquire this controlling stake through a fresh equity issuance by RBL Bank, which will be done through its wholly owned subsidiary. Now, this is important because the entire investment is going to be then directly infused into the bank, and also because RBL Bank's current foreign shareholding, if you look at it, it stands at more than 22%. So the fresh equity issuance to NBD is going to expand the overall capital base of RBL Bank to ensure that their stake remains within the regulatory FDI cap of 74%. Now, our sources also indicate the transaction is expected to be priced, like you were saying, in line with, of course, SEBI's prescribed formula without a major premium to RBL's current market price. Now, the transaction cannot, of course, course, happened without RBI's blessing, and we understand this change of control has received an informal nod from the regulator. Formal submissions, of course, will be made once the boards approve this deal. Now, while RBI is not going to relax that 26% voting rights cap, our sources do suggest the regulator will offer a glide path to Emirates NBD, allowing it to gradually bring down its shareholding in RBL Bank. Now, for Emirates, of course, which operates in India through its 3 branches, the acquisition will significantly deepen its footprint in one of the top banking markets. And for RBL, of course, a globally recognized institution, massive capital infusion, and long-term ownership clarity.
All right, thanks a lot for that, Ritu. We'll just get brokerages on that in just a bit. But important news at the bottom of your screen, the EPFO chief has been defending their changes, saying that these changes will be benefiting members. Remember, there was a fair amount of uproar among, a lot of the salaried community on account of these changes. Our colleague Parak has been getting this information from the EPFO chief, who says that 25% minimum balance in PF account is to ensure substantial amount available with holder on retirement. More importantly, for concerns over, increasing the timelines, withdrawal timelines from 2 months to 12 months, they have kept a separate category called special circumstance in case of special circumstances where twice a year up to 100% of the eligible balance can be withdrawn. So that's not to be worried right now or fretted over. We'll get more details on that and perhaps an implication of this in just a bit. But that's important clarification coming in from our colleague who's spoken to the EPFO chief. But let's continue our discussion over RBL Bank. Sudarshan joins in. Sudarshan, the stock's almost doubled in 2025. The brokerages, are they expecting any of this deal making to actually change the valuation multiples that they're ascribing to the stock, or is just business as usual?
So before I talk about RBL Bank, EPFO chief lines that you are seeing on the screen, it's from the interview of the Timsy has done with EPFO chief. Now coming to the RBL Bank, the stock has almost doubled in 2025. And the move that if you've seen the last 3 to 4 months, it's up almost 35%. And following today's move of almost 3 to 4%, it has gone to the highest level that we have seen since early 2020. Now, Ritu has told you what's the reason behind the stock move in the last few months, that Emirates NBD is planning to buy majority stake. It might be 51% or 60% stake in the company. But apart from this report, if you take a look at the shareholding pattern also, in the June quarter, both mutual funds and FPIs had majorly increased the stake in the company. Mutual funds had taken their stake as high as to 29% from 19% that they held in March quarter, and FPIs had increased stake to almost 15 to 17% from around 13 to 14% that they held in March quarter. Now, brokerages have come out with some notes on RBL Bank following the reports related to Emirates NBD's plan to buy the stake. Citi maintains buy call with a target price of rupees 300 per share. It says if Emirates goes ahead and buys 51% stake, RBL might see an infusion of in the range of rupees 18,000 to 19,000 crore. And if there is a stake buy of 60%, infusion might be in the range of 22,000 to 23,000 crore. CLSA maintains hold call and target is rupees 260 per share. It says ROA could expand by 25 basis points to 1.2% with this deal if it happens, while ROE may remain unchanged around 10%, and this deal would increase FY27 book value per share by 8% to rupees 318 per share. But you have seen the big move in the stock price, but the interesting part is in the last 4 months of all the trading sessions that we have seen, in 90% of those, stock has been in the FNO bank.
Okay, all right, Sudarshan, thanks very much for that. So that's RBL Bank, just about touching around 300 odd rupees at this point in time. Gurmeet Chadha of Complete Circle joins in to discuss a couple of stocks this afternoon. Gurmeet, hi, welcome to the show. If you could just start by giving us a sense on RBL Bank. Have you looked at it? How much do you possibly hold in your portfolio? Where do you see it go from here?
Hi, we tactically entered the stock a couple of months back, considering that, and we also entered Federal Bank because these were the two banks available at around book value. RBI was actually below book value a couple of months back. If you see last quarter also, if you remove the treasury gains, the core PPOP has been pretty weak. Even there were more slippages in the retail credit card portfolio, which has been a bit of a concern. The positive news is the MFI portfolio seems to probably have bottomed out. So if a marquee investor comes in, over a period of time, nothing's going to change overnight, but you could see a bit of a re-rating in terms of the multiple of the stock. And that's the reason, the stock has moved up the way it has. But at some point of time, that a lot of good news may get factored in the price, and we'll see how the RBI approval comes in. But it's definitely positive for the stock, and they have been trying to now, increase stake in, the mix in commercial banking as well as the retail secured credit, which augurs well for future as well. So these are the two banks we do hold in portfolio, more for tactical reason and valuation catch-up.
Right, but what about the post-deal immediate decline? You expect there to be a bit of a profit-taking or cashing out as soon as the deal is announced? Because Ritu is also gathering that the premium may not be as high as what the street may be, factoring in.
Yeah, so I agree, Manglam. It depends on the price at which it happens, and because it's a higher stake, there will be an open offer. So we need to keep a watch on that. And sometimes, they say, buy on rumor and sell on the event which happens. So, as I said, a lot of the up move has happened in the stock, and near-term correction may happen if the price is lower. But as I said, if a marquee bank comes in, the rating multiple over the long term gets re-rated. So fresh investment may not be a great idea, but if you get better entry levels, and let's say Emirates finally makes it, might be just good to look at it again from a medium-term perspective.
Gurmeet, hi, afternoon. I think in the past you've spoken about ICICI Lombard. It's a part of your portfolio, I believe. Stocks done well post numbers. Time to add, or what should you do?
Yeah, so, I think insurance, both life and general, have been a bit of a laggard. Then there's been a little bit of concern on when the GST changes happened that insurance companies are bearing the brand. But off late, our channel check suggests that a lot of the disadvantages are now being passed on to lower commissions. And I've been a firm believer that, commissions are too high on insurance. You can't be giving 50-60% payouts on a lot of policy. Even some of the medical policies, the industry some of the new entrants have started giving 40-45%. I think it's not sustainable, not ethical. And if some rationalization happens, it's good. ICICI in particular, the total ratio has been improving. It was a few years back was 103, 104. Now it's getting closer to 100. In simple language, you want to make more money from underwriting than from investment income. So if it's below 100%, your underwriting makes profit. And these businesses have long gestation. Finally, the trends are coming, and it's also gaining some market share across categories. It's present across categories, and they were very timely in terms of reducing the crop insurance part, which had a bit of an impact on the profitability. So it's pretty solid. These businesses will not give you multi-bagger returns, but very, very steady stock to have in the portfolio.
You buy now? I mean, you own it because you got in at a lower price, but at 2,000?
No. So not adding any more, Rima. We own it for some time now.
All right, we take that point. You spoke about them gaining market share. In fact, earlier today, we spoke with the management, Gopal Barchandran, who also said that, they're likely to grow at least 100 to 200 basis points higher than what the market would grow. And the market by itself would, definitely exceed the 7% growth that we've seen in the first half in the second half. So if you put those numbers together, maybe 9 to 12% growth for ICICI Lombard. Let's hear him out.
I think what we'll be kind of looking for is to try and see if we can get an alpha or a growth higher in the range of 100 to 200 basis points. I think that's what we would kind of largely be kind of working towards. But more importantly, obviously kind of staying focused on delivering profitable growth and sustainable return on equity.
All right, we take that point. Gurmeet, before we move forward, you have a thought on IT, how the numbers have been so far versus the valuation, some of the mid-cap IT names, Persistent Systems, for instance, reported a good set. The stock's doing extremely well. We'll hear out the management as well. But before that, your call on it.
So I think you've got to differentiate, Mangam. I think HCL, in fact, reported a very good set of numbers. I'm surprised the reaction was quite muted. They have a nice mix now. The software business now, which they acquired some time back, that's actually a 24-25% margin, which gives a fillip to the overall margin. They, for the first time, reported the AI services vertical revenue separate. So it has a better mix compared to some of the larger IT names in terms of IT services, lesser exposure to US. Even on H1B, I think the number of live H1B they were talking of was some 3,500 or something. And last I had that conversation. So it looks good. Valuation is good. Stocks have been beaten down. So there could be a bit of a tactical bounce as and when the trade deal happens. Right now, I don't think so. Market is pricing any kind of a trade deal. So maybe from a tactical point of view, some good large IT companies and some of the better mid-cap names like Persistent, Coforge, maybe KPIT because auto is going through a bit of a rough patch, could make sense. But we are underweight right now. It's sub 5% in our portfolios.
Okay, well, let's stay with the IT space. We did speak to the management of Persistent Systems earlier in the day, so let's listen in to what they had to say.
See, at this point of time, what I can say is we don't give forward-looking guidance. But what we have said is our 2 billion journey by FY27 continues. In the last 22 quarters, we have delivered a consecutive sequential growth. Our order pipeline is very, very strong. The couple of deals that are in pipeline at this point of time look very, very promising. If we are able to strike them and happen it, we believe that this should help us in terms of continuing to maintain the momentum. At this point, unless until obviously any unknown event happens, which is not in any of our control, but we'll tackle that uncertainty as it comes.
All right, doing well for Persistent. That stock is up around 6% at this point in time. But Gurmeet, just wanted to come back to you and discuss how exactly would you be playing, this gold price increase or the silver price increase through specific stocks? Anything that you have in your portfolio and which you can share as an idea?
So we have Muthoot in our portfolio, and we were very timely in terms of entering into gold-based NBFCs. So that's played out reasonably well. And we, also started adding, because we also have a wealth management outfit, adding gold ETFs and some multi-asset funds on that side. And probably that helped us, covering this 14-15 month period, which has been a little flattish for the market. Other than that, we haven't really added anything. We also had a look at some of the gold mining funds, which are feeder funds internationally. So that's something we've been looking at. But because of the RBI restriction, there is not much allocation you can do. And in general, I believe that precious metals and commodities are in a good cycle, and these cycles are much longer. Only thing is, I think these days, I get 8 calls a day on asking views on gold and silver. Earlier, that used to get on small and mid-cap stocks 6 months back. So it's a bit of an, euphoria going on. So you've got to be a little careful in terms of not going overboard in this space.
All right, Gurmeet. Thanks a lot for that. We'll take a short break, come back, tell you more on the markets. We'll also have Rashi Talwar on the other side discussing market technicals and fundamentals. A bunch of stocks which are buzzing around right now. Hormaz, as always, joins in to tell us the top movers this hour. Hormaz.
Some interesting movers in the broader markets, and we'll start off with the PSU banks, because that's the sector that has been buzzing. The gains have been led by Bank of Maharashtra. It was down 5% yesterday after its results, but it's down up now around 8.5%, and over 8.5 crore shares have already been traded today. 20-day average of just 1 crore. Similar is the case for other banks like Indian Overseas Bank, UCO Bank. Over 1 crore shares traded well above their 20-day average as well. The other stock making a move today is Tattvachintan Pharma. We spoke about this earlier in the day as well, and it's only built on to those gains. 15% higher now for the stock, the biggest single-day gain since May. This is the 4th straight day of gains, and during this 4-day period, the stock has gained well over 20%. The volumes are the highest in 3 months. We've had close to 30 lakh shares that have now been traded. The 20-day average here is only 55,000 shares for Tattvachintan Pharma. So making a move on very strong volumes, and as a result of this 4-day up move, the stock has moved past its IPO price of 1,083 and has been a good performer so far in 2025 with gains of around 40%. But what is in very high spirits is GM Breweries, and the stock has been up in 9 out of the last 10 sessions, and these 10 sessions have produced gains of nearly 60% for the stock. Another 10% added to it today, and more than 3 crore shares have traded in the last 5 sessions for GM Breweries, and that includes today's session, which has close to 80 lakh shares that have been traded. The 20-day average is only 9 lakh shares. And this October month has resulted in gains of 56% for GM Breweries, turning out to be the best month since 2017. Incidentally, in the month of October again.
That point, Hormaz. Thanks a lot for that. In fact, for GM Breweries, this move has been backed by very strong numbers and, more importantly, favourable policy as well. The Maharashtra made liquor policy that was announced by the Maharashtra state does better for GM Breweries than any other listed stock. With that, let's go back to the big story, EPFO. That's gone ahead and eased withdrawal rules to ensure members can now pull out 100% of their balance, including employee and employer contributions. Timsi Jaipuria quizzed the EPFO top boss Ramesh Krishnamurthy to understand what do the new norms entail. Let's hear out that exclusive conversation. Timsi.
What was felt was that let us make it easy for people to access their own PF money in times of financial need, but at the same time protect their PF for their long-term social security requirements. As you are aware, India is a young country, but all the youth who are going to retire, who are now coming into the work, are going to retire in 2055, 2060. So unless and until we plan for proper social security protection in times of their retirement, then they'll have less of a corpus to be available. So that is why a concept of a minimum balance of 25% was visualized, and that has been kept away as a minimum lock-in balance. Rest of the 75% is freely accessible up to, so if 100% of that is accessible by the member, apart from illness, education, marriage, housing, there is also, we have kept a separate category called special circumstance. In special circumstance, up to twice in a year, you can withdraw up to 100% of your eligible balance. So the 75% is always accessible to you. Now, what used to happen earlier was that you could have withdrawn only small amounts towards illness or something like that. For unemployment, you were forced to take a final settlement. So anything more than 2 months that was available as unemployment, you would have had to exit your PF membership. What was happening was that we were finding that people were exiting their full PF membership. Therefore, what was happening is that they would wipe their entire PF balance completely and they would rejoin after some time. So what was happening was that they were losing out on a very important component, which is called pensionable service. So every time you have left a job, you joined a job and left a job, that is the period of service that keeps on adding to your pensionable service. If you have 10 years of pensionable service, then you are eligible for a pension.
Okay, and don't forget to catch the full conversation at 6 p.m. only on CNBC-TV18. All right, well, let's get Rashi Talwar in now, partner and portfolio manager at Ashmore, to discuss a little more on the markets. Rashi, hi, welcome to the show, and season's greetings as well. If you could just start by giving us a sense in terms of, a little bit of what you think the earnings season has started off with. Do you think, are you happy with the numbers that you've seen till now?
So, I mean, we've got just a very few set of numbers as yet, and essentially in the tech space, and I think their expectations were really beaten down. So what numbers we've got in are marginally better than what was expected, but they're really nothing to write home about. They're still pretty weak, and I think the guidance and the commentary by the companies tends to be about times that are really uncertain, and you can't fault them for that. So they don't know what's lying ahead. So I think from that perspective, the uncertainty for that sector continues. I think as far as a lot of the other sectors are concerned, and especially the domestic facing consumer sectors, people will pretty much look through this quarter, because a lot of the action that we've started to see is just very recent, last 2 weeks of September. And therefore, I think everybody's going to wait till the Jan set of numbers or the Q3 set of numbers to really start to see what's happening over there. So if you ask me, I don't think this earnings season is going to be significantly material from a market standpoint.
All right, this earnings season is not going to be significantly material, but I remember you having, among your top holdings, something like an Infosys, HDFC Bank, and Bharti Airtel as well.
We don't discuss our holdings, so I won't get into that, Mangalam.
All right, so let's
talk about sectors.
Let's talk about sectors. What have you made of, the IT results that have come by so far, largely because of this valuation, decline that we've seen there? Some people are finding comfort, and some saying perhaps the worst is over. How would you see that?
Yeah, the funny thing about the IT sector is that you have such tight earning estimates in most cases that the valuation numbers will now look the same for a bit. So, they're not going to change. The point is how much are earnings going to change, and you're just going to see the stock price react to that. So I think, honestly, people are going to wait for some kind of change in outlook or some kind of indication that there is an improvement in the business momentum, or there is confidence that the companies are seeing. Unfortunately, that's not happening.
Rashi, any changes that you've made to your portfolio since the last time we spoke?
So I think in terms of, I don't remember the last time when we spoke, but...
or just broadly in the last 2 or 3 months. I mean, the data points keep changing.
Since about March, we've gone underweight the IT sector. We didn't obviously have any idea Liberation Day was coming, but it worked out well for us. And we went, put that into the domestic consumer names and the domestic financial oriented stocks. And we have always talked about the large private sector banks being one area where we've been extremely positive. So we kind of reoriented the portfolio in March that way, and we've pretty much held it since then because it's played out reasonably well for us.
It's doing well. Domestic consumer names. In fact, Nestle is up around 4% in today, ahead of numbers. We have a bunch of others as well. But hold on to your thoughts, Rashi, because we're getting some visuals from our team, which is at the NSA right now for CNBC-TV18's Market Cafe. So we have both Nimesh as well as Nigel out there, along with all the market experts who are joining in shortly. So we will cut across to that as soon as the conversations begin. There you have a bunch of the market experts who are there in conversation with some of the top market voices. All right.
Okay, all right. So that's going to be a glittering event. That's a Diwali special, which you're going to get to listen to soon enough. But Rashi, just wanted your thoughts in terms of this entire GST cut. How do you expect it to probably play out in terms of companies, and by when? And how much do you think your portfolio is probably going to benefit from it?
I think you can't look at the GST cut in isolation. You have to look at the actions being done by the government and the central bank pretty much from the beginning of the year. starting with the income tax slabs. They've had, some of the states have given handouts to women below the poverty line. Then there was the announcement that the Prime Minister made for new joiners to the workforce. Now we've had the GST cuts. On the monetary side, we've had a number of stimulus rate cuts, risk weights lowered. We've had rate cuts, risk weights lowered, and the CRR cut, which is now coming into place, which is obviously providing a lot more liquidity to the banks to lend as well. So not only does there have to be demand, but there is a stimulus on the leverage side as well. So if you ask me, the GST cuts is probably one of the last ones we've seen, but there is a whole string of them. And
all right, Rashi, thanks a lot for giving us your views on the market. We'll keep coming back to you for a bit. Season's greetings to you and your teams as well. But let's cut across to Nimesh Shah and Nigel D'Souza, who are in conversation with some of the top market voices in Market Cafe.
Hello and welcome to this Diwali special Market Cafe Sambat 2082. I'm Nigel D'Souza, and with me, my co-anchor today, Nimesh as well. Well, Nimesh, it's been a difficult year for the markets.
Absolutely.
But we have an elite panel with us today.
Oh yeah. So happy festive greetings to you, to your family, to all the viewers, and to the distinguished guests as well. All our seasoned fund managers. Nobody needs any introduction. First question will be an open question to all three of you. Anybody can answer, or all three can answer. From last Diwali to this Diwali, Nifty is flat. The returns have been quite good. Did you all expect that India will be a rank underperformer in the last 1 year? And what was the key reasons for this underperformance? I'll start with Anish first.
So, well, two reasons for the underperformance, right? One is that earnings growth slowed down and multiples were to start with. And more importantly, there was a lot of supply of paper, right? So a lot of the argument last year, the people who were extremely bullish were making was that there's a lot of demand for paper. But what hadn't been anticipated was that there was a lot of supply for paper. So while the retail investors might be disappointed, the promoters, the private equity, the investment banking world has done quite well last year because they've managed to put out a lot of paper in the markets.
Vishnu, what's your take?
Right. I think part of the reason, as Anish also pointed out, is expectations are high, right? But we had also started getting into a zone where economic activity had kind of cooled off again. If you go back, say, about 12-15 months back, the Reserve Bank of India had kind of clamped down on lending into, subprime, MSME, etc. So that was one source of funding issues. And then you also had fiscally very little stimulus and support coming to consumption. Over the course of the last 9 months, I think a lot of those have kind of got addressed, right? But the relentless supply of paper and, of course, the curveballs of Mr. Trump and what he tweets on X, keeps us on our toes. So I think a combination of both of these is where the markets are where they are.
All right. Pankaj, I want you to come in it. Over the last 1 year, we have interacted numerous times. And you normally look at the brighter side of things. So could it be that sort of a pitch the last 1 year, which was bouncing around, it was turning, and yet we managed to hold our wicket at least? Do you think it's that sort of year? Because look at the challenges we've had on the global front, on the valuation front, on the paper front as well. So do you think India as a batsman has done pretty okay, given the kind of challenges in the last 12 months?
So apart from what Anish and Harish said, they spoke about domestic side. But we should not ignore that we have seen about almost $20 billion of FI selling.
Yes.
And that's because India was seen as an AI loser. And a lot of money from India flowed out to Taiwan, Korea, China. And there's an AI frenzy for the last 12-15 months, which is happening in the globe right now.
Yes.
In the midst of that, we had domestic challenges, as they said. And last, if you look at indices, they are not portraying the right picture. Indices may be down by 5-6% from their all-time highs. But when you look at the median constituents and the drawdown of those median constituents, it ranges between 50 to 25%. And when you speak to HNI, retail, their portfolios from an all-time high perspective are any which ways down by 20-25, which is the correct portray of the things. So I think along with time, I think you have seen price correction in the broader market space also. And from those challenges perspective, I think a lot is getting priced in now. And I think it is healthy. For a large part of the year, if you remember, Nigel, we were very cautious, saying that valuations are not making sense to us. From March, April onwards, we started to get constructive. And I think a large part of those concerns are priced in. Incrementally, I think we should front load our equity investments as you move ahead in the next 1 to 2 quarters, is my thought process.
Pankaj, you spoke about, AI has not been the big theme. In fact, India has been seen as an anti-AI. In that context, if globally there is an AI bubble, you think this year could be in a way a blessing in disguise for India that we are not in that AI bubble so far?
I think so. And all the data points are flashing absolutely red. We don't know the timing because markets always test you. It's 6 months, 12 months, 18 months. But look at the data points, just 4 of them. The concentration is the highest ever. If you plot the S&P 500, equal weighted index versus market cap weighted index, it's at its lowest point today. That means 490 stocks on one side, 10 stocks on the other side. It's always a risky part. The second is Nvidia is now 15% of US GDP. Remember 2000, internet was invented. People said Cisco is the only company which will provide hardware. It became 5% of US GDP. And from there, how many years that Microsoft took to come back to the original price. I'm not saying AI will not be there. It will be there for the next 15, 20, 25 years. But the financial market, I think, is pricing far more things. $10 million company getting a valuation of 20 billion. Last 4 years since ChatGPT was announced, you saw 80% earnings growth, 90% capex coming from AI companies. And there's just a frenzy going on. I don't know when the party will stop, but you need to be at the last door to get it out. I think in that respect, India could be a beneficiary where it's a diversified market. Look at Taiwan, TSMC is 55% of MSCI Taiwan, one stock index. Samsung, 30% of MSCI Korea, one stock index. So when this party will stop, I think a large part of that money will come into diversified markets, which are much more sustainable and structural in nature, which I think is India.
All right, Harish, let me come across to you. The other problem has been the FI selling, right? I mean, we talk about them selling $20, $23 billion just in the last 12 months or so. But if you look at the primary market, actually, they put in close to around $5 billion approximately. What about this IPO frenzy? Everyone talks about it, it's sucking some liquidity as well. But is most of that now a known devil? We had a couple of big IPOs that people were worried about, which have gradually got digested. And thankfully, getting into Diwali, at least those that got LG will be a little bit happy because at least it's giving some kind of positive rub-off, you know. Your take on this IPO frenzy as well.
Right, so India is one of the unique markets which globally is seeing a lot of new listings coming through. Most of the rest of the world, the IPO market is pretty much dead, right? So that is one unique aspect. The second unique aspect, especially in the IPOs that we are currently seeing, is that there are a lot of scale companies which are very, very differentiated, which was not there, even 6 months or 9 months back. So while yes, the number of issuances, etc., are large, the type of businesses that we are kind of encountering now are very, very new and do not have, in many cases, a parallel to what is already present in the market, right? Now, of course, valuations is in many cases nosebleed level, okay? But given the fact that there is something unique and differentiated that these businesses bring at scale, I would imagine that, you know, a lot of the legacy holdings of many FIIs, you know, which have been traditionally in the banking or the IT services, or maybe in the last 5 years, a lot of money has gone into the industrial stream, which has done very well. I think those will be the areas that, you know, people may want to kind of reallocate and move into this. So that is one key aspect that's coming through. The second key aspect is in terms of sheer number, just to put it in numbers, currently we are kind of selling, supply of paper is roughly about 2% of market cap if we were to quarterly annualize this number. This number, the last time we saw such huge numbers was in 2017, okay? And we all know how 2018-19, you know, we had to digest all of this along with expectations running very high in 2016-17. So I suspect that, you know, it's not that, you know, we are at the tail end of the IPO digestion problem. I think it will continue to be coming through in the course of the next 6-7 months, and which means, in my opinion, even though the fundamentals are stacking out much better, it does appear that it's going to be a grinding market. The sheer supply of paper is going to keep a lid on any kind of a very big kind of a move up. But we think that, there are markets when, consolidation is a good thing, because especially when the fundamentals are improving, and that therefore is a great place to allocate and to accumulate very good quality equities at this point of time.
Anish, my first question was on what went wrong and why India underperformed. You highlighted some of these concerns. Let me just ask you on the 4 big concerns, and you give your view. Are they behind? Is the worst over? What is it in terms of earnings, in terms of valuations, in terms of global headwinds, or whichever the key headwinds were for last year? Your take on all the 4-5 concerns, and are they now behind us? And what is the take now?
See, of these, the most important for me is earnings. Right?
Is earnings?
Earnings, right? I think earnings should pick up momentum. Okay. What had happened was that, one, the economy slowed down a little bit, and two, what we had seen, right, was that 2 years prior or 3 years prior, what had happened was earnings growth had outpaced revenue growth, which happens when capacity utilization is improving, you're getting operating leverage, and that obviously tapers off. So that tapering off also happened, and demand was weak.
So net on earnings, you're comfortable that now there is going to be
I'm reasonably comfortable on earnings. I'm expecting the economy to...
FY27 going to be a good year for earnings?
I think FY27 for large cap stocks should be a good year for earnings. Sure. Now, I would caveat that. Actually, what I worry about is that in the small and mid-cap space, there's a lot of paper that has come on the market, not just primary, but secondary also, which has come on the market with very poor quality of earnings. Right? Okay. If you look at the balance sheets of those companies, they've been, I feel, very flattered. Those earnings will disappoint, right? So I would not say that there's a uniform improvement in earnings, because the poor quality of earnings will I say there's hardware, there's software, there's vaporware. The vaporware will vaporize. So that part you have to be careful of, but the economy should regain momentum and earnings should pick up.
Point taken. On earnings, which are the other concerns which you feel now it's turning around?
No, I think for me the most important concern is earnings. I don't think tariffs are a big issue. Our current account deficit is in good shape, and as long as the current account deficit is in good shape, a few specific sectors which are not very big, like textiles experiencing some problem, doesn't change the shape of the overall market. And I'm not worried about, tariffs being put on the bigger sectors like pharmaceuticals or IT. I don't think the US economy can absorb putting a tariff on those.
All right. So I think we have consensus that the last 1 year was challenging, but now we're gradually getting more constructive that the next year or so will be fairly positive. Talking about these tariffs issues, Pankaj, let me come across to you, because economically it may not be having a big impact. However, those animal spirits to come back, for people to get more excited about the markets, you'll want to have a deal with Mr. Trump. How important is that? And do you think now we have faced bulk of that music? He'll have to come up with something new now to scare us. 25% became 50%. On the tariff front, do you expect some kind of a breakthrough to come through, given the time that we have seen, and also given the kind of commentary, which, to be fair, is a little bit heartening, a little bit more positive?
So, to be honest with you, any speculation is above our pay grade, right? We all thought that in April we are first in the queue. And suddenly what happened that we are last, and with a 50% tariff, which is one of the highest, right?
Yeah.
What will change also, we will not know.
But hopefully the worst is behind.
Worst is behind. That's what the sense we are getting, right? And the sound bites which are coming are quite positive.
Hopefully.
We are building in that the penal tariff will be out. Reciprocal tariff remains. But there are certain section of market which has started to believe that that final tariff could settle between 18 to 20%.
Yeah.
If that happens, I think market is still not pricing in that. Sure. And that will be a very, very positive outcome. But let me give you a real ground situation. You speak to textile guys in pain. Yeah. You speak to gems and jewelry guy in pain. So there are certain sector pockets of economy which are really, really badly hit, and they are employment generators.
Right.
So I think we need to solve this issue sooner than later, so that the animal spirits are back both in economy and markets. Today, when you speak to exporters, they don't know what is happening, and the consumer confidence, the CEO confidence index which we track, it is at the lowest point ever been in the last many, many years. So I think it's for the global economy, local economy, that tariffs issues get resolved. And I think it will. Don't forget, next year is midterm election.
Yeah.
And he wants a good image for himself as well.
Got it. Harish, help me.
Welcome back. Well, 25,330 is currently where the Nifty is at. We have the Midcap index, which is marginally outperforming, so up around 1% at this point in time. Good time then to get in some BTST calls. We have Mitesh Thakkar joining in to tell us to buy or sell today for a reverse trade tomorrow. Mitesh, over to you.
Yeah. So I have a BTST on IIFL. It's moved well now at the day's high. Keep a stop at 503.5. Look for target of 514. And L&T also, I think, similarly breaking into fresh high. It was slightly off the day's high, but still looking good. So BTST here with the stop at 38.10 for targets of 38.50.
All right, Mitesh, thanks a lot for that. Let's take note of the earnings that are likely tomorrow from Nifty. We have two companies, both Nestle as well as Eternal. Both of them actually doing well in today's trading session, though Nestle is about 10% away from its 52-week high. Nothing expected from this quarter. For all the FMCG companies, growth starts from Q3 onwards, but the street is pricing that in already. So 3.5% revenue growth is what the street is expecting this time around. EBITDA absolutely flat, which implies a margin decline of nearly 90 basis points. And the net profit on an unusual gain in the last quarter. Optically looks like a decline of 28%, but the absolute number between 700 to 710 crores is what the street should be watching out for. Apart from that, the impact of GST trade-led trade transition would be close to around 350 to 400 basis points on sales. So had that not happened, the sales growth would have been around 7 to 7.5%. The other part is there has been 3 to 4% growth in domestic business that the street is working with, 7 to 10% growth in exports, domestic volume growth seen between 1 to 2%. But commentary on demand post GST, raw material inflation, pet care growth and strategy from the new leader Manish will be extremely important to track on Nestle. For Eternal, the stock is at a record high. It's been doing very well ever since the first quarter earnings, and more importantly the management commentary out there as well, when they said that food delivery growth has bottomed out and it's likely to expand from here on. And at the same time, losses in Blinkit have also maximized. From here on, they will only reduce. And the street's factoring that in. 66% jump in the revenue is what most analysts are working with, closer to 8,000 crores. The EBITDA, however, grows just about 13% because the excess savings would be put back into expansion of the network in Blinkit, and the net profit declines by about 21%. A large part of that also attributed to non-cash depreciation. Food delivery GOV growth seen between 18 to 19%. Same time last quarter it grew about 16%. Management believes can grow faster. Blinkit gross order value grows between 130 to 140%. That's a big positive. But EBITDA will be lower due to store expansion in Blinkit. So Blinkit store expansion could be anywhere between 1,775 to 1,800 stores as compared to 1,550 stores that we saw in the last quarter. So all those factors important to track for both Nestle as well as Eternal. For Eternal, more than the reported numbers, what the management feels about competition would be even more crucial to track. All right, with that, we'll take a short break. More stock talk on the other side.
Welcome back. Well, 2 minutes to close for trade. We do have Mitesh with us. Mitesh, I was looking at a stock, Man Industries, that seems to be doing well today. It's up around 10.5%. It's gained around 23% this year. Any view on that particular stock?
So I think today, looks like some kind of a strong reversal. In fact, last few days, the stock was slightly on the negative side. And 370 was a weekly support. It's kind of bounced back from those levels. Yesterday's closing was 364. I think the stock can advance to about 450 to about 460, which is where the stock has had two swing highs, which was one in July and one in September. So that's the minimum target which I would look for. And on the downside, as long as the stock now is about 387, I think maintain a positive bias.
Midcap IT, good session. While Persistent is up 7%, look at Coforge, LTI, Mindtree, Hexaware, Infosys. Strong volumes, 3-4% higher. Mitesh, any stock that you like here?
So I think, we had a buy on LTI, Mindtree, and I do like Coforge as well. Very good technical setup over here, if I can put it that way. I was looking at a target of around 1790 and then about 1825. I think it's heading towards these two levels.
Thank you very much for that. Well, it brings us to a close of today's trading session and a strong close. The Nifty ending above 25,300, a gain of nearly 200 points. But I think the Diwali...
Yes, in fact, let's go across to NSE where they will be ringing the closing bell from there. So let's cut across.
हाँ बजाएंगे ना लास्ट के
Well, we are at the NSE, so no better day. And going by the market performance, it's a good day to ring the bell from here at NSE itself. The Nifty ends in the green yet again, and hopefully we get past that resistance mark that we're looking at. Well, gentlemen, we're almost there. 40 seconds to market close. The feedback that we've got has been it's been a pretty good day, Nimesh. And hopefully, in fact, those flows come back. FI is a net short in the system as well. And we've seen various pockets today that did well. Breadth of the market as well, fairly good. But we've got the final 30 seconds, I think, of trade. So let's wind down. 20 seconds to the end of today's trading session. And I'll tell you what, getting into the Diwali week, it appears the bulls, they're already in the festive mode. Lighting lamps is going to be starting next week. But I think for the time being, portfolios, they are brightening up at least. Well, let's go for the countdown. 8, 7, 6, 5, 4, 3, 2, 1. Well, that's, end of today's trading session, but we've got lots more to talk to our guest about. And since Vikas joined us a little later on the show, Vikas, you think the time has come, brighter times?
Okay, and we're going to keep getting all of that perspective soon enough. This is just a quick wrap in terms of what the markets did in today's trading session, and definitely a very good day because we had the Nifty, which closed above 25,300. No complaints coming in there, up around 178 odd points. We did recoup back above the levels of around 25,310, which was an earlier high that we had hit on the 10th of October. The Midcap index up around 1% in today's trading session with a good advanced decline ratio, which stands at around 2:1 and has been steady for a large part of the trading session. In terms of specific stocks, we had a lot of the consumption plays doing well. So Nestle India comes out with numbers tomorrow, up around 4%. Asian Paints, which was up around 2.5%. And a couple of, even Trent, in fact, was up around 2.3%. Financials were the other ones which were in focus. So Bajaj Finance up 4%, Bajaj Finserv up around 2.5%. And on the downside, we had a couple of other stocks. IndusInd Bank, which comes out with its numbers this Saturday, that stock was down around 1.4%. We had Tata Motors X, the CV business, it was down around 1% post the demerger. That stock, went X demerger yesterday and showed a little bit of a downtake today. Separately, Infosys still to come out with its numbers, down around 1% in today's trading session. TechM was down around 0.6% post its numbers. From the broader markets, what really stood out were a couple of these these result reactions. So we had ICICI Lombard, which really stole the show with a 9% gain today. Persistent Systems, which is up around 7% in today's trading session. On the downside, SAI and DLM lost around 6%, and we had a couple of others from the pharmaceutical space, which did see some amount of profit booking. So Aurobindo Wockhardt stood out. KEC International also was down around 0.7% in today's trading session. But overall, good trading day. Start off to the countdown to the Diwali was definitely a positive. Let's see whether that sustains going into the next two trading sessions for the week. Well, it's a wrap on Closing Bell. Our special conversation with the market experts on Market Cafe continues next. Stay tuned.
Powered by LIC, हर पल आपके साथ. Co-powered by SBI, बेस्ट है सबको पता है. Co-powered by SBI, बेस्ट है सबको पता है.
Welcome back to this Diwali special. Well, we have our guest with us. We've been focusing more on the markets, the year that went past and the year ahead as well. Let's focus on a couple of themes then. And Anish, I want to come to you, because if I look at the portfolio, I think private banks is something that you like. Credit growth is expected to pick up from year on. And also there is talk of consolidation in the sector, which normally bodes well. Tell us, how are you focusing on the financial space and private banks in particular?
We do expect credit growth to pick up. See, partly the equity markets have been so, generous in giving capital that corporates have not had to tap the banks. Yeah. But I think as markets have now, moderated a little bit and people are becoming more realistic about equity markets, credit growth within the banking system should pick up. I think while volumes will clearly pick up, I wouldn't be too optimistic on the net interest margins because the banks have a lot of capital and they will compete aggressively for this. So my thesis on banks would be around volume growth, which means more lending with moderate NIMs. I would still remain, and within the banks and NBFC space, I would still remain very careful in the unsecured lending space. I think that is still very, very overheated, and I don't think the risks are being appreciated there.
Okay, all right, that's about the banking space. Harish, I want to come across to you with regard to the tech pack. You know, we speak to a lot of fund managers as well as, you know, analysts, and everyone's actually sitting either on the extreme left or the right of it. You know, some very, very bullish arguments. Where do you get balance sheets like this? Good quality companies, not done anything, valuations have come down. But on the other side, you'll say, what are you buying these companies? They're not going to grow that much. Where is the growth? They haven't focused enough on AI. Which side of the argument are you on with regard to tech?
So I'm on the first side of the argument, which is that I think that a lot of it is in the price.
Okay.
Yes, we are not saying that they are going to magically grow into strong double digits, etc. So that's not going to happen for sure. But today there seems to be a wave of pessimism, which we have seen in the past also. Okay. So how do we gauge whether a lot is in the price? So this is the third instance in the last 25 years where the collective profit pool of Indian IT services is, as a share of the total profits, is more than the market cap share of the IT services companies. This last time happened in 2008 when GFC happened and the banks were going belly up. And because IT services, the largest clients were the banks in US, you didn't know whether they would have a tomorrow. Or in 2017, when there was this entire digital wave that came and then there was this feeling that Indian IT will not be able to adopt. So we've been there, and this is again a similar kind of a setup. Like I said, it has happened once, 3 times in the last 25 years, and each of these over a 2-3 year horizon have been great opportunities to get alpha out of the space.
So it's time to focus on tech then.
Yeah, so that is one. The second aspect within tech itself is that you know, today while a lot of focus is on getting the models right and the infrastructure and the plumbing, the next wave is going to happen on the application layer. Okay. Now think of it that, you know, you had the Visas and the MasterCard in US, which had a particular kind of infrastructure layout and a small amount of application layout. Okay. And then think of how it has been adopted in India, where UPI as an application layer has kind of dominated everything else, right? So application layers are going to be very different from the infrastructure layers that is very capex intensive, that is significantly R&D intensive, etc. Whereas application layer is more specific to business needs, and which is where I think that, you know, people are being a bit too obsessed about believing that Indian IT has lost their plot. Yes, again, I'll be the first to concede that we are not expecting significant fireworks from this space in the form of revenue growth, but a lot of it is being priced in for all the reasons that you said. Very good cash flow yields, great balance sheets, decent and very good executors, margin profiles, which have traditionally been very well supported, currently are lower than what it was in pre-COVID, despite higher offshoring. A lot of tech that these companies themselves will use. So I would think that, you know, from an expectation point of view, I just go back to what Warren Buffett said. The secret to a great marriage is low expectations. And today I would think that expectations are very low for the Indian IT services. So from a 3-year perspective, I think one can make a lot of money in Indian IT.
Okay. Because you heard arguments for IT, for banking, but one sector that's you know, stands out for me that you're very bullish on is pharma and API. Run us through the thought process, and I'll ask a bit more about pharma as well, because, you know, looking at the top holdings, it's very interesting. One of the pharma companies that you hold has done very well, and one has not done well. So I'll ask you that, but generally for the pharma and API, what's your thought process and why you're bullish?
I think, see, more than pharma and API, pharma in general, domestic pharma is doing well for quite some time, and we've been very bullish on pharma for last 3 years, or 2.5 years, specifically after the pricing pressure. You know, US FDA regulator visited India, and that was a very big sign of that the pricing pressure will start going down on international markets. And secondly, you know, domestic market was doing very well. So that segment we've been quite positive, and I think should do well. But more than API, I think we've been very bullish on CDMO as a
CDMO players, yeah.
You know, that I think is a very big trend, probably pretty much like what, you know, in some sense minor, but what IT was, you know, in the 80s and all, whatever, because a lot of outsourcing is going to happen, you know, on that front. Move from that. That's where the China Plus One is there, and Biosecure Act got passed recently as well. But even if that was not happening, we were positive that, you know, it will move away. And right now the companies are very small. I won't be surprised in fullness of time if we see companies with 5, 6, 7, 8 lakh crore market cap in this segment coming about that kind of potential it has. So you have to see the very long-term trend, and that is how we are seeing. And companies will do well in periods of time. So, company which we own, Laurus, has done very well in last 1 year, and we've just bought another one which we think will do very well. Yeah. So that's how you kind of look at it, but there will be cycles intermittently in this.
The other space which you are very bullish on is BFSI, both credited and non-credited. I think that constitutes nearly 30% of your portfolio. Quickly, if you can run through what's the logic there, what's the thesis there, and why you're bullish?
Again, same thing. I think if economic growth picks up, credit growth picks up, which I was saying that because I think when your regulator is trying to say that
you're trying to play those themes via different companies than what the large private bank seems to be. Because in your portfolio, it's more about AB Capital, more about those kind of.
So yeah, how do you play that? Is
it's individual.
Yeah, I mean we've been playing more through my large weight is through ICICI Bank and Aditya Birla Capital because we think that's where Aditya Birla Capital is going at 25% for last 3 years, right? So. That's a more company-specific issue, but the tailwind is there. When your regulator is saying that I want to see the credit growth happening, that itself tells you that there's a tailwind, right? And of course, all ingredients of economy are in place. So that's a segment. So eventually, as economy grows, your channelization of savings into users of the capital is going to happen, and it essentially happens through the BFSI, players, right? So. Companies have grown over the last 20 years, and I'm sure these companies will grow over the next 10, 15, 20 years as economy grows. So it is not possible that, economy does well, but BFSI does not well, generally speaking, right? So that's our call.
But with Pankaj, I think we should drill more about bottom-up approach, right? You've been a bottom-up approach guy. You try to bet a lot of, entrepreneurs and owners, so to speak. Within the new basket of companies that have come in the last 1 year in terms of IPOs or either ways, what's been your take? Are you seeing a lot of companies and a lot of promoters with a lot of hunger and fire to deliver over the next few years? What are your top bets within that?
Yes, absolutely. I think I believe that the earlier set of promoters.
If you can give us some examples on
earlier set of promoters who created wealth in the last 30, 40 years, built India. I think the next set of promoters could be very, very different, right? Because they are retiring and the new gen is coming in. And I always talked about. One of the thumb rules which has worked for me is promoters between 40 to 60.
I was to ask you, yes.
60 years of age.
That's right.
By 38, 40, you see the cycles
and they're mature.
You understand, you mature, but you have the fire in the belly to prove something. By 60, 65, you go into a genre, kiske liye kar raha hu, kyo kar raha hu, and all those kind of things. Outliers are obviously there, but I think that set of promoters, I see about 30, 40 of them, which are creating the next India for us, right? So from that, I am extremely bullish that the entrepreneurship in India is fantastic. Every day we meet somebody who's full of charge, looking to disrupt things, looking to build India. Only the IP layer is missing right now. We are all processing right now. Somebody has to create that IP where we go into a next league. Coming to sectors, I think it's very, very exciting. I think 4-5 sectors where I think I am personally bullish on. I think chemicals is clearly one of them. The last 3 years, we have seen the worst. I think the next 3, 4, 5 years as geopolitical starts to take off, I think chemicals is one place where we have a right to win. The second space I believe is a complete contra call for last 5-6 months is metals. I think last 5-6 years, we have not seen any new supply of either a oil and gas or a metal mine or anything. And demand slowly is catching up. What we saw in gold and silver, suddenly some large guy coming in started buying it, which is central banks, and you create a demand-supply mismatch. I think same can happen in many other hard metals as we speak. The third part is, I think manufacturing as a whole. But I think many new profit pools will be created which we have not seen. Let me give you a small example. Aerospace, right? It's both for civil as well as defense. There are two major players, Boeing, Airbus. Both of them have 14 to 18,000 global vendors across the globe. But in India, only 200, 250 on an average. And a lot of auto guys who are very good on precision engineering are pivoting themselves to aerospace, semiconductor and others. I think as a profit pool, I think many sectors in manufacturing can create profit pools which India has not seen for the last decade or so. Look at EMS, for example. There was zero profit pool 5-6 years back. The profit pool is getting created now. So be on lookout for such creation of profit pools, which will happen over the next 5-10 years. Because what took us to $5 trillion market cap, from 5 to 10, the set of winners on sectoral and bottom up both could be very, very different.
Absolutely. Okay.
So I think these are few of the areas where we are positive. But let me give you a caveat also. Along with good quality companies, I think investors need to be extremely careful on many companies where the quality of balance sheet and cash flows are very, very inferior. We are seeing companies between 20, 25, 30,000 crore market cap, EPS going like this, but last 5 years, they have not generated operating cash of even 50 crores. So I think finally cash is king. If you can't convert your accounting profits into cash flows, you will have a trouble today or tomorrow. So markets today are getting excited by earnings growth, but finally if doesn't convert into cash, I think you will see many of them becoming penny stocks also.
All right, though that caution taken on board, Pankaj, and very, very rightly so as well. But since you briefly spoke about metals and gold, and since Harish gave us some advice on marriage, I want to ask you about gold. What about gold, Harish? I mean, what do you think about it? All the housewives are saying, you know, what's going on, guys?
I mean,
what's happening?
All housewives believe that they are the best fund managers.
No, I
think
the last Samvat has clearly proven that.
They have reason to even prove that. I mean, if you just look at India household savings, I mean, in gold, it's gone from what? 190 lakh crore to 290 lakh crore in a matter of a year. That said, at current reckoning, what is your view on gold? And between the two assets, what do you think?
Okay. So I think it is, maybe it might be a bit arrogant to say that, you know, this time, maybe it is better not to listen to the wife and to put money in equities. And let me give you why I think so.
You're on your own on that. Continue.
So if you were to look at, say, Indian equities, let's take the case of Nifty.
Yes.
And we all look at the value of Nifty in rupees terms. Okay. Now that is just one way of expressing our wealth. If I were to look at Nifty in gold terms, right, what you will see actually is that today, at today's closing, okay, we are about 11% higher than what it was at March 2020. Remember March 2020, when there was panic all around whether we are going to survive or not the pandemic, nothing was clear, whether businesses are going to remain there, whether we are going to see a vaccine, none of them was there, right? And we are just about 10% away from that level. Now, if I were to tell you that, you know, let's say that we were to time travel and we were to get a price point of Nifty which is at April 2020 levels, okay, I'm sure that all of us would jump over and say that pura paisa dal. Okay, I'm saying that we are seeing the similar kind of a thing today, but yes, viewed from the lens of gold. Now, the good thing is in India, given the fact that, you know, we've got such huge gold ownership, now to kind of flock into that kind of a trade just because it is done very well, I think, you know, might be a bit too foolhardy to kind of go through. So therefore, my sense is that, you know, both these trades or both these asset classes, be it gold or equities, essentially bulk of their growth has come from rupee depreciation. Even our earnings growth has come because of rupee depreciation. It's just that one of them benefits from the fear factor, which is gold, and other works on the hope factor, which is equities. At this point of time, it appears that, you know, fear is overriding hope. But we should remember that in 5 years, at least 3 or 4 years will be hope, and maybe 1 year is that of fear. So I would say that, you know, I would be believing that, you know, we would have a far better expectations from equities rather than gold at this point.
Okay, all right. I'll tell you what, we have a couple of queries coming in from our audience itself. So let's get a mic going, and I think we have a query. Yes, sir. Please go ahead.
My question to all the guests here. See, just like US has their own Magnificent Seven companies, you think India can also has its own Magnificent Seven companies from the startup age which have debuted since 2022, just like Eternal, Swiggy, PB Fintech, because they have survived the geopolitical crisis, they survived the tariffs, they survived the slowdown, and they're here in the market. What's your view on that?
Pankaj, if you want to take.
Okay, but see, I think that, you know, one thing that we are seeing is that we are seeing a lot of entrepreneurs with first principles approach, trying to kind of build businesses with scale. And that, I think, is the key recipe for success in any country. And we are seeing that now getting replicated. So I am reasonably positive that you're going to see some very large wealth creators. Now, whether it's going to be in the same proportion as what, say, US is, which is world renowned, etc., I don't know. And maybe it is not something that we even need. One of the good things about operating in India is that there are many sectors, there are many champions that we can actually go to, rather than only having, say, a tech fantasy in, say, US, or like he said, Taiwan is only about TSMC. The good thing is the diversity. So I remain very positive on entrepreneurship in India, that we are doing things differently.
Anybody else?
All right, and I think we have one more query. Yes, sir, please.
Please, sir.
We have been talking about IPO, sucking out liquidity from secondary market. But that having a lot of IPOs leads to entrepreneurship, employment, and studies indicate that in a decade from now, IPOs will be about $2 to $3 trillion, which actually adds to market cap. So is that not a good? Is it a boon or bane for secondary markets?
I'll take this question. So it's good that the market expansion happens. Last year, the biggest argument a lot of people were giving was that fund managers are getting money, they are buying the same stocks and creating a bubble. Now the opposite is that primary market, the paper supply is so huge that it's keeping a lid on the secondary markets. It's in a way good, but let me give you our experience. This year, about 210 IPOs have come, including main board and SME. All of them mostly got oversubscribed by number of times. But the reality is only 120 IPOs are in green as we speak. Yeah. The rest, 90 or 100 IPOs are in red. That means that you overpaid for a lot of issuances. And I believe that when I meet a lot of companies, and we have done a last 20-year study, before the IPO, 2 years before the listing, the company bumps up the top line and the bottom line at the expense of cash flow because they want better valuations. After the IPO, the cash flow starts to, the top line, bottom line starts to come down below expectation. So you need to be careful on the companies you are betting on. A lot of good issuances are also coming, with the sectors which were not available for any of the investors like us. But be very, very careful and selective on the companies you are betting up in the primary market right now. Because let's be honest, they don't have a track record. Last 5 years, 10 years, 20 years, we have not seen them how to behave in a public market, which could be very different. So we'll bet on, but be very, very selective. And from an overall perspective, I think it's very, very good.
I just want to add to what Pankaj said, and maybe any of you all can highlight this. For a retail investor, how should one identify between an FPO and an IPO? Because large part of the IPO seems to be more of FPOs where there's an exit. Has anybody done some work on does the investor make money if there is only an exit and no money gets into the company? Harish or because anybody wants to take this?
I think sorry.
Maybe.
No, see, I think I approach all IPOs with a healthy dose of skepticism. Okay. I spend a lot of time looking at the balance sheet. I try to identify.
I think that's a good learning for a lot of investors, right? You have to be skeptic to start with.
I mean, at the end of the day, IPO, whether any form is the promoter is selling, right? And obviously, he has no interest in making you wealthy. He is interested in he has his own interests, validly so. So I approach them with a healthy dose of skepticism. Also, you have to remember that, look, one is the problem that Pankaj identified, that the numbers may be dressed up. Second, I find that, corporate governance in India is also pro-cyclical. Yeah. Right? So at the time of a IPO, people will come, give you all kinds of details, talk very nicely, but then when once the issue is done, when the markets are down, people disappear, right? Yeah. And then you find them totally inaccessible. The same people who are on your TV shows all day will suddenly not be seen for the next 4 or 5 years. So one should remember that and be very, very, I would say be skeptical.
Okay, all right. Just one more query we have. Yes, ma'am.
Hi, all of you. Happy Diwali in advance. Diwali. So my question is, what will be the role of NBFCs in Indian economic growth in future?
Because NBFCs.
Yeah, NBFCs.
I think, see, every segment has a role to play. Banks, obviously, are very much more regulated than NBFCs. So NBFCs have far more leeway, and because they don't take deposits, their borrowings are less regulated. So, in many other developed markets called shadow banking or shadow banks. So it will have a huge role to play. There's no doubt on that. And if you see in last 20 years ago, there were hardly any NBFCs. And today there is a very large number of NBFCs, especially run by the Tata Capital to Aditya Birla Capital to, AAA rated NBFCs. So they will have. The only thing I believe that in NBFCs, you don't want, see, NBFCs are a leverage business. Banking is a leverage business. So we as a house typically prefer AAA NBFCs because it's a leverage business. In a leverage business, you don't want to take another risk because the cost of NBFC, raw material for NBFC is capital. So you want to invest into companies which are cheapest in terms of raw material so that they can take make money by taking the least risk. And that's the reason we stick to that. But NBFCs will have a huge role to play.
Okay. All right. Well, we thank our audience as well for joining in. And thank you, gentlemen. Wishing you all a very, very happy Diwali to you, your family, and hopefully we have a very, very prosperous year ahead. Thanks a lot, Vikas, Anish, Harish, as well as Pankaj.
Thank you.
And let's hope next year, same time, same place when we meet up, well, things will be looking
But we'll
brighter.
keep on tracking in between also.
Absolutely. Absolutely. Well, on that note, we'll wrap up on this special edition. Hope you enjoyed it.
Presented by Standard Chartered.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Indian equities break a two-day losing streak with a brisk rally. The Nifty and the Sensex end at a one-month high as indices track gains across Asia. Rising expectations of a rate cut by the US Central Bank and easing domestic inflation offer support. The Sensex gains 575 points. The Nifty ends 175 points higher. Axis Bank reports strong numbers in Q2. Net interest income sees growth against expectations of a decline. Slippages also lower by 33% on a quarterly basis. President Donald Trump criticizes China for not buying soybeans from the US, calls it an economically hostile act and threatens to terminate cooking oil trade with Beijing. Analysts say Chinese cooking oil shipments to the US already dropped by 65% this year. 45,000 crores in investments, 26 car launches and 1 lakh crore rupee revenue gold. Hyundai unveils its 5-year India plan. The global CEO Jose Munoz tells CNBC-TV18 exclusively that India is the central pillar of Hyundai's global strategy. Tarun Garg will take over as Hyundai India's first Indian MD and CEO from the 1st of January. Emirates NBD, UAE's second largest bank, eyes a majority stake in RBL Bank. Sources say the deal and the subsequent open offer will give it a 60% stake. Add that the deal has informal approval from the RBI and is set to be announced very soon.
In special circumstances, up to twice in a year, you can withdraw up to 100% of your eligible balance.
The CEO of the Employee Provident Fund Organization defends the tweaks in the fund's withdrawal rules, as the 12-month lock-in rule for 25% of PF balance would help ensure pension benefits in the long run. Adds that concerns over increasing withdrawal timelines is misleading. That's a CNBC-TV18 exclusive. The Supreme Court allows the sale of green crackers in Delhi and NCR ahead of Diwali, but with conditions. Allows the sale only via designated stores and authorized QR code. Says bursting of firecrackers will be permitted only between 8 p.m. to 10 p.m. from the 18th to the 21st of October. 20 people killed, 16 injured after a bus catches fire in Rajasthan. Officials say a short circuit in the bus air conditioning seems to have triggered a gas leak. All of that is coming up for you in just a bit, but on to the day's trading action. Indian equities have seen a sharp rally that brought a two-day losing streak to an end. Strong cues from Asia and increasing hopes of a rate cut by the US Federal Reserve helped the Sensex and the Nifty close at one-month highs. Easing inflation back home also helped bolster sentiment. The buying was broad-based, with nearly 40 Nifty constituents ending in the green. The hopes of a Fed rate cut and the buzz of forward movement in trade talks between India and the US also made their presence felt in the currency market, where the rupee saw its strongest single-day gain in nearly 4 months, closing at a near one-month high, 88.75. That is where the rupee finally closed for the day. But the big earnings of the day, Axis Bank reporting a strong set of numbers in Q2. Net interest income have seen a growth against an expectation of a decline. Gaurav is here with the Axis Bank report card. Gaurav.
Well, as when we look at Axis Bank numbers, on the first look, the numbers are looking good. Provision is the only pinch of salt, and I'll come to that. First, when we talk about net interest income, that increased almost by 2%. It was higher than our own expectations. PPOP, which is pre-provisional operating income, there we saw around 3% decline. It was in line with what the street was expecting. Now, when we look at provision number, that has come down almost by 10%, but it is still higher than what the street was expecting. And the reason being that there was an additional provision for an account, and this was worth 1,231 crores, and this is for 2 discontinued crop loans, as Axis Bank said in their press release. And that is the reason why when we look at profit, now that has declined almost by 26%, and it is also lower than what we were estimating. Apart from that, when we look at advances, the growth was very strong. They have delivered 11.7% growth in terms of advances, and in deposits, they have delivered a growth of around 11%. When we look at advances, street was expecting the growth to be in single digits. So definitely that is something that we will be watching out for. When we talk about net interest margins, now that has also declined just by 7 basis points. It is at 3.73% versus street's expectation of 3.63%. So definitely better than the street's expectation. Net credit cost, that has also come down from 1.38% to 0.73. So that's a decline of around 65 basis points. And gross slippages, now that is also at around 2.1%. So definitely there is some improvement. What we will be specifically watching out is that the provision, the additional provision that they have made for 1,200 crores in this quarter specifically. Second is that when we look at the gross slippages, the slippage number, because of technical impact, as they had provided earlier, is now at around 1,512 crores versus what it was at 2,709 crores. So we will be watching out on how their commentary is going to be and what they're specifically going to talk about the technical slippage going ahead. But all in all, apart from the profits that we have seen falling and lower than estimates, the numbers all in all look better than what we had estimated earlier for Axis Bank in this quarter.
Okay, better than what was expected. That's Axis Bank for you, Gaurav. Many thanks for joining us. The big global story, President Trump has said his administration is considering terminating its cooking oil trade with China after criticizing the country for purposefully not buying soybean from the US. President Trump, in a post on Truth Social, called Beijing's actions an economically hostile act. China remains the world's largest buyer of soybeans and has been buying it from Brazil and Argentina since 2024. As per reports, shipments of Chinese cooking oil to the US have also dropped by 65% in the past 1 year. Now, China has lodged a formal complaint with the World Trade Organization over India's electric vehicle and battery subsidies. The Chinese government has said it will take resolute measures to safeguard its domestic industry's rights. The Chinese Commerce Ministry said that India's measures are hurting China's interests and has urged the Indian government to correct wrongdoings. We are still waiting for a response from India. Middle East banking giant Emirates NBD is eyeing a 60% stake in RBL Bank after factoring in the mandatory open offer. Sources say the pricing of the transaction is likely to be calculated as per the SEBI formula. Ritu is here with more. So Ritu, deal likely to close soon, but almost 60%, that's what Emirates NBD could pick up in RBL Bank.
After Yes Bank SMBC, now we understand Dubai's Emirates NBD Bank is finalizing a landmark deal to acquire majority control of RBL Bank, which will mark one of the largest foreign forays into India's private banking space. And the deal could be announced very soon, in fact, in the next few days itself. Remember, the bank is going to report its earnings this Saturday. So we could hear about this as early as that itself. Now, there has been widely, this has been widely reported that the two have been in talks and that Emirates was eyeing a minority stake in RBL, but our sources indicate NBD, the second largest lender in the UAE, is going to announce a deal to acquire as much as 60% stake in RBL Bank, which will include the open offer component that, of course, gets triggered when the acquirer buys more than 25% stake in a company. Now, we further understand NBD plans to acquire this controlling stake through a fresh equity issuance by RBL Bank, which will be done through its wholly owned subsidiary. Now, this is important because the entire investment is going to be then directly infused into the bank, and also because RBL Bank's current foreign shareholding, if you look at it, it stands at more than 22%. So the fresh equity issuance to NBD is going to expand the overall capital base of RBL Bank to ensure that their stake remains within the regulatory FDI cap of 74%. Now, our sources also indicate the transaction is expected to be priced, like you were saying, in line with, of course, SEBI's prescribed formula without a major premium to RBL's current market price. Now, the transaction cannot, of course, happen without RBI's blessing, and we understand this change of control has received an informal nod from the regulator. Formal submissions, of course, will be made once the boards approve this deal. Now, while RBI is not going to relax that 26% voting rights cap, our sources do suggest the regulator will offer a glide path to Emirates NBD, allowing it to gradually bring down its shareholding in RBL Bank. Now, for Emirates, of course, which operates in India through its 3 branches, the acquisition will significantly deepen its footprint in one of the top banking markets. And for RBL, of course, a globally recognized institution, massive capital infusion, and long-term ownership clarity.
All right, Ritu, many thanks for joining us. Volkswagen has resumed talks with the JSW Group for a joint venture to manufacture electric vehicles in India after discussions with M&M stalled. The Economic Times has reported that the company held several meetings with JSW in the past month to explore a partnership. The proposed JV could see the JSW Group handle local operations through JSW Auto, its mobility arm. Volkswagen, meanwhile, could provide the technology and product platform. Staying with auto, the sector registered broad-based growth in September as per industry body SIAM. This is strong manufacturing activity and robust exports have offset moderation in domestic demand for certain passenger vehicle segments. Passenger vehicle sales grew 4.4%, while sales of two-wheelers rose 6.7%. Speaking to CNBC-TV18, SIAM's President Shailesh Chandra attributed the rise in sales to GST rationalization and the ease of financing.
Consumer sentiment has definitely gone up, which is a good news for future growth, right? There's huge pent up which is also building, which is not getting serviced fully in the festive period, so there will be carry forward of this. The reduction in GST rate will bring affordability across the sector, across all the categories of automotives, so that will play out as a structural change and will support the growth.
Well, that's the auto sales numbers. And more auto. Hyundai unveiling its 5-year plan as it aims to achieve 1 lakh crore rupee revenue goal and increase its market share in India. The automakers announced a 45,000 crore rupee investment plan in a bid to capture over 15% market share. It plans to launch 26 new cars, including 6 EVs by fiscal 2030. Hyundai Motor India has appointed Tarun Garg as its Managing Director and Chief Executive Officer. Garg will take charge from the 1st of January next year. He will become the first Indian to be the head of Hyundai in India. Global CEO Jose Munoz tells CNBC-TV18 exclusively that India is the central pillar of Hyundai's global strategy.
The main message that I've conveyed to all the stakeholders, including, of course, the shareholders in attendance, is that India is not important for the strategy of Hyundai, but it is the strategy of Hyundai itself.
For the last 29 years, you were consistently at number 2. The market share in the last few months has fallen. Sometimes number 3, sometimes number 4. Does Hyundai want to be number 1 in India? Is that the plan?
And then one of the reasons why we may have lost some ground in terms of share is because we have decided, we made a conscious decision to focus on providing the best customer satisfaction and maintaining a high value, including the residual value of our vehicles to our consumers. Whilst others have entered into a price war, an incentive war, we've been very disciplined because one of our commitments to the shareholders is to maintain a very high double-digit profit margin in this market.
Why not a target higher than 15%?
Well, I think, let me maybe summarize some of the things that we have announced, right? So we have announced that we're going to deliver in this market more than 860,000 total sales in the market. And then we have announced also an increase in capacity to 1.1 million, which would allow us to be, already we are, but to be by far the largest exporter of vehicles from India.
Well, you can watch that conversation exclusively on CNBC-TV18. The global CEO of Hyundai, Jose Munoz, talking to us about their plan for the market. Shares of Tech Mahindra slipping today despite its operating performance ahead of expectations in Q2. Both revenue and margins came in ahead of estimates, while constant currency revenue growth was at 10th quarter high. Tech Mahindra's management reiterates the company's guidance for the full fiscal. However, it tempered growth expectations for FY27, citing macroeconomic uncertainties. Coinbase has increased its investment in Indian crypto exchange CoinDCX for an undisclosed amount. This transaction will value CoinDCX at $2.45 billion. The funds will be directed towards the company's expansion in India and the UAE. Remember, Coinbase had first invested an undisclosed amount in CoinDCX in 2020. Now, the Employees Provident Fund Organization has recently revamped its partial withdrawal rules, consolidating 13 separate provisions into just 3 broad categories. The number of withdrawals allowed has also been increased. Sonal is standing by to explain to us what the EPFO has done by way of changes. Sonal.
Well, yes, important announcements and approvals coming in from the EPFO. This is with respect to withdrawal of your PF amount. So let's get started. The first one is that you can make partial withdrawal under 3 broad buckets or categories. The first one is essential needs, there is housing and special circumstances as well. So this has been clubbed into 3 buckets versus 13 provisions which were available in the previous provisions. The second is that more number of withdrawals are allowed. Basically, the frequency has been increased. You can withdraw 10 times for education, 5 times for marriage versus 3 times which was allowed earlier. The third is that partial withdrawals are now allowed immediately after 12 months of completion of your service. Earlier it was very particular to a particular reason. For instance, if you had to take out money for housing, you had to have 3 years in terms of opening of your account. For marriage, it was around 7 years. But now it's flat out 12 months for any reason that you pick. In fact, for special circumstances, you no longer need to specify a reason. There's freedom to withdraw without justification. So they say that earlier, special provisions would include something like an epidemic, national calamity, but now they need to specify what these special circumstances are. But they say 100% withdrawal of your eligible balance is allowed under the new provisions. What the street or the members have not liked, the fact that they've asked for 25% of your contribution as a minimum balance in the account all the times. This has drawn a lot of criticism from the members. Additionally, the premature final withdrawal window has been increased from previously 2 months to 12 months now. What it means is if you're unemployed, you will be able to get your full money back after 12 months, or you can apply for it only after 12 months. But do remember, there is a special clarification here, important one, that 75% will be available after you terminate your employment or you become unemployed. But that 25%, the remaining amount, is only available after 12 months. So this is an important clarification. In terms of final pension as well, withdrawal window has been extended from 2 months to 36 months. So these are some of the important provisions which the EPFO has approved with respect to withdrawal. Some of them liked by the members, but some of them have been gaining a lot of criticism.
All right. Many thanks for joining us. The CEO of the Employees Provident Fund Organization has defended the tweaks in the fund's withdrawal rules. In an interview with CNBC-TV18, Ramesh Krishnamurthy has said the 12-month lock-in rule for 25% of the PF balance would help ensure pension benefits in the long run. Take a look.
What was felt was that let us make it easy for people to access their own PF money in times of financial need, but at the same time protect their PF for their long-term social security requirements. As you are aware, India is a young country, but all the youth who are going to retire, who are now coming into the work, are going to retire in 2055, 2060. So unless and until we plan for proper social security protection in times of their retirement, then they'll have less of a corpus to be available. So that is why a concept of a minimum balance of 25% was visualized, and that has been kept away as a minimum lock-in balance. Rest of the 75% is freely accessible up to, so if 100% of that is accessible by the member, we have kept a separate category called special circumstance. In special circumstance, up to twice in a year, you can withdraw up to 100% of your eligible balance. So the 75% is always accessible to you. Now, what used to happen earlier was that you could have withdrawn only small amounts towards illness or something like that. For unemployment, you were forced to take a final settlement. So anything more than 2 months that was available as unemployment, you would have had to exit your PF membership. What was happening was that we were finding that people were exiting their full PF membership. Therefore, what was happening is that they would wipe their entire PF balance completely and they would rejoin after some time. So what was happening was that they were losing out on a very important component, which is called pensionable service.
And you can catch that exclusive conversation with the EPFO CEO at 6 p.m. this evening, only on CNBC-TV18. We'll head into a break, but up next with Diwali around the corner, global shortage of silver leaves jewelers in Delhi in a fix. A special report coming up. festive season, silver in high demand as prices surge 20 to 25% in a month and premiums rise from 8,000 to 10,000 rupees per kg. Delhi NCR jewelers report limited stock forcing buyers to pay top rates. Shivani Bazar's reports from the nation's capital on the festive rush and the challenges buyers and jewelers face amidst the global supply crunch. Take a look.
It's the festive season, and while the sparkle of gold continues to attract buyers, it's silver that's stealing the headlines this year. Not just for how much it's selling, but for how little of it is available in the global markets. A global supply squeeze has pushed up silver prices sharply and created a shortage that's now being felt on the ground, from refineries to retail counters. I'm here in Delhi NCR, where jewelers are saying that they're facing mounting pressures to keep up with both demand and cost. Silver prices have jumped nearly 20 to 25% in the past 1 month as global demand outpaces supply. A surge in industrial use from solar panels to electric vehicles has deepened the supply crunch. The Silver Institute projects a global shortfall of over 140 million ounces this year. In India, jewelers are one of the largest consumers of silver, and they say they are finding it increasingly hard to replenish stock, with premiums rising up to 8,000 to 10,000 rupees per kilogram.
There is a lot of demand in the market, into retail, into wholesale, a lot of demand, huge demand. So the difference is, and supply is very less, you know. There's literally a scarcity from the miners and from all the places where they source it from. And there's huge demand in the market for jewelry, especially for the coins, gold bars. So I think that's why the premium is a lot right now. If a jeweler is holding up some particular stock, he will only sell his stock once he's getting it from the back. So it's not possible for him to sell something and which if can't refill it, so he won't sell it ahead.
As gold prices hovered near record high, many small investors and festive buyers have turned to silver. But with a sharp rise in prices and demand, jewelers say the metal, which was once seen as an affordable alternative, is slipping out of reach.
Right now the premiums from the actual rate is far more, there's no supply. Yeah. So you're stuck in a situation where the rate is what it is. You want to pay for it,
It's not just festive demand that's driving the silver rush.
The main difference is the price cost. It has been jumped at least 70 to 80% on the silver article. So definitely the demand for the middle class people has been nil now. This is the only occasion they can think of buying something in a coin or maybe Lakshmi Ganesha to buy as an investment for the children or for the future. But this year they have facing a problem because the price has been increased a lot.
The craze is not just for physical silver. Silver ETFs have also seen strong inflows this quarter, and that has meant greater demand for the underlying asset. Analysts warn the imbalance could last through 2025 unless global mining output rises. So while the festive rush continues, it's clear that this season shine comes at a higher cost. With global supply lines stretched and prices on a boil, silver may remain the most sought after and hardest to get metal in 2025. In New Delhi with Vijay Akhilesh Singh, this is Shivani Bazar for CNBC-TV18.
Well, Delhi's air quality index has entered the poor zone just a week ahead of Diwali. This has prompted authorities to impose stage 1 of the graded response action plan. The measures include the ban of non-essential construction, dust control and stricter vehicle checks. Meanwhile, the Supreme Court has allowed the bursting of crackers from the 18th to the 21st of October between 6 a.m. to 7 a.m. and 8 p.m. to 10 p.m. for the National Capital Region. Patrol teams will be deployed on ground to ensure that only certified crackers are sold at permitted locations. At least 20 people have died and 16 people are still critical after a bus caught fire in Rajasthan. The bus was travelling from Jaisalmer to Jodhpur yesterday. 19 people died on the spot. A 75-year-old man died during treatment. Initial investigations suggest that a short circuit in the bus air conditioning system triggered a gas leak. The fire broke out and trapped passengers inside as flames engulfed the front of the bus, blocking all exits. In international news, Hamas has handed over the bodies of 4 more Israeli hostages, bringing the number of released deceased captives to 8. Israel has said it will only allow half the agreed number of aid trucks into Gaza and has delayed the opening of the Rafah crossing. Meanwhile, US President Trump has called on Hamas to disarm, warning that if they don't disarm, the US will disarm them. It will happen quickly and perhaps violently. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Presented by Standard Chartered. Special partner, Nuvama. Let's do it right.
Today we bring you a very special conversation. One, hopefully, which is a blend of market wisdom, but also family banter. And that is why this, I think, for me as well, is a very special conversation. My guests, one has built an investing institution, which I don't think needs any introduction. I'm talking about Ramdeo Agrawal. Joining him today for this interview is his son, Vaibhav Agrawal, who is the CIO for the AIF and the PMS businesses at Motilal Oswal. Gentlemen, both of you, thank you very much for being part of this program.
Thank you. I mean, this is very new and I would say very good experience for me to bring Vaibhav along with me.
New and old,
yes.
not old.
No. I mean, we are fully out there. This is best is ahead.
Best is ahead. Happy Diwali to the both of you and to the teams and of course this wonderful institution.
My pleasure to be here and grateful to be with you and my father on the interview.
And Vaibhav, have you seen any of these? How do these Diwali interviews go? Have you seen any of the earlier ones?
Yeah,
we've done so many over the years.
Yeah, when I was younger, I had seen it at that point. But I think every year there's some different color, different flavor, and so it's obviously a very interesting time to sort of be part of the market.
Did both of you gel match what you guys were going to wear?
No, till 10 o'clock in the morning, I didn't know what I'm going to wear. I knew what he's going to wear, but I didn't know about mine. So it came out with a...
But it's looking fabulous, fantastic, and Diwali-like. Vaibhav, what are your earliest memories? I mean, you're here managing, I mean, the AIF and the PMS portfolios. Yeah. But what are your earliest memories of, of this business, basically?
Yeah, so I think earlier, like, we were just a broker. So I remember sort of, we used to go to Natwar Chambers, which was one of our first offices next to the Bombay Stock Exchange. And there I used to get fascinated seeing the stock tickers sort of going, up and down. So I remember that was one of my earliest memories. And then I think that time, Dad and Mr. Oswal used to sit in one cabin. And if I was ever sort of making too much of a noise, I would get a shouting from Mr. Oswal because he was always a very strict disciplinarian.
Not your father?
I mean, he was more polite. He has a gentle way of being firmer, but Mr. Oswal is obviously sort of more strict, and so that was my earliest memories. And then I also used to play computer games. I remember because when I was a 4-year-old kid, that's what interested me. So since then, I've seen a lot more.
Square foot office. When we started Motilal Oswal, I was so happy to walk into that office. 72 square foot. Was, in that we had Moti and me sitting in next to each other, and then there was a working space where 4-5 guys were sitting and doing the clerical work, making the bills and contracts and all sorts of stuff. So in 72 square foot we started, and I was very happy when we ignored that office. And that was 1990. We got the membership and we started that office. And that's where Vaibhav was maybe 2-3 years old, and he used to come and...
So he said that he would sit in the office and play computer games.
What else can
now
you do?
Markets have become computer games.
Completely.
I'm not a journey it has been, right?
My God.
आपने कुछ मुझे पहले बता रहे थे. From what to what is
so
you've seen 3 phases.
Yes, I have seen. I mean, I read the book Value Migration, but I have seen the value migration right in front of me. When we started in '87, that time we were the first 2 or 3 chartered accountants to come in. It was a completely, like all the old Parsis and Gujaratis and Marwadis, dhoti masters,
Dhoti masters.
So many of them were actually wearing dhotis.
Of course,
like my father was also wearing dhoti, but they were elderly, respected, very respected community. But they were very old type, a lot of family kind of business, and small income, not much. It was not a big game, and markets were small, and from there. We took over. I mean, I don't remember any of those old guys in any significance now. Now, whosoever is there, they're all our generation or the new digital guys. So from us, the cake has expanded too much, very, very large, but now third part is happening. That is complete digital.
Correct.
Like your Zerodha, Grow, and whatnot. So those guys have taken almost like 70-80% market share in broking. And we are with, that advisory driven 20-25% of the
You've also expanded, not just broking. I mean, so many other businesses that
we our smartness is that we use all the cash flow to build other businesses, other associate businesses in the wealth management, private equity, AMC. So all those businesses we build, and that has what has made Motilal Oswal, kind of capital market powerhouse. So that's what, and now the journey is different, and that's where. Now Vaibhav and Prateek's, their entries are there, and they have to play the role.
Did you always know that Vaibhav was going to be part of the business?
I mean, it is his call, but I told him right in the beginning, this business pagalon ki basti hai. You have to be passionate about his stock market.
This is when he was how old?
No, like whenever he started understanding, I was very clear, he has to have a free hand in what he wants to become. He wants to become Bollywood star, or he wants to become cricketer, or boss, it is your call what you want to become. You'll get the share certificate of the company for sure. So don't worry, you'll not be poor, but pursue what you love, yeah.
And when did you realize, Vaibhav, that you want to be in this business? That's investment management.
Yeah, so I had gone for my undergrad to the US, so I was studying computer science at that time. And then I started taking some courses in finance as well. And that's when I think, I was able to sort of understand that more deeply. I think maybe it came naturally or whatever And even over the summer when I used to come, I used to do...
Before going to, you went to UPenn.
Yeah.
And then you went to London Business School.
I went to London Business School for my MBA.
For your MBA later.
Yeah.
But did you think you'd do something in computer science, IT, technology at one stage, or no?
So I had that feeling. So that's why I was studying engineering. But then when I came over the summers, I realized that sort of equity markets, investing, that's kind of something that I was gravitating towards.
Okay.
So the second half of my time in my undergrad, I sort of focused more on coming back to investing.
Yeah.
And so I think mostly when I was about 20 years old, I figured that I want to be in part of the equity markets.
Yeah. How's it been coming back here?
I think it's been great. I mean, I think the platforms like just exploded since the time I've been here.
Right.
I think every day there's so much to learn.
Right.
Because obviously there are phenomenal people over here, but you also get to meet amazing people outside.
Right.
Who are like the companies, the analysts. So I think it's a very fulfilling experience.
When I said you cut your teeth as a fund manager.
Yeah. Yeah.
You have to be a good fund manager. Otherwise, you're my son, that is one thing.
Correct.
But what competence you bring for the capital market?
Is he a strict boss?
Yeah, he's definitely a stricter boss.
But polite, you said.
Yeah.
Or
polite but strict.
Polite but. I want to ask you, how did you actively as he was growing up? And I mean, Vaibhav is almost as old as Motilal Oswal, right?
Yes.
I mean, the organization.
Yeah.
Just a 2-year difference. Did you actively sort of teach him? I mean, concepts growing up. You're busy building the business, but
no interaction that much. In the sense that not discussing so much about the company or business. Or
right.
I taught him only. He was learning Vedic maths. I don't know. Somehow he and his mother both they got into thinking that they must learn
Vedic
maths, which is much more mental maths actually.
Correct.
In that I said you must learn compounding.
Okay.
So after the dinner, when we go for a walk, just a stroll, he used to come and I taught him compounding then. When it must have been about 11, 12 years. You must have been.
I think about 14, 15.
14, 15, yeah.
Okay.
So now he can do faster compounding than me. So that is the only thing I have taught. Rest all.
Otherwise, I mean, growing up in a house like
so
this, I mean, you pick up through osmosis, right? I mean, you pick up a lot of stuff, absorb a lot of stuff, which you don't even realize, but it's there.
Yeah. I think it's just organically. I mean, if someone discusses the markets or the companies.
Yeah.
So I think it more formally started maybe like when I was in 11th and 12th grade.
Okay.
I think that is when then he started telling me about value investing. That time his focus was more about Benjamin Graham and value style and a little bit of Warren Buffett. But I think his own style evolved over a period of time. So that's when we moved from purely value investing to growth investing.
So Prashant, why don't we go and sit and have a cup of tea and we'll continue the discussion. Yeah.
Ramdeo, I wanted to ask you, do you spend a lot of time together in office? Have lunch together or have fixed time where you can sort of connect?
Zero. No interaction. I'm the boss. He's one of the fund managers.
ये तो बड़ी ज़्यादती है.
But ऐसे ही है. So I mean, like actually in AMC, I sit actually right next to the AMC. But now with the SEBI mandate, I'm not allowed to enter. Every time I enter, I have to give reason why I enter. So I've said I will not enter till 3:30.
Right.
Ever.
Right.
So I stay out and he's there inside as a fund manager.
But now that he's part of the business, part of the investment management business, which you oversee, do you actively, as you said, I mean, you know, you've not actively taught him how to invest or the frameworks or the models, etc. But now that he's part of the business, do you kind of spend time with him in that sense, or?
No, I take reporting from his boss. His boss is Pratik Agrawal and his boss is Navin Agrawal. So I talk to all of them. I mean, of course, I talk to him and Niket, who is another CIO for the fund, MF. So I generally talk about the business, not about the stock picking.
Right.
What he's doing. If he wants to ask something, then of course.
Right.
But not much of active interaction with him about what he's doing in his fund, what his stock is buying, why he's buying. No,
Right.
I don't get into that.
Right. Do you find that as a missing piece or no? Not really.
I think like earlier between 2012 and 2014, when I was just learning the ropes of investing, I think at that time I had the advantage of we had a much smaller team. He was more actively involved with asset management. So at that point I had the advantage of seeing him up and close for 3-4 years. So I think I was able to pick up a lot of things at that point in time. And then I think informally I have picked up things over the years from him.
Right.
So I think it's obviously like it's a huge honor to have someone like him, to look up to. But at the same time, I think a lot of my colleagues at work, and the analysts and the other managements who we interact, I think there's a lot to learn from them as well.
A lot of them have, at least at Motilal, trained under you at some point or the other. So in a way, it's kind of that knowledge is seeping through, not directly maybe, but indirectly.
Yeah, through our well-placed studies and some casual interaction also at home.
Yeah.
Exchanging of the books.
Yeah.
Some idea I would throw, he would throw. But I mean, so it's a continuous process. It's a cumulative process, I would say.
Yeah. I want to ask both of you a question. What do you find about Weber which is different from how you invest, how you think about things? Is there anything which stands out to you?
No, one thing which stands out clearly is that he got far more stable mind or calm mind than what I was at his age.
Okay.
So now I would be, even now I'm more talkative or more active than him.
Right.
But to have this kind of patience and what do you call?
Sthirta.
Sthirta, stability.
Which is?
So that's what he has. So he's a good listener. He will talk less. And he will do his homework. He's far more digital. Initially when Google came and, when I would ask any question, he will go to Google and figure out what's happening. I think
do you also find that area of coverage is a lot more in terms of the kind of companies or not really? I mean,
no, I mean now if you're sitting in this kind of AMC, the whole world comes to you.
Correct.
So and I'm busy in much more corporate activity. He's busy in actually fund management.
Right.
So the number of companies, I mean 100, 150 companies are getting listed new.
Correct.
First time, and I'm struggling when the company guys they pitch the idea, what this company does. From there we start. These guys they know much more about each and every company. So now the future or present of even what's happening in the corporate development is all in their head. They are building new directory in their head. We are the top 500. Old 500 is in our head. So
and new and old, not just old, new and old.
And no, more old and few new ones. The something like say quick commerce and all, which fits into my head, that I'll pursue.
Like he's able to think like 10, 15, 20 years for a stock or a company that he invests in. I think just given that like how volatile the external environment is and how quickly things are shaping up, sometimes it becomes a little difficult for me to maybe visualize how in the midst of all those factors, will maybe an early stage company, behave after 10, 15 years. So I think obviously maybe because of his wealth of experience, over time he's seen that journey more. So he's able to visualize that. So I think that's something which maybe I'll learn over a period of time.
Whether it is HDFC, though I lost it in 6-8 months, then started with the Hero MotoCorp. I sat for 18 years. Then we did Infosys, Tree CMD. That was a very short blast, you know. And then we did Bharti, again 50x and all. So like that, we kept on. So I became more and more buy and hold, longer term. But it's a journey. I mean, eventually he will also realize that as the money becomes bigger, when he has to manage thousands of crores prop, not AMC. In AMC, there is no taxation and all. So when he'll manage his own money, then he will realize that, boss, let's find a great idea. And
you can't flip in and out, not continuously.
I mean, that option is also there.
Yeah, yeah.
But where you should be sitting, you should be sitting.
Yeah, yeah. I want to ask you a sector idea which.
He's the best guy. You ask him.
No, not about what will do well, but anything you can disagreed on and one or the other.
So I think back in 2014, I remember I was pitching TVS Motors to him, and I think he was more of the hero camp, you know, back in the day. So
hero
so Old Faithful.
Yeah. So I think
Old Faithful.
Yeah, old and
actually, so there was a leadership change in TVS at that point. So I think from there on, TVS I think has obviously
It's
done very well,
and
kudos to them and the management there to sort of do what they did. So I remember I think that was one thing where we used to have a lot of disagreement about.
So did you finally buy it or no?
I think our funds.
Once you disagree, then you don't.
I think our funds have bought them over a period of time.
Okay.
But yeah, I mean, I think so there are obviously instances like that where we do.
The reverse has never happened, right? Obviously, it's not happened.
Yeah, but I bought a multi-bagger with his trip. That was Guru Finance.
Guru Finance. Guru, I think, was one of your first kind of.
Yeah.
Guru and there was another stock, no? Which was.
So the first stock I ever bought was Nestle because I was doing my summer internship studying it.
Okay.
But then I think Guru Finance sort of came about.
Guru was the HDFC subsidiary.
The HDFC subsidiary that got taken over by Bandhan. So that it has HDFC management, and I think it was available at 1.5 book or something.
Right.
And it was growing very well and very well managed housing finance company. So yeah, it did very well. I think it went to at one point as high as 9 or 10 book. I think even today in the NBFC space, I think it is one of the highest ever recorded valuations.
Right.
So it's too cheap, very cheap for the growth and quality and parentage. So when he was in US, he came in summer and all. That this Nestle kind of thing, this one looks to be good. So I bought and then I bought and bought and bought. I made a lot of money in Guru.
In Guru.
Guru, yeah, yeah. So those kind of things happen.
You know, let's do a rapid fire if both of you are up for it.
Yeah, absolutely.
Yeah, please.
Quick ones. So let me start with the first one. One standout habit you admire in each other. In Vaibhav and Vaibhav, you and Ramdeo ji.
So I think his patience and ability to sort of sit through for the long term, and I think he's very gentle with people. He has a way of interacting with people which makes them very receptive to him, which I don't find in many people. So I think that's what I think.
If I had to name one, and I've said this before, is his curiosity.
Yeah.
Which is he's so excited. About things and new things that and he'll sit down and he'll ask you questions and always at least I found that over the last 2 decades. Ramdeo ji, about Vaibhav?
No, I admire his that coolness, that calm thinking, very composed, calm, and of course he knows compounding. So that's a big asset.
Sorry, which one?
He knows compounding well. I don't know if I can remind him ever. So,
do you read as much as? I mean, that's one of the first things he said. Pado.
Yeah.
Read 30, 40, 50, but it doesn't matter what it is, but read. And so
I don't read maybe as much as him, but I have these phases when I'll maybe read 3-4 books at one time.
Right.
And then I'll not read for a period and then sort of do it. So it's like a step jump that happens with me.
Book currently on the bedside? What are you reading? Anything you're reading now?
I'm reading this book on commitment actually. It's written by ex-army generals.
Okay.
And it talks about the importance of having absolute commitment in whatever you're doing.
Okay.
So I think that was very interesting to sort of learn.
Ramdeo ji, book? Current book?
Always.
Books or book?
No, book. Always a book. So I'm reading a book called The Brave New Wealthy World.
Okay.
Very exciting book, written in 2003 by Edmund.
Okay.
It's out of print kind of thing, but amazing book.
Okay.
A
brave new wealthy book.
Yes.
A wealthy world.
Wealthy world.
Yeah. Okay.
So this book is about in 2003 this prof who is now dean of Babson College So this guy is saying that because of securitization, why America is rich? Because they did the securitization of the debt as well as equity, big time, and that is making the
that cycle.
Yes, all the savings are going into the assets, and assets are being securitized. So that whole cycle is on, and that is making them very rich. And I think, fortunately, India also has the same kind of machine here.
Correct.
So he has projected the world will become so rich. It's not funny. By 2030, 2020, he said it will be 600 trillion. 600 trillion will be the wealth of the world, because he thinks all global. And by 2050, it will be 6,000 trillion.
Wow.
Okay.
Wow.
So now we have the benefit of seeing what he said in 2003 and what has happened in 2025. Directionally, he's perfect. Okay. But the quantum is somewhat, I mean, he's say 5 years behind. What would happen in 2030, what would happen in 2020 as per him will happen in 2030 or maybe 2028.
Got it.
But directionally, bang on. Very exciting book.
Weber, one stock you wish you bought, you had bought.
There are quite a few. I wish
one you think
bought,
you kind of sort of, maybe you didn't buy it for X reason, Y reason, but you really liked it at that point. And said, well, Ramdeo, you want to answer till then? Till Weber thinks?
It is. I had a lot of fun with a lot of stocks. What I felt like I bought. One of the regret for me is that between 2006 and 2013, sorry, 2004 and 2013, 9 years, including the GFC boom, it had gone into our head that the corporate should not buy stocks in their, what do you call, treasury. So 9 years I didn't buy stocks.
Wow.
Out of the cash flow. That has made us so poor is not funny. My balance sheet would have been at least double at this point of time.
But that does not show up in your...
It doesn't show up.
Regular,
it's an error of omission.
In regular accounting.
Error of omission.
If there was a biopic on Ramdeo ji, which is possible going into the future, who you think is best fit to play him?
Hold your breath.
Yeah, I think Paresh Rawal would sort of fit that role. I think because
that's a nice one.
Maybe because of his optics and also his ability to be both serious and hilarious at the same time.
Yeah.
I think he would represent him quite well.
A resolution for the new Samvat, anything?
Nothing in particular, but because of this book I'm reading, so I would like to take some of the ideas from there and maybe become more aggressive, a little more aggressive, or maybe some new business ideas will germinate. Definitely will give birth to some strategic change in my thinking about capital market and about the company.
About Motilal Oswal, the business itself.
Yeah.
Weber?
No, I think yeah, just become a better investor and focus on getting maximum returns for clients. I think that would be the resolution.
I thank both of you for joining me here on this Samvat special. Wishing you guys, your families, your teams very happy Diwali. Thank you very much.
Thank you and happy Diwali to you
too. Happy Diwali to you and your entire CNBC viewers all over the country. They admire CNBC.
Special partner, Nuvama. Let's do it right. Co-powered by SBI. Best है सबको पता है.
Hello and welcome to CNBC-TV18. Hyundai Motor India has announced an ambitious 5-year plan. They've outlined a 45,000 crore investment till FY30. They've announced 26 launches, including 7 new nameplates. And most importantly, for the first time in the company's 30-year history in India, Hyundai is going to have an Indian managing director and CEO. And that's going to be Tarun Garg, who's led the company as Chief Operating Officer so far. So what's going to be the strategy for the India market going forward? Joining us now to discuss this is Jose Munoz, who is the Global CEO and President of Hyundai Motor Company. Jose Munoz, thank you very much for being with us here on CNBC TV18. Let me begin by asking you, 30 years in India, 1 year since listing, what is the ambition that Hyundai really has in India today?
Well, Pariksit, thank you very much for having me. It's a real honor to be with you here today in Mumbai. Well, definitely we're very proud. I think we are one of the first, if not the first, international company being established here in India. And I would say that our reference tells us that the Indian consumers see us as an Indian brand, which is really great. Well, today I was very proud to present our plan to 2030 for the company once we went into the largest IPO in 2024. And then not only this market is important, the main message that I've conveyed to all the stakeholders, including, of course, the shareholders in attendance, is that India is not important for the strategy of Hyundai, but it is the strategy of Hyundai itself. We will be globally as good as we are in India. That's why we've deployed so many, I would say, good news and activities that I'm happy to summarize through this interview today. I think it's been well received.
Right. So for the last 29 years, you were consistently at number 2. The market share in the last few months has fallen. Sometimes number 3, sometimes number 4. Does Hyundai want to be number 1 in India? Is that the plan?
Well, I think we are not obsessed with numbers. Numbers help us get some reference. But the thing that we are obsessed with is to provide the customer with the best ownership experience. And then one of the reasons why we may have lost some ground in terms of share is because we have decided, we made a conscious decision to focus on providing the best customer satisfaction and maintaining a high value, including the residual value of our vehicles to our consumers. Whilst others have entered into a price war, an incentive war, we've been very disciplined because one of our commitments to the shareholders is to maintain a very high double-digit profit margin in this market. Still, with the introduction of 26 new products, with 7 of them being brand new, with 2 of them in segments where we don't compete, like the MPV, and also in the off-road SUV domain, we are confident that not only we are going to maintain a high position, but we're going to naturally grow.
The next question that some of the investors also asked you today, why not a target higher than 15%?
Well, I think let me maybe summarize some of the things that we have announced, right? So we have announced that we're going to deliver in this market more than 860,000 total sales in the market. And then we have announced also an increase in capacity to 1.1 million, which would allow us to be, already we are, but to be by far the largest exporter of vehicles from India. So we have exported so far more than 3 million cars, and we have sold in India more than 9 million cars, right? So this is really something very important. And we want to do so by also taking advantage of the trend in the market by bringing new battery EV products, new EREV products, and especially well received has been the hybrid products. We have seen in the market a lot of positive momentum on hybrid. We have one of the best hybrids in the industry, and then with very good profitability. So we're going to bring those hybrids as well. Altogether, electrified vehicles are going to account for more than 55% of our mix by 2030, right? If you add to this the incremental capacity of our newly announced Pune plant with more than 250,000 cars of capacity and potential additional expansion in the future, this would put us in a very, very strong position in this market.
Right. I'd like to ask you about the 45,000 crore investment plan. According to the presentation that your team made, 60% of this is going to product and R&D, and 40% will go towards capacity and upgradation. What I'd like to understand from you, specifically for research and developing products in India, developing for India and for the world, how much of that money, that investment, that capex will go there?
Well, the most important element to understand in this strategy that we've gotten for India is we want to be fully localized. At the moment, 100% of the products that we sell in India are produced in India. But we want also to have the other two pillars of full localization. One, we are already there, which is the export pillar. Now, 30% of our total produced vehicles are going to be for export, and export vehicles for us bring higher profitability than the locally sold. But the third pillar, I would say, is the most important, which is the R&D localization. So to compete in the highly competitive Indian market and at the speed that is required, not only we need capacity, we need the localization of the suppliers, what we call the tier N localization, and we need our engineers to be Indian. We need the speed, we need the imagination, we need the competitiveness that you can only get in India. I think a few companies can do that. I think we are one of those that bet for this, and it's going to be a key competitive factor for our company and our products to continue to be and even enhance the competitiveness.
Right. So when it comes to R&D, are you going to be setting up a bigger R&D center in India? Will hiring for research and development be a bigger focus area?
Yes, both answers to it, yes. So we want to have more engineers, we want to have more capabilities so that we are faster to go to market, and we are able to not only develop greater technologies here, but also to export these technologies to other countries, namely those that are going to receive the products produced here, but also, why not, all other global markets or even our headquarters.
Right. When it comes to capacity and upgradation, you've given us a plan as to where you want to see the capacity by 2030. Now, how will these production lines cater to EVs, hybrids? How are you foreseeing that demand? And how will these production lines manage changes in the demand scenario?
Right. So one of the strengths of Hyundai Motor Group is the flexibility. We call it in Korean pali-pali, to be very fast adjusting, right? And then if you look at typically some of our plants may produce 6, 7 products in one line. Most of our competitors will produce maybe 1, maybe 2, maximum 3, but 6 to 7 is quite a lot. So flexibility allowed our company to be the least impacted during COVID. When a lot of companies had to stop a line because they didn't have particular chips for a model, we were able to adjust the models we were producing with the chips we were receiving. So flexibility is key. As mentioned, by 2030, our plan is to have 55% electrified vehicles in India, having battery EV, EREV, and hybrid, as well as CNG, which is very, very specific to the Indian market. So that's the plan, but if we need to adjust, we will adjust. So I will set as an example our plant in Savannah, Georgia, which is the latest and greatest that we have put in operation. You know, it's a state-of-the-art plant, which we announced for 300,000 units of capacity. and then now we have already expanded to 500,000. This plant was meant to be BEV only. However, we saw the demand in the market more into the hybrid territory, so we have made extraordinary investment to be able to produce hybrids, which will start coming off the line starting next year. So in addition to that, we will do also EREVs. So flexibility is key, but again, our plan is kind of 45% traditional powertrains and then 55% electrified by 2030.
Right. Now, speaking about hybrids, could you give us a sense of how many hybrid cars will Hyundai have in its portfolio by 2030?
Yeah, very clear. So the current plan is 8, which is a lot, from none to 8. This is a huge investment. We believe that the hybrid models are going to be well received in the market because you have kind of the best of two worlds. You have a great improvement in terms of the running costs, a great improvement in terms of fuel efficiency. Now we're very competitive also in cost, as we do in other markets, and you have zero range anxiety, right? So these are the benefits. We have seen, you go to the US market, which, as you know, very competitive, that typically in a given month we will grow maybe EV sales 10 to 20%, depending on the month, which is a great result given the EV chasm. And then hybrids will grow by 60 to 80%, right? We believe something similar may happen in the Indian market.
The debate between EVs and hybrids, in some geographies, we've actually seen the sale of plug-in hybrids exceeding that of electric vehicles. In the next 5 to 10 years, who do you think will be a winner between electric vehicles and hybrids?
In our plan, we believe they're going to be balanced. On the one side, the electric vehicles bring a greater performance when it comes to acceleration, handling, excitement when you drive, because they have lower center of gravity, very stable, huge acceleration. But then, as you know, they depend very much on the charging infrastructure, depend on the usage, etc. And then the hybrids have no range anxiety there. So the way we see it is that if you are, for example, in a city where you commute and then you have good charging infrastructure, probably a BEV is the best solution, especially if the government wants to support that technology because it's the best for the environment, right? Now, if you live more on the countryside, probably a hybrid until you get a great charging infrastructure could be the better solution. In fact, one of the elements of our plan, we have announced that we want to increase our presence in the countryside, in the rural areas of India, and to be the closest to the consumers. We have today 3,600 dealers, but we want to increase our presence there to be closer to the customer. Because ultimately, when the customer buys a product, of course, technology, design, price is very important, but service is very important too. You don't want to buy a car and then find out 2-3 months into the ownership, oh, I cannot repair it, it takes forever to get the parts, etc. We want to be closer to the customer and apply what we call Sonnim, which is the concept of honor guest. So every customer should feel welcome and be willing to go visit our dealers.
All right, please hold that thought. We have to take a short break, but when we return, this conversation with Hyundai Motor Company's global CEO, Jose Munoz, continues. Welcome back. You're watching CNBC-TV18 and we are in conversation with Jose Munoz, the global CEO and president of Hyundai Motor Company, and we're talking to him about Hyundai's 5-year plan for the India market. What's going to be the best price point according to you for electric vehicles in the India market?
We have not announced this type of information, but we'll be always competitive. We are always competitive, and then we want to bring to the customer the best. To that end, I would like to also announce, as I announced earlier this morning, that we've taken the decision to introduce for the first time ever next year our sales finance captive company, Hyundai Capital. So sometimes it's not about the price of the vehicle, it's about the financing capabilities. So by introducing APR programs, financing programs, leasing programs, we are sure we are able to provide to the consumer the best financing position. And then it's not about, hey, this price is too expensive, etc. It's, can I afford it? Can I get credit? Can I pay this on a monthly basis? And if that is the case and the conditions are competitive, I believe this is going to be a changing agent for our company.
Right. Who do you see as your biggest competitor in India right now?
Everybody. So we don't look at one competitor. We're looking always at all competitors. I think we've seen that all domestic competitors are getting better. They have a great design. They bring new products. They bring innovation. They're very competitive, which we love. We love the competition. This is what makes us better, right? We like the challenge, and the more challenge we get, the better we become, right? So everybody is a good competitor. We respect them all, but we hope we can very quickly reestablish our number 2 position. Why not even higher? Always in a disciplined, profitable, and a steady way that allows us to be always providing the returns that the shareholders are expecting.
Right. Have you set a target for your team as to by when do you want to be number 2 or at the number 1 position?
Yeah, I think it's not an obsession again. To me, what we have announced today is more about the double-digit margin, which is the constant. We keep delivering those outstanding results. We have announced also that the dividend policy is going to be between 20 to 40%, which is very good. So I'm very confident. I think already when I look at the numbers in the month, we are already back into number 2. So number 2 is not an issue. So it's there. It's every month, and then we will take it from there. But we are not going to compromise on what we call the revenue management, the quality of sales, which is what the investors expect. So the investors don't like you to be number 1 and then make no margin or losses. No. We rather be number 2 solid, provide good customer satisfaction, or number 3 and very high returns on investment. And if we can make it to maybe number 1 one day, why not? But it's not our obsession.
Okay. India has carried out GST reforms, which has helped the auto industry, as your team has also said. If there was one thing which India could do to make it a better market, which would help higher sales of high technology vehicles, high-end SUVs, what would that be?
Well, one thing we've learned over time is that the incentives to the demand of newer technologies are also helping. So from that point of view, programs like FAME or like we had in the US before the IRA, they really help the demand, especially at the beginning. And once you achieve critical mass, then you can be more profitable as an OEM. You can continue to invest and to grow, but then already the consumers know the technology and they are confident. So I think that's what I would say. Incentivizing the good technologies where the country wants to develop the growth, I think that's always a good tool.
Incentives on future technologies in cars, you mean? Because currently there are no incentives on cars.
That's what I mean, yes.
Right. To speak about your export contribution, you're looking at a 30% export contribution from HMIL. Which are the countries where you want to improve your or increase your footprint to? Currently you're exporting to over 80 nations.
Right. So the most important market for us these days in terms of export is Middle East and Africa. The second, it is Latin America. so Mexico and Latin America. And then you have other markets. Those export markets are really great because even if geographically markets like Latin America, you would say, wow, this is far away. Well, the product is so well received, the quality is so good, and the competitiveness is so good, that is extremely well received. I have every month the presidents of the different markets in Latin America, they come and ask me, can I get more, particularly Creta, for example, very, very popular. But Middle East, I think, is the markets which are very profitable. They're growing thanks to a lot of favorable policies. And I think they're very favorable for the Indian manufacturing.
Right. My last set of questions, sir. You know, we've been seeing a lot of competition from Chinese players globally. They're giving the likes of Tesla and Ford a very difficult time in the Chinese market. How do you see the competition from Chinese EV makers right now, and what do you think is giving them the edge?
So I think we, as you know, are present in the Chinese market, and very recently I've taken leadership of that market. And then it's the largest market in the world. And then you have a lot of competition because there are so many brands, right? And then they've been able to develop their technology very fast. And then they've gotten a lot of government support. So if you combine those elements, they make them almost unbeatable in their domestic market. Now, is this policy sustainable? And is this something that they can sustain outside of their market? I think they're making efforts and they're increasing dramatically their exports. So we will see how many brands are able to compete in the global market. Nowadays, it's very difficult to be successful only in one market. The level of investments are such in this industry that you need to have a huge volume and what we call the critical mass to be able to have EV, plug-in hybrid, EREV, fuel cell EV, ICE technologies, in some markets still diesel, right? And then to have the right capacity. So for us, we see the Chinese as very strong contenders. We analyze them, we want to compete with them, and we want to learn with them. But my observation is that the Indian manufacturers or ourselves, we are able to compete with them. And in fact, today, after many years of Chinese development, we continue to grow. We are the third largest OEM as a group. We recently overtook Volkswagen as the second most profitable global OEM. So I would argue that more competition has helped our group.
The rare earth magnet crisis, it has not improved. For some, it's getting worse. And China is now coming up with a large set of export controls, which will be on lithium-ion batteries and more than 10 to 15 types of rare earth. Are things going to get worse for the auto industry?
You never know. Things get constantly more and more competitive. As mentioned, for us, one of our competitive edge is the vertical integration. So not only we produce vehicles, but we also produce steel. We own our own tier 1, tier 2, sometimes tier 3 suppliers. We do our own logistics. We produce chips. We do a lot of things. So the more constraints and the more competition you see, the more challenging it is for us. But we are better equipped than others to compete in this
it's not
in
going
this
to
global economy.
put a stress on your production?
Always, but again, we have more flexibility than others. So anything that increases the competition puts more challenges on us. But this is not about the challenges for you. It's how those challenges compare to your competitors. And then other competitors may suffer more in these circumstances, right? We are more diversified. We are able to source from different places and take advantage of the power of the group. So more challenge, maybe more opportunity.
Finally, you are a PhD in nuclear engineering with experience in aerospace as well. What does that add to your automotive career? You started off working in a dealership. You became a dealer principal, from what I see. Just take us through your career trajectory and how your academic background, your background at a dealership has really shaped your leadership and your automotive career.
Well, it's very interesting for circumstances. I'm not going to tell the story right, but One thing I've learned through my development is the importance of analyzing and the importance of data, right? So in a world where, there are different languages, different standards, etc., as long as you have very clear when you determine the strategy on what to do, how to do, and you are able to provide direction to your teams, and then you utilize very simple tools, which everybody understands, like numbers, then you are able to drive a strategy. What I've learned through all these years also is to always challenge yourself, right? Automotive is, it used to be kind of a slow industry because the product life cycle was very low, very slow. It took years to introduce new products. And now, for example, we see the Chinese that are bringing new products constantly. We see the Indian OEMs doing the same thing. When you work in other industries like aerospace or nuclear, you need to be extremely fast and you need to constantly apply the latest and greatest technology. So this is something that I've learned. But I say to the team, I've learned also to be very humble because there is always something that you don't know. So you constantly need to know. And then you need to be very hungry all the time. To be the best, you cannot be happy with where you are. You always have to do more, have to be better, and challenge your team. And then you need to be the hardest working in the room. It's the 4 H's. Hyundai, you have to be humble, you have to be hungry, and the hardest working. So this is what I've learned from my early days as an engineer and working in a dealer, which the dealer dimension, I never understood how important would be in my career. Because ultimately, when we buy a car, we think we're buying a car, but in many cases, the consumers are buying trust, buying confidence from that dealer. And they buy to the dealer. And they buy to the dealer that product because they know if something goes wrong, they're going to come back to you and then you will fix the product.
Right.
So that's very important. So this is something that I can thank my family and my career that I can utilize every day.
So humble, hardworking, and hungry. Is that the leadership mantra you live by?
Absolutely.
All right. Thank you very much, Jose Munoz, for speaking to us here on CNBC TV18 for a very comprehensive conversation on the next 5 years of Hyundai in India.
Thank you very much.
That was Jose Munoz in conversation with CNBC TV18 on Hyundai's 5-year plan for the India market. Thank you for watching. Goodbye.
Co-powered by SBI. Best है सबको पता है. Co-powered by SBI. Best है सबको पता है.
Hello and welcome to this special broadcast on the RBI Minutes. I am Lata Venkatesh. The minutes from the meeting of the Reserve Bank's Monetary Policy Committee are out. Remember, the Reserve Bank MPC had unanimously decided to keep the repo rate steady, unchanged, at 5.5%. That was on October 1st when the meeting had ended. The minutes that are announced, that are just announced, reiterate what the governor had said in his statement on October 1st, that even though the fall in inflation gives the MPC space to cut interest rates, cut repo rate and support growth, it is not the opportune time to do so, the governor had said. And in the statement, he explains that this is because of global uncertainties and the unlikelihood that a rate cut will be utilized by the business community. They're also waiting for a fuller passage of the rate cuts that have been given so far. The external member of the MPC, Dr. Nagesh Kumar, has also advocated that a wait-and-watch stance is better so as to see how the US trade policy uncertainties play out before the MPC considers a further rate cut. He joins us today on the show to explain the thinking behind the MPC's decision. Mr. Kumar, thank you very much indeed for joining us. Let me start by asking you, whether you think that the decision was fair, considering that the inflation number that has come after your decision has also undershot. The RBI forecast the July, August, September average to be 1.8. Now the average is working out to 1.7. So do you think a cut could have been given?
Well, it's a, issue of uncertainties that we were looking at. Trade policy uncertainty and inflation numbers going down, certainly provided policy space for monetary policy action. However, all of us felt that transmission of the heavy dose of repo rate cuts in the past is still happening.
Okay.
And we wanted to wait for that to be fully transmitted before we consider and look at other options and other actions. And the uncertainties, how they are being resolved, how much of impact or incidence on growth and investments there is going to be. So we wanted to, come back to the next meeting when things are a bit more clear before taking a decision.
Okay, fair point, sir. Actually, your set of minutes are extremely instructive because you are giving us a lot of minute details on the impact of the US tariffs. You point out that although India's merchandise trade is only 20% exposed to the US, the labor-intensive exports are exposed to the extent of 33%. Do you therefore expect a fairly big impact on growth in the second half? Because, a lot of MSMEs could be hurt.
Yeah, well, as I said in my minutes, the impact on growth, I'm not too much worried about because it may be, between, say, 40 basis points to 60 basis points if, in the worst case scenario. But I was more concerned about the impact on jobs and particularly MSMEs and the jobs that they create and sustain, because although United States is a market for 18 to 20% of our exports, merchandise exports, but they are much bigger market for our labor-intensive industries, such as textiles and garments, gems and jewelry, processed foods like shrimp, the leather goods and all that. And these are the industries which are dominated by MSME. They create a very large proportion of jobs actually the labor-intensive industries account for 40% of total manufacturing jobs in India. So if 33% of their market are in United States and that is affected, so there is a prospect of some impact on the MSMEs and jobs, but it's not that no action will be taken to take care of or address this. So I have also talked in my statement that we need to find alternate markets for these exports, which will be possibly affected. One is the exploitation of the domestic market fully, and for that, government's reforms on GST side, the GST 2.0
should help.
Is helpful, and early indications suggest that boost to demand is showing up. The other is to find other export markets, diversification of export market, and in that context, the India EFTA, European Free Trade Association EFTA, which became effective from 1st October, is helpful. The UK-India FTA, which was signed recently, is helpful. The expedition or expediting the negotiations of India-EU FTA is also going to be helpful. But I also mentioned that we should also fully harness the potential of India-Japan, India-Korea, India-Australia, India-UAE FTAs, which are already in place.
Yeah, actually, all that the statements that you make are running on our screen as you speak. The main points that you make. I wanted to just ask you, sir, that since inflation is undershooting, now I took a poll of professional forecasters, and now the expectation is that the full year average may not even be 2.6, which the Reserve Bank forecasts. But after looking at the more recent numbers, it will probably be 2.3 or 2.2. That's the average I'm getting from about 10 economists.
It is possible. It is possible.
As well, the year-ahead inflation, which Reserve Bank forecast, they brought it down from 4.9 to 4.5. Now chances are it will be 4. So do you think the space opens up for more than just 125 basis point cut? Because inflation is really benign and WPI is at 0.13. I mean, there's hardly any core inflation impulse from the rest of Asia, and you will know that better as a trade expert. So do you think there is space for more than one cut?
Well, it is something which we have to see going forward, but certainly this kind of very benign inflation outlook, and all the surveys are indicating that inflationary expectations are very well anchored. So this certainly opens up space for monetary policy action. And so this is the call we have to take when we meet next in December, and going forward, all the numbers, not only of inflation, which are going in the right direction in the sense that they are opening up policy space, but how much of impact the growth side is facing, or challenge growth side is facing, and how much support we need to give from the policy action. So this is something which will be certainly debated in the next committee.
A final question, sir. Do you think the Reserve Bank was too hasty in going to an accommodative stance? There are some in the market who believe that the transmission through the bond market got stymied, got stopped, because this expectation channel was taken away because of the change in stance. You have actually even spoken about it. That's why I'm asking you. It would have been a better idea to retain it at accommodative?
Well, I and another rational member did feel that at this point we could possibly change the stance to accommodative, which will be reassuring to the markets that the Monetary Policy Committee or policy action, supportive policy action will be there if there is a need. However, there was, the consensus was not there.
Okay.
But these are things which are evolving constantly.
Okay.
So I hope next time around when we meet, we have seen greater clarity of the numbers and trends, and maybe there will be a greater coherence between all the members on this issue. In any case, the stance is something which is not voted upon.
Yes.
It is an individual view, and I think next meeting will have more clarity on all the different dimensions of growth versus inflation or growth inflation dynamics, and how much of action is needed. So we'll consider all of that.
Okay. So we're just out of time, but very briefly, do you think there is a major disinflation in Asia which may continue to impact disinflation in India? Chinese related.
Sorry?
Chinese dumping related.
No, I think some of it, of course, will be linked with the dumping of cheap goods. But on the other hand, I think the supply side is opening up, helping because of the good monsoon. The GST reforms are also helping to bring down prices, and some bit of sluggish demand in urban consumption probably is also behind. So it's a combination of several factors rather than one.
Okay, fair enough, sir. I was just swept away by the WPI falling so much. Thank you very much, Mr. Kumar, for joining us and helping us understand the arguments behind the MPC's action. We hope we will have an occasion to speak with you before the next meeting. Well, that's the word coming in from one important external member of the MPC. We have to take a quick break, but don't go anywhere. We have a couple of market participants, experts joining us, Axis Mutual Fund's Devang Shah and Abhishek Upadhyay of ICICI Securities PD, to give us their view of the minutes. Back in a minute. Welcome back to this special monetary policy show where we are discussing the minutes of the RBI's MPC, which have just been released. The overall or the single theme that the minutes exude is that there is space to cut, but perhaps it will be wasted in October itself. It would be good to wait because there's too much of uncertainty and therefore a rate cut may not be used well. That seems to be one of the main themes emerging from at least the RBI members and even the external members. To understand more and to understand how the market is interpreting these minutes, I'm joined by Devang Shah, Head of Fixed Income at Axis Mutual Fund, and Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealership. Abhishek, Devang, thank you very much for your time. Abhishek, what did you take away? Are you getting a sense that MPC members are still very stingy about rate cut and we may at best get one in December?
Well, Lata, so comments make it clear that December rate cut is more or less a done deal. There is clear mention that there is policy space and members are only waiting for the monetary policy transmission to take place and for some clarity about global developments. If at all, the data which is being made available after the meeting was held, including on inflation, which was in line with market expectations, but details indicate and high-frequency data for the current month, if you look at that, indicate that for October-December period, inflation could be tracking 1% versus 1.8% predicted by RBI, so sharply lower. Also on the growth front, globally, the eruption of US-China trade conflict has meant downside risks to growth stemming from the global side have also increased. So quite likely that December is more or less a done deal. But issue is market is already pricing in a full rate cut. The swap market is already fully pricing in a December rate cut. Issue is whether there will be more easing. On that, there is less clarity from these minutes. There are some comments coming from external member Saugata Bhattacharya, who's pointing to next year inflation profile, which is around 4.5%, which will be a sign that maybe scope for deep cuts is not there. If other members also start making similar arguments.
Okay. Devang, what have you taken away from the minutes as a bond dealer?
So, Lata, I agree with Abhishek. Largely, 25 basis in December is a done deal because the minutes and all the policy members have actually put across very clearly that they have passed the October policy just because they wanted to see the impact of GST and get more clarity on the tariff rate. Our perspective is that the swap curve is pricing 25 basis completely, but the bond markets might lead to around 5-10 basis of other additional rally if the 25 basis rally rate cut gets delivered in December. Okay. I think the communication will be much more important, and if the tariff uncertainty continues, and I think at this point of time there is no clarity that whether it is 25% or if this 50% continues for long. If this tariff uncertainty continues, I think the communication would continue to remain dovish, which then markets might price in another 25 basis rate cut in February, which can lead to additional rally in our bond markets. But at this point of time, I think today bond markets have drifted lower over the last 10-15 days. In fact, the 30-year bond yields are from its peak 30 basis lower. Ooh. So our view is that into the policy, we might see a 635 on 10-year, which is 7-8 basis from current levels. Very high possibility.
Oh, okay. Abhishek, are you... getting a sense, or can one argue that the inflation number is likely to be, as you pointed out, far lower than the Reserve Bank's lowered forecast of 2.6? I mean, they may be forced to come to terms with probably a 2.2 for the current year. And even the forward estimate that they are giving of 4.5 may have to be brought down closer to 4. So is there a door opening for more than one cut? Can you sense any of that at all in the minutes of more than one? Or are the minutes looking a little more hawkish? Will the market look at it as hawkish?
No, I don't think minutes are hawkish. For me, the reason why the monetary policy decision was dovish and the latest minutes are also consistent with that is that the committee didn't underplay the disinflation which is coming from the food side and from GST-related changes. Normally, these drivers of inflation
are one time.
Are typically will not lead to easier monetary policy, right? Because next year inflation could be high for the same reasons.
Yes.
But there is no emphasis on these one-off, potentially one-off disinflationary forces, which is a sign that maybe committees is looking to leverage these favorable inflation optics to address any growth concerns.
Okay.
For me, the scope for cut after the next meeting in December should be heavily contingent on whether these higher tariff levies stick or not. If they don't and tariff levels normalize to rest of Asia levels, and if inflation is still lower but because of these drivers, then I would still think RBI would be well advised to take a more cautious approach and basically not cut further.
So you mean any rate action should depend on the growth worries and not be inflation driven? Is that what you're saying?
I think the best way monetary policy can support growth in this cycle is by keeping these rates for longer. Delivering that one extra cut led by which is triggered by soft food inflation or tax cut induced impact. I don't think that would be very wise tactically. As we saw earlier, also during rate hikes, also RBI didn't go full hog and hike to the full extent. They stopped a little early, and that allowed them to basically deliver easier policy settings basically over a long time frame. So my sense is Feb or April rate cut will depend on growth related concerns rather than inflation related basically tailwind, which is a trigger for maybe a December rate cut for sure.
Okay. Just a final question, Devang. No joy for a trader, right? For a bond trader, I guess a few more basis points if December sounds benign. Is there otherwise there isn't much for a bond dealer either, right? For a bond bull.
Yeah, so completely with you, Lata. So from a monetary policy perspective, in fact, we saw that price action in bond markets. Like when June monetary policy, RBI commented that largely there is no or limited room for monetary easing. We actually saw yields going up.
Yeah.
So the last rate cut, if it is December or February, will not lead to any significant rally. The only joy which can probably, or the reason for additional rally which can happen in the next quarter, as per me, is that there is a high probability of Indian bonds getting added into Bloomberg. So they have started to review our index again and probably look at FAR securities, start the dialogue open. And they are consulting FPI investors. If that happens, I think that triggers another 15-20 billion of flows depending on our allocation, and which probably can come into, which can lead to positivity around bond markets, and we can see a 10-15 basis of rally. But very low probability of going below 6 quarter on 10-year GSEC at this point of time.
Okay, 6 quarter also looks quite ambitious, I must say. Because, I mean, if it is the last and only cut in December, then I guess the bond markets will have to rest content with where they are now. Thank you very much, Abhishek and Devang, for joining me and giving us your idea of how the bond markets might interpret the minutes and what you all are expecting in the days to come. Basically, the minutes are clearly telling us that there is space for a rate cut, and that may be one more in December. It's clearly to that extent a benign or a dovish policy and a dovish set of minutes. That's it on this special show on the RBI MPC Minutes. Thanks much for watching. There's news and updates lined up for you after the break.
Co-powered by SBI. Best है सबको पता है.
Hello and welcome to this CNBC TV18 special. I'm Timsi Jaipuria. Taking the reforms agenda forward, the government has recently brought in new changes when it comes to easing the hassles related to the Employees Provident Fund. The Employees Provident Fund Organization, or the EPFO, in its recent board meeting took some really sweeping decisions. To decode them, today we are joined by Chief PF Officer Ramesh Krishnamurthy. A very warm welcome, sir. Let me begin by asking you, on this reform agenda, government has now allowed members to withdraw up to 100% of their PF amount, covering both employee and employer's contribution. What are the conditions? What is the rationale behind this move, sir?
So, thank you for having me on this program. The Central Board of Trustees, headed by the Union Minister for Labour and Employment, Mr. Mansukh Mandviya, yesterday on 13th, took the decision to simplify partial withdrawal claims, which under EPF to a great extent. Mostly because there were over 13 different conditions covering education, marriage, housing, and other special circumstances, which were complex in the sense that they had different eligibility criteria in terms of minimum service, in terms of how much people could withdraw. Sometimes it was a multiplier of their basic wage. Sometimes it was the amount of cost involved in purchase of a house, for example, or in terms of their balance, so either 50% or 75% of their balances. All this was creating a lot of confusion in the minds of the members. So what was felt was that let us make it easy for people to access their own PF money in times of financial need, but at the same time protect their PF for their long-term social security requirements. As you are aware, India is a young country, but all the youth who are going to retire, who are now coming into the work, are going to retire in 2055, 2060. So unless and until we plan for proper social security protection in times of their retirement, then they'll have less of a corpus to be available. So that is why a concept of a minimum balance of 25% was visualized, and that has been kept away as a minimum lock-in balance. Rest of the 75% is freely accessible up to, so if 100% of that is accessible by the member, and as I said, for illness 3 times a year, for education 10 times during the membership, for housing and marriage, including their own marriage for a youth or their children in future or for their siblings 5 times, and for their housing needs about 5 times. Apart from that, what we have done is that we have eliminated.
Let me break you out there. The Central Board of Trustees also in its meeting, which was held on 13th in New Delhi, said that partial withdrawals members can take up to 90% of their account balance for purposes like buying land, building or a home, or repaying a housing loan. With the new decisions, EPFO members will now be accessing the entire eligible balance when needed, subject to certain conditions, certain rules. So what are these cases, like you were explaining, that there is a minimum balance criteria also, but in some cases 100% withdrawal is also there. This is a little confusing. If you can decode that, yes, a minimum balance is mandatory in all the cases, or in certain cases it can be done away with. Is that the case?
So let me first correct you. There is no 90%. Now it is 100% of the eligible balance. How we are defining eligible balance is your total contributions every year or every time that you make. Out of that, 75% will be available for withdrawal. 25% will be kept as a minimum balance. So out of this 75%, everything is available in one shot, in multiple frequency. It is up to the member to decide how he wants to withdraw it. So there are no conditions attached. The only condition is that we have reduced the service eligibility, which was, for example, for education, it was 7 years. For housing, it was 5 years. And in some cases, it was 3 years. We have reduced it to a uniform period of 12 months. What we have said is that the uniformity in eligibility, uniformity in withdrawal amount will help the members in giving full clarity. This 25% minimum balance, let me just explain to you what it means. It means that if supposing your total contribution of employer and employee is to your PF, excluding the pension part which goes away, is supposing it is 10,000 rupees, then out of this 10,000 rupees, 2,500 is kept aside as minimum balance. The 7,500 is allowed for any kind of withdrawal. Supposing the member does not withdraw, next year it still remains available for withdrawal. So it is both these balances with interest will continue to grow, and any member at any point can withdraw up to 75%, 100% of the 75% that has been earmarked at any point of time based on the reasons I've already mentioned. What we have sort of projected is that a person who is earning 15,000 rupees, say, for example, the employer and employee share comes to about 28,200 every year. Now, if you project that for the next 20 years, assuming a simple 8% compounding interest, the total accumulated PF balance, if he does not do any withdrawal, comes to nearly about 14 lakh rupees, which is a substantial amount. But out of this, 75% he can withdraw. That is about 10.5 lakh he could have withdrawn any time during this 20 years. He could have withdrawn this amount, whether it is at the end of the 20 years or whether it is immediately every year he wants to withdraw, he can do that. But the minimum balance which is accrued now is nearly 3.5 lakh. Now, that is a substantial amount which at the time of superannuation or retirement will be of tremendous help to the worker.
Some experts are also saying that the withdrawal timelines in case of unemployment has been increased from 2 months to a year, and this is unfair. What would you like to say on these concerns, sir?
First of all, this is completely misleading. As I said...
why is it misleading, sir? Because definitely when we read it, we feel that, yes, 2 months and 12-month period, there's a lot of difference. And in case of unemployment, every penny counts, and this is an employee's own hard-earned money. Kindly explain, sir.
Yeah, so what I'm trying to say is that, as I said, apart from illness, education, marriage, housing, there is also, we have kept a separate category called special circumstance. In special circumstance, up to twice in a year, you can withdraw up to 100% of your eligible balance. So the 75% is always accessible to you. Now, what used to happen earlier was that you could have withdrawn only small amounts towards illness or something like that. For unemployment, you were forced to take a final settlement. So anything more than 2 months that was available as unemployment, you would have had to exit your PF membership. What was happening was that we were finding that people were exiting their full PF membership. Therefore, what was happening is that they would wipe their entire PF balance completely and they would rejoin after some time. So what was happening was that they were losing out on a very important component, which is called pensionable service. So every time you have left a job, you have joined a job and left a job, that is the period of service that keeps on adding to your pensionable service. If you have 10 years of pensionable service, then you are eligible for a pension. Now, what was happening was that because people were withdrawing their PF money and simultaneously also withdrawing from their pension corpus, their pensionable service never increased. So we have seen 75% of our EPS members who are contributing to pension have withdrawn their entire pension within three years. Now, that is something which is harming them. Secondly, we have also seen that nearly 50% of the PF members have a corpus during final settlement of less than 20,000. So what was happening was that the main reason for their holding a PF account was towards social security protection. Now, this was completely, was going away because people were withdrawing. And again, let me point out to you, in 24-25, there were nearly 1.25 crore rejoinees. So a lot of people who leave one job also take up another job in a short period of time, maybe after 2 months, 3 months, or whatever, 4 months. So what was happening was that your exiting of PF membership is doing a lot of harm. So we wanted to make sure that while we have made it super simple for that 75% to be available for any kind of financial need, including unemployment during this, any kind of a break between two employments. So 75% of your corpus is still available for withdrawal. It is only that 25% which is locked up to 12 months. And after 12 months, if you're still unemployed in a worst case scenario, in a very unfortunate scenario, if you're still unemployed after 12 months, then this balance 25% also is available to you for withdrawal. So I think it's a very prudential move, and it helps in both ways. It is allowing for that small probability of an extended period of unemployment, but at the same time, within that 12 months, you still have 75% of your corpus available for any kind of financial need. So therefore, I would say that this is a very balanced proposition, and we expect that this will help our youngsters in building up a retirement corpus in 20, 30 years period of time.
We'll slip into a short break and we'll be back with more details on the recent decisions taken by the EPFO board on the PF withdrawals and other crucial decisions. Stay tuned. We'll be back shortly. Welcome back. We are still in conversation with Chief PF Officer Ramesh Krishnamurthy, where he's talking to us about how the recent decisions taken by the Central Board of Trustees of the EPFO, talking about the withdrawals and why they have been made in these new fashion, where with more new limits and yes, a lot of easing of hassles. So coming down to pension again, similarly, withdrawal of pension will be now allowed only after 36 months rather than 2 months, which again experts say that, you know, there is not enough that is meeting the eyes. Probably you can explain, making what is the rationale on that side, sir? Why 36 months from a 2-month period?
Understood. Number one, please understand that your pension contribution is coming entirely out of the employer's contribution. It is not your money, but it is the employer's contribution towards PF that is going towards pension, number one. Number two, if you see, As I
So,
told you,
but that is,
75
but so let me tell you there, it is not employees' contribution alone, because it is part of people's pay package. This is included in the pay package of the people. So every employee feels that it is their own money, which is repurposed as EPFO to meet the needs of the EPFO criteria, which employers get the benefit of saying that in the government eyes, it is employers' contribution. To be fair, it is part of your salary package.
No, I fully understand. It is a part of your CTC. All I'm saying is that is a part which is getting diverted out of your 12% of your employer share towards pension corpus. Now, what was happening was that, as I told you, nearly 75% of our EPS members were withdrawing their full pension after, they were saying 2 months of unemployment. But as I told you, most of these people are rejoining after a short period of time. But once they exit from the pension and take a final settlement for pension, their pensionable service gets reduced down to zero. So every time they would exit pension, the pension corpus, they will work for 2 years, 3 years, exit pension, again come back, work for 2, 3 years, again exit pension. Their pensionable service never crossed 10 years. So what was happening as a result is that people who were eligible, because people have worked for 20 years, 30 years, but because they kept on taking breaks and they kept on withdrawing for pension, they never accumulated their pensionable service with EPFO. They were deprived of pension coverage which they were entitled to. Mind you, this is not only for themselves, but this is also for their family members in the unfortunate event of a death. So if the member passes away, the family gets family pension. So this is a lifelong benefit. There is no restriction on the age, and also it's for survivor. What we were seeing is that, for example, for the year 22-23, nearly over 31 lakh EPS members, who were eligible, who could have got pensionable service of 10 years, they have withdrawn their money, and they have lost out or forfeited their pension eligibility. So what we thought is that in order to make sure that they don't make the mistake of withdrawing from pension, we have increased the period of 2 months to 36 months. There is a rationale for that. Already in the pension rules, there is a provision that even if there is no contribution, if any person dies in harness before retirement, even if contribution is not received for 36 months, then also the family members are eligible for a full family pension. So we have aligned that with the same period. So it is actually a huge social security rationale and a benefit for people who are otherwise who would have derived a pension, but they have missed out because of break in service.
So my last question to you, what are the new measures that EPFO is considering for social security? Because this entire mechanism of EPFO is for social security, and recently Labour Ministry was also conferred with the prestigious ICICI award for efforts again for social security. So what is the road ahead for social security of labour and workforce in India?
Recently in Kuala Lumpur, India was conferred with the outstanding achievement in social security protection coverage, which increased from 19% in 2015 to over 64% in 2025. And the award was received by our Honorable Labour and Employment Minister, Mr. Mansukh Mandavia, on behalf of India. Now, what it means is that there were many social security programs run by central government, state government, welfare boards, municipalities, and others who are doing it. There is a need for probably some kind of a convergence. And this convergence has been achieved by demonstrating this part. As you're aware, the government has already taken steps. PM Ayushman Bharat Yojana is available to all people who are as per the socio-economic status of 2011. That has been extended to senior citizens above 70 years. In this year, in the budget announcement, it has been also made available to gig and platform workers. So there is a thought process of expanding social security coverage to greater sections of society. Pension is one of them. And as you see, our efforts, including the PM Viksit Bharat Rozgar Yojana, or the new employment enrollment scheme, which was again notified on 13th. All these are areas where we are promoting increase in formalization of the economy. Increase in formalization means that more and more people get the benefit of social security coverage through PF and pension. And also in the informal sector, there is a provision under the Code of Social Security to provide for all kinds of social security protection. So the approach for the government is to increase the scope and coverage of social security protection, not only in the formal sector, but also in the informal sector. And the second part, obviously, which is also going to be important as we go along, is because India is now reaping the demographic dividend. But at some point of time, which is expected to be somewhere around 2025 or 2060, India will start to age. At that time, if we don't plan now, then at that time, there will be a difficulty for our senior citizens who are retiring at that time to fund for their retirement and for their financial security after retirement. So all that planning has to happen now. These are all steps which will
one crucial thing which I want to ask you here is when it comes to employment, as you said, social security is the roadmap of the entire government, be it Ayushman Bharat, be it employment-linked schemes. But unemployment continues to remain a concern. And since Labour Ministry is the custodian of employment, you spoke about employment-linked schemes also, ELIs, etc. What is the success rate of ELIs so far? Are we seeing any betterment in terms of unemployment rates? Are we seeing the unemployment rates reducing in the near future or in the recent past? Can you give me some data on that, sir?
PMVBRY scheme, as you know, came into effect from 1st of August. The first installment is due only in the month of February. So this is a new program. We have had nearly about 8,000 different outreach programs among various establishments, educating them about the new scheme. There is going to be a massive collaboration with Ministry of Skill Development because, as you know, it is not only employment but employability. Everything goes together. So there is a case of a demand, and the demand, as you see, is from the economy growing well. All the recent forecasts have upgraded the GDP forecast even recently. So that is one is demand-led. The second is from the supply side is the skill, and that is where the Ministry of Skill and its programs come into effect. A kind of a collaborative approach, a whole of a government approach in skill development, internship. The PM Bharat Viksit Bharat Rozgar Yojana, all of them build a momentum towards generation of employment and sustained employment. So that is the approach that I think we are taking. We are extremely positive. We've had a lot of outreach programs to establishments and through state governments and at district level, and we will continue to work towards that. As far as this is concerned.
Many thanks for joining us, Ramesh Krishnamurthy, and talking to us, especially explaining the rationale on the key decisions that have been taken at the recent Central Board of Trustees meeting on the 13th of October, and also talking about that how these new employment-linked schemes will actually be seen on the ground in terms of what is the actual success rate by February, but as of now, good feelers coming to the government. Well, many thanks for joining us. And with that, it's a wrap on this edition. Stay tuned for more news and updates on the other side.
Startup Street, I'm Arundhati Ramanan, and these are the top headlines from the startup world. Everbright Health, a services platform for mental health providers, raises $7 million in a seed round. The round was led by W Health Ventures and Sanos Capital. The funds will be used to expand its technology capabilities, accelerate market growth in the US, and introduce similar operational models for other advanced therapies. Prosus increases its stake in travel platform Ixigo to 15%, acquires the stake through an off-market transaction. Prosus bought a little over 5% stake from Peak 15 and Elevation. Coinbase backs CoinDCX with an undisclosed sum, an extension of an earlier round. The new funds will be used to support product development, new on-chain use cases, and expansion into international markets. Consumer raises $1.3 million from Aquarius Innovatex Fund to build the future of consumer research with AI. Round also saw participation by prominent angel investors. Funds will be allocated for technology development and market expansion, both domestically and globally. Chennai-based agri-tech startup Pregaria raises $2 million in a seed round led by WEH Ventures. Rain Matter and Spiral Ventures also participate. This capital will support Pregaria's fruits in providing year-round supply of high-quality, sustainable produce to the Indian market. Those were the headlines that we're tracking for you this evening. But on What's Brewing today, India's semiconductor ambitions just got a major boost. Bengaluru-based Morphing Machines, a deep tech startup incubated at the Indian Institute of Science, has raised 38 crore rupees in a Series A round. The round was led by IA and Alpha Fund with participation from Speciale Invest, Ivy Cap Ventures and Navam Capital. The company is building Redefine, a breakthrough many-core processor that promises to revolutionize computing for data centers and AI workloads, combining speed, flexibility and energy efficiency. Joining me now to discuss its growth blueprint is Deepak Chapeti, the co-founder and CEO of Morphing Machines. Deepak, thank you so much for joining us on the show today. You know, Morphing Machines has just raised about 38 crore rupees in a Series A round. If you could sort of, before we get into the fundraise itself, what's the core technology that's drawn such strong investor confidence? If you could take us through what's on offer at the company.
Thank you, Arundhati, for having us, first of all. Happy to run you through what actually has not only driven investor confidence, but has sustained it over a period of time. What we are building, our core technology processor, Redefine, is very differentiated. And in a sense, it is reconfigurable, which allows us to target multiple domains, right from AI to 5G telecom to self-driving ADAS cars or data centers. Now, it is this kind of flexibility and the ability to create for the world from India in a deep tech area such as semiconductors is what has primarily, sustained investor confidence in our journey.
Sure. And, what will this Series A funding specifically go toward, right? There's chip fabrication, pilots. There's also scaling your team and your customers. So what's, on top of the agenda? How are you going to use the funds?
So the way we're using funds is not for an end-to-end journey, but primarily for the design and validation of our processor. What this allows us to do is prove that, hey, there's a clear product market fit. And further to that, it is far more easier to kind of, get customer orders and do business. But primarily, we typically handle the entire supply chain of semiconductors via partnering with, foundries for the fabrication, with partners for software. But overall, we will be using these funds for building our test chip and generating, customer orders thereafter.
Sure. And, the company also says it's building a many-core processor called Redefine, right? Could you kind of explain to us in layman terms, how exactly does this differ from traditional GPUs and CPUs?
Yeah, absolutely. So actually, that's the biggest differentiator. Not only are we many core, just like a typical GPU or perhaps even CPU, right? CPUs also have multiple cores. Where we are differentiated is we can do workloads which are very good on CPU. We can do the workloads which work well on GPUs like AI, but we can also do some very complex high-performance compute workloads which are done on custom processors. It is this kind of flexibility which allows you to cater to the emerging workloads of tomorrow. So when you don't know what workloads are going to come tomorrow, how do you build a semiconductor or a processor for it? The timeline, and even what if the workload changes, right? I mean, you then have to upgrade your chips, and there's a whole entire cycle of spend and ramp up period which is involved. So this is where our redefined processor, which is reconfigurable in software, instead of taping out or making or fabricating a separate new chip and designing a separate chip, which takes about 30 months and about $50 million. All we need to now do is update our software, make an update in the software, and voila, our processor is ready for that new workload, which didn't exist before. So that's actually exactly what is the most differentiated for us, and we are one of the only global semiconductor companies who has this capability at this point in time.
All right. And with global demand for data centers and AI compute soaring, how soon can we expect Redefine to hit commercial deployment?
Yeah, so this is where the patience needed for semiconductor deep tech ecosystem comes in. We have taken fantastic, great steps thanks to the Indian Semiconductor Mission and the venture capital ecosystem support that has followed. But just like if you notice the journey on in the Silicon Valley in US, in Europe, or in China more recently, the time from first silicon to actually it becoming a mature solution which can compete on scale with global multinational incumbents, it's a period of 2 to 5 years. It could take anywhere between that. Unlikely it will happen before 2. We hope it will happen in 3. But formally we have seen a lot of folks, even from NVIDIA to other recent successes, have taken at least 5 years to kind of become mature.
So it does take a little bit of time for the company to, hit maturity. But if you could sort of then explain to us, you are in talks with clients and stuff. So who are the kind of clients that you are in talks with to sort of deploy, your chip? And when will we sort of see the first pilot projects?
So I think for us in our semiconductor line of work, we typically have this ability to prototype our processor. We don't have to wait until actual physical chip comes along. We can actually start testing out customer workloads even before the chip comes. Now, to add to the problem or the pain for us is that we are reconfigurable. So we have a wide variety of applications or demos to choose from. The choice for morphing machines, along with my founders, Professor Nandi and Dr. Anjani, has been we focus on very narrow niche areas where today no compute options exist. There are areas like BFSI regulated markets where there's a lot of demand for encrypted privacy, so some very advanced computation workloads is what we are targeting first in the data centers. Within that, we're targeting the BFSI market because it's highly regulated, and there are we have gotten an early traction with potential BFSI folks.
So early traction in the BFSI space is where you're looking and pushing hard at. But, there was the other thing that you mentioned as well, India's semiconductor mission, right? So like you said, India is pushing hard on the semiconductor front. How do you see morphing machines contributing to the country's deep tech and chip ecosystem? Yeah, so with morphing machines, we have taken up the challenge of building a innovative infrastructure ground up, right? I mean, it's a completely new architecture, microarchitecture built from scratch. And that gives us a lot of differentiation. But eventually, we envision that, over the next 5 to 10 years, over a decade's time, morphing machines Redefine will actually find its way into a host of diverse domains, right? We hope that our next telecom stack, when we transition over to 6G in 2030, it is powered by morphing machines' primary Redefine chip. Also, a lot of the ADAS vehicles, which are today really taking off, both in EV and the non-EV space, approximately 60 processors exist in these high-end vehicles, and we hope that these will again be replaced or catered to by Indian semiconductor companies, and we are aiming to target that as well. Additionally, all data-sensitive privacy things, right from defense data to BFSI data and medical data, all of this we anticipate will be catered to by morphing machines variants, which will be specialized towards preserving privacy while enabling machine learning as well. All right. And, you've mentioned that this chip can adapt to different workloads, right? If you could sort of explain how, software-defined hardware works in practice.
Yeah, so fantastic. I think you picked the right word, right? Software-defined hardware. So the typical challenge is that, if you use software to kind of, reconfigure, there are a little bit of overheads and performance hits and power hits that you take. The fundamental innovation of our architecture is, stems from the work of our founder, Dr. Anjani. And specifically, we do compute in a way which allows us not to trade off that power and performance, while at the same time giving you the flexibility. There's about a 5%, trade-off in the entire thing. But what it allows you to do is, cater to any given workload tomorrow. So in principle, without perhaps complicating it too much, we are able to almost paint an image of any application you give us onto our hardware, which allows us then, to kind of run it as if it were a custom hardware, which was, created over 30 months with an expenditure of 50 million, right? So we essentially have gotten I'm being a little bit reductionist here, but overall it is about painting an image of a given application or an algorithm onto our hardware. And that's what we have kind of figured out. That's our secret sauce.
That's your secret sauce. But, if you could sort of tell us, what were some of the challenges that you faced when it comes to, manufacturing semiconductors within the country?
So I think manufacturing or fabrication, as we call it, is fairly capex heavy and a volume led business. Until you have substantial volumes from the local domestic companies to sustain a foundry or fabrication business, it can never run profitably. That's the reason why TSMC is like the global manufacturer in terms of the foundry. But speaking of challenges, I think the primary challenges, I think India has sufficient hardware design. I mean, it's known as the design center for the world in semiconductors because we have a lot of good hardware talent. Where I think we are lagging specifically is in complex software areas like compilers. I think there's a sore gap there. And in order to kind of drive innovation in the semiconductors, right from the design to the architecture to the product and then finally to the fabrication, I think compilers and perhaps certain advanced packaging abilities are what need to kind of be targeted next.
Sure. And some of the targets that you've set for morphing machines is that over the course of time, you also plan to sort of enter global markets like the US and Europe, right? So how soon will we see that happen, once the pilot projects and all of that start? So give us a 1-year target for morphing machines.
Yeah, so I think, for some fabless semiconductors, you may have to increase that to 2 years. But over the next year, we have a test ship out. We essentially, prove our product market fit, saying that, hey, all our features, our reconfigurability, our low power, our very high performance characteristics are all captured and proven. And on the back of that, then we decide, okay, which is our beachhead market? And in our case, as I said, we're looking at regulated industries and privacy preserving machine learning. So these areas are the ones we will actively try to scale up in year 2, wherein we actually build up our order book and build up a sizable customer funnel, whom then we drive through our entire process. And after we conquer one vertical, then we actually move on to another associated vertical like an ADAS or telecom. But that's years 3 to 5.
All right, so that's a 3 to 5 year target that you've given us. All right, Deepak, thank you so much for taking time out and being here with us on Startup Street.
It's a pleasure. Thank you.
Moving on, as software becomes central to every business, companies are under pressure to deliver updates faster and keep their code secure. JFrog, known for its DevOps and software supply chain platform, sits at the intersection of these two priorities, helping organizations manage how software is built, stored and released. In this interview with CNBC-TV18's Ritu Singh, JFrog CEO and co-founder Shlomi Benheim speaks about the company's growing engagement with India, both as a base for talent and innovation, and as a key customer market, and what the company's strategy looks like as AI begins to reshape software development. Take a look.
Welcome to India. Let me start by asking you what brings you here this time around.
Well, Ritu, first, it's great being here again. And the first thing that brings me into India is my team. Every time that I'm meeting the team, it's bigger.
Yeah.
And we are very excited about the development of the team here as part of JFrog overall business.
Agentic AI, I mean, for the last couple of years, that's all we've been hearing when we talk about the software industry. What kind of changes has that brought about for how you conduct your business, the kind of risks and opportunities you think it presents, and the kind of partnerships you've had to forge to tackle this new Gen AI era?
JFrog is a software company that helps the biggest organizations in the world deliver software faster and more securely.
Yes.
Think about it as a logistic company that has to move physical goods from the factories to the store. JFrog is doing the same thing with digital goods from the creator, from the software developers to the user. So you touch something that everyone in the world is impacted by, right? Gen AI, agentic AI. And I know that like every CEO that you will meet will have to say 5 times AI in a sentence, right? But what is it that is being changed? Our experience as human beings is being changed and being powered by machines. So is software development. It's not only the developer that writes code anymore, it's also the machine that contribute code as well. JFrog helps not only secure, but also to make sure that software is being delivered faster, whether it was created by machine or by human being, without interrupting everything that runs in the background.
You know, let's talk about India since you're here on your visit here. And you're coming at a time when global technology companies are expanding their R&D centers here, their customer acquisition here. How important or how critical is the market for JFrog here, whether that is innovation, talent hub, or, you know, overall from a business point of view?
So we started long ago in India as a place that we got into, especially Bangalore, as a result of an acquisition. Yes. The first company we acquired was headquartered in Seattle with the team in India, in Bangalore. Second company that we acquired was, from whatever reason, headquartered in Seattle, and the team was based in India. So from the get-go, the first frogs that joined JFrog in India were a result of an M&A activity and inorganic growth of the business. And then we doubled the team every year since then. And what we started to see is that it's not only a team of R&D or a team of extension of our R&D and support services, it's everything, including sales, including operation, including finance, and everything in our company is also extended to India.
What is the kind of strength you have in India at the moment, employee strength? And you know, what are the plans to increase hiring, if at all?
Well, obviously, the immediate suspects are developers and engineers. Yeah. And India, and more specifically Bangalore, have an amazing pool of talents in this area. Some of them are coming from the biggest software companies working here, and some of them are educated in the university and looking for the first chance in a high-tech company. This is the first kind of audience that we attract. I think that the second group of talents are business people, marketing, sales.
If you just take a step back and give us a more macro view of what's going on around us. I mean, globally, we're seeing companies tighten their IT budgets. You know, what are you seeing on ground here, globally as well as in India? What are your clients telling you in terms of their spend outlook for the coming year?
There is, this is an amazing question because there are some trends that coming from the macro market and the very high level changes that we see, even geopolitical and macroeconomic. And they are digging all the way down to the daily task of the CIO and the chief information security of the company. And what we see as a trend is, number one, they all want to have a better predictability of their cost. Everybody understands that we are off or trying to get off a very deep macroeconomic crisis of few years. They are still trying to figure out how their business is working post-COVID. And there are a lot of geopolitical changes in the world. So with that, what they are looking for is, first of all, predictability. The second thing is that they are looking to consolidate tools. So if 2 years ago or 3 years ago, you were a best-of-breed point solution in the world of software, you would be considered as a very kind of innovative approach to be adopted. JFrog started as a best-of-breed solution. But slowly the market moved to platforms because the amount of tools that developers are now bringing to their territories, whether you are a bank or a car manufacturing or a retail company, the amount of software tools that are being brought is just overwhelming, so they are looking to consolidate.
Finally, Shmi, you know, you've been serving large enterprises in India for a while, and you have a whole host of them, hundreds of customers here in India. But recently, what we've been hearing from JFrog is the shift towards smaller and medium enterprises as well, the SMB segment. Give us a sense of, you know, why this shift, why now, and the kind of opportunity this new segment presents for a company like JFrog in India.
Most of our customers are enterprise customers. Actually, the top 10 on every vertical is a JFrog customer. So we are very honored and pleased to have that in our portfolio. But what happened now? Every group of developers, even if it's a 50 people company, become 1,000 times faster and more powerful. And what you see in India is that there is a lot of innovation happening in this country. because of the amount of engineers you have here. Now, if yesterday you needed a big enterprise and a big enterprise resources to be behind you, now with the power of AI, you can move much faster. You see AI companies that were established 2 years ago already crossed the $100 million in ARR.
Yeah.
And you see companies that were just established running faster than ever before. People are speaking about going public in these days in NASDAQ in the range of $400 million, and they are getting there in 2 years or 3 years. So we assume that the amount of innovation, the amount of talents here will also bring opportunities. And this opportunity is not necessarily going after enterprise solution, but lighter, small and medium
more agile businesses as well.
Agile solutions.
On that note, it is time for us to head into a short break. But coming up next, Bengaluru-based startup Airbound is aiming to revolutionize civilian use of drone technology. With deliveries already underway, the company is now setting its sights on scaling operations and expanding its logistics footprint across India. Stay tuned for that and more. Welcome back. You're still with us on Startup Street. Airbound, a Bengaluru-based startup, wants to expand the use cases of drone technology for civilian life, and it's starting with deliveries. CNBC-TV18's Meghna Sen reports that with a fresh round of funding under its belt, Airbound is not just looking at cutting delivery costs, but scaling its business and its footprint rapidly as it redefines logistics in India. Take a look.
Imagine getting your package delivered not by a biker, but by a drone flying straight to your neighborhood or doorstep. And that's what exactly most Indian startups are working on, and Airbound is one of them. And this 42,000 square foot facility which I'm about to enter is where the magic happens. This is Airbound's next generation drone. It boasts a blended wing body, meaning the wings and fuselage are merged into a single aerodynamic structure which offers fuel efficiency and space, and a tail-seated design which allows it to take off like a rocket and then reorient to fly like a plane. The startup says these drones will make deliveries up to 20 times cheaper than current methods. Armed with the $8.65 million it has raised in seed funding, Airbound is now raring to scale up manufacturing and production and make a nice project into a large-scale real-world operation.
These drones look really nice, they fly really well, but that's, it's just a nice project, right?